A very warm welcome, ladies and gentlemen. Thank you so much for joining us here today. My name is Keisha Lobo, and I'm going to be your anchor for the 8th annual 2-day Gatekeepers of Governance Summit. Ladies and gentlemen, there have been and continue to be exciting developments in the corporate governance space. And it is our expectation that many of them will figure in the deliberations over the next 2 days. So as we begin this morning, a word about our organizers. Excellence Enablers, a corporate governance and board advisory consultancy firm that was set up over a decade ago. The continuing endeavor has been to grapple with the issues that impact the interests of the stakeholders while at the same time demystifying corporate governance. Working with the founder, Mr. Damodaran, on this endeavor are a number of highly experienced and renowned consultants and advisors, MBAs, company secretaries, and lawyers who offer experience-based consultancy and courses on the journey from compliance through governance to performance. Ladies and gentlemen, the collective experience and wisdom of the speakers and the members of the audience at each of the earlier 7 summits has helped to establish Gatekeepers of Governance as the premier annual corporate governance summit. As in the earlier years, we have at this year's summit a number of outstanding speakers who are uniquely positioned to shed light on solutions to complex matters. So over the next 2 days, we will have 9 sessions that address different aspects of corporate governance. So we thank each and every one of you, as I look around this morning, for joining us in our search for the best solutions. So ladies and gentlemen, as we move into our inaugural session, which is on the challenge of regulation, ensuring orderly conduct in the regulated universe is a major challenge given that human conduct is often informed by greed and the pursuit of short-term benefits. What does it take to ensure compliance and good governance? At the same time, have increasingly prescriptive regulations adversely impacted the ease of doing business? Allow me now to also introduce our host and main gatekeeper, Mr. Damodaran. Good morning, sir. He is the chairperson and the founder of Excellence Enablers, a former civil servant and now an independent consultant and corporate advisor, coach and mentor. Mr. Damodaran serves on the boards of several reputed companies. He has formerly served the government in various capacities and has been chairman of SEBI, IDBI, and Unit Trust of India. Ladies and gentlemen, please put your hands together one more time as we welcome our host, the main gatekeeper. Good morning, sir. And now, ladies and gentlemen, as I welcome our panelists, I'm going to request Mr. Damodaran to kindly do us the honors and present a beautiful bouquet of flowers. Up first, we welcome Mr. Debashish Panda, who is chairperson, Insurance Regulatory and Development Authority of India, IRDAI, but he will be joining us virtually this morning. He will be inaugurating the summit. A former member of the Indian Administrative Service, Mr. Panda was the Secretary, Department of Financial Services, Ministry of Finance, Government of India, from where he superannuated in January 2022. Prior thereto, he served as Joint Secretary, Health and Family Welfare, and as Additional Secretary and Special Secretary, Financial Services in the Government of India. He also served as a district magistrate in different districts in Uttar Pradesh, was Principal Secretary, Home and Vigilance, as also the CEO of Greater Noida Development Authority. Ladies and gentlemen, joining us virtually, please put your hands together, Mr. Debashish Panda. Good morning, sir.
Good morning.
Welcoming our next dignitary on the dais, Mr. M. Rajeshwar Rao has been a Deputy Governor in the Reserve Bank of India, RBI, since October 2020. Prior thereto, he served as Executive Director of RBI since 2016. A career central banker, he has previously held charge of several departments in the RBI and has also been the banking ombudsman in New Delhi. Besides stints in RBI's offices in Ahmedabad, Hyderabad, Chennai and New Delhi. Ladies and gentlemen, please join us in welcoming Mr. M. Rajeshwar Rao right here on the dais this morning. An honor, sir. Welcome. And we have a beautiful bouquet of flowers that we request Mr. Damodaran to hand over to welcome Mr. M. Rajeshwar Rao. And as we have that lovely bouquet being brought up onto stage, please let me welcome our third dignitary on the dais, Mr. Amarjit Singh, presently a whole-time member of Securities and Exchange Board of India, SEBI, has been with the Securities Market Regulator for close to 30 years. He has headed several departments in SEBI and has been instrumental in setting up the Social Stock Exchange in India. While heading the Office of International Affairs at SEBI, he dealt with issues relating to financial stability and was involved in various international regulatory initiatives. He played a leadership role in the Assessment Committee of International Organization of Securities Commission, IOSCO, from its formation in 2012 to 2018. He has represented SEBI on a number of committees constituted by the Government of India and the RBI. Ladies and gentlemen, please put your hands together for our dignitary on the dais, Mr. Amarjit Singh. And ladies and gentlemen, as we look forward to moving into this day filled with so much of knowledge exchange, I request Mr. Damodaran to make the opening remarks and welcome all our guests and speakers. Sir. Good morning.
Good morning, ladies and gentlemen. Mr. Panda, joining us virtually. Welcome. Mr. Rajeshwar Rao, Mr. Amarjit Singh, and friends in the audience. This is the 8th in-person Gatekeepers of Governance Summit that we have the privilege of hosting. When we set out on this 10 years ago, we lost 2 years due to COVID in between. We were told that this is not a sustainable proposition, that you won't be able to do this for more than a year or two, that no one is interested in corporate governance. You will not get people in the audience for such programs. No one wants to engage on subjects that do not directly impact on their lives in a very perceptible manner. And therefore, you're barking up the wrong tree. This was the essence of what several well-meaning people told us. Not that they were not well disposed towards us, well-meaning people decided to tell us that you should find something else to do. But looking at some of the faces here in the audience today, people who have come here year after year after year, and these are not people who have a lot of time at their disposal. They carve out the time to come here to signal their support to us as we continue pushing our shared agenda of improved corporate governance. And I can see several faces in the audience, people that have come here over the last 8 years. Happily, they continue to look as young as before. Maybe corporate governance is the elixir that keeps them going. I do not know. Because if I can establish a causal relationship, I would have a larger constituency outside this audience, right? But we look at different aspects of governance. The one thing that we are very clear about, both when we set out on this journey as well as now, and that hasn't changed, is that we at Excellence Enablers differentiate between compliance and governance. We believe that compliance is doing what somebody else wants you to do. Governance is doing the things that you think you should do because that is the right thing to do. And our simple explanation of governance is doing the right things at the right time, in the right manner, and for the right reasons. That's all there is to it. It's not a very complicated phenomenon. So that's the journey that we are embarked on. That is the cause that we are pushing with as much support as we can gather from people sitting here, several people outside here. A lot of sponsors who happily support us, knowing that this is a worthwhile cause. I'm sure that that money can be better invested to reflect on the numbers in the books of accounts, but they prefer to spend some money on us because they believe that in the larger interest of the ecosystem, governance is a cause that needs to be supported. And we get every year some of the best speakers that you can get. We started out with 2-day programs, then because of public demand, for want of a better word, let me put it that way, who said that by the second afternoon, governance tends to get a little weary, so we have reduced it to a day and a half, which I believe is an acceptable proposition. So we get a lot of people, good people, persons with great track records, most importantly, persons with their hearts in the right place, who come here and share their thoughts with us on occasions like this. And this year, at the inaugural session, we have put together, it's not a panel, these are 3 individual speakers, but we put together 3 speakers representing the premier regulatory organizations in the financial sector in India. With us today virtually, in spite of the great connectivity that India has, and given his very punishing travel schedule, we couldn't find a way to get Mr. Debashish Panda here. In person, we had planned that, but he's been kind enough to take time off and join us from his office in Hyderabad. Welcome to the summit. Delighted to have you with us. We have with us Mr. Rajeshwar Rao, veteran central banker, who deals with some of the most important aspects of central banking, including one that appeals to me. I have not shared this with him, which is the Regulations Review Authority that he looks after, which cleans up all the muck in the set of regulations which are past the sell-by date and sees that what we have is a set of regulations that is current. And then my young colleague from my old times, Amarjit Singh, old-time member SEBI, one of those who did the heavy lifting, certainly while I was at SEBI, continues to do it thereafter. I think the advantage of being a chairman in an organization with people like this is that a lot of the work gets done, and you stand up in places like this and accept credit whenever credit is due. So he is from that brigade. He's a whole-time member in SEBI, and one of the things again that I must mention is he's finally crafted the first social exchange in India, which is, I think, addressing what was a missing space in the area of exchanges. We wish him well with that. Now, the good thing about having 3 regulators is, and I don't intend to make a statement that might frighten any of you, that ultimately all of us have to render accounts to somebody sitting up there. So when you go to render accounts, and this I heard from a former vice chancellor, a very respected man, he said this 25 years ago. He said vice chancellors are in a privileged class because they see so much trouble in the world. So when you go up there, you are not asked the question, so have you seen hell before coming here? Because they've been vice chancellors. So I've been reflecting on this, and I think the only other constituency that qualifies to join the shorter queue where St. Peter will allow you entry into heaven without asking you these questions is a regulatory community. Because they face a lot of challenges, and we'll hear about those challenges now. But all of them are regulators. I'm hoping all of them do not look at this subject, the challenge of regulation, only through the lens of regulators, because There is a universe out there that's regulated, which has certainly some crooks, for want of a better word, but a whole lot of people who want to do business and who might get hurt because well-intentioned regulations might stand in the way of their conducting business effortlessly. That's an issue that we have to address. That's a balance that they address on a continuing basis. I won't anticipate what they're going to say. My understanding of regulation is completely past its sell-by date. I was last a regulator 16 years ago and haven't even looked in that direction thereafter. So without further ado, let me formally welcome the three of you, request Mr. Panda to speak first, address us, because this is one gentleman who has breathed life into a regulatory authority, brought in well-meaning changes, and is grappling with the prospect of bringing some more changes, but you have to overcome institutional obstacles and mindsets before you get there. We wish him luck. All yours, Mr. Panda. Take it from here. Thank you.
Namaskar. Good morning to each and every one of you. At the outset, I would like to extend my warm greetings to Mr. Damodaran, senior colleague of the service and a very distinguished civil servant. And sir, I'd like to express my gratitude for the opportunity you have given me to address this very, very distinguished audience. Ladies and gentlemen, it's a pleasure to speak before you today at the 8th Annual Corporate Governance Summit, which is very aptly titled Gatekeepers of Governance. Now, as we come together on this occasion, we are not merely convening for another corporate event, but rather for a purpose-driven dialogue, a conversation that has evolved over the past 9 years. If I look at the journey of the excellence enablers in persuading individuals and organizations, basically to uphold high standards of corporate governance, I'd say it is a commendable effort. That effort has been continuing, is still deserves more applause and comments. Appreciation from the corporate world and also from the regulatory perspective. Now, when we are in an age where business, financial institutions, and corporations wield considerable might, I think it's vital that they function responsibly and also ethically. This is precisely where corporate governance comes into play. Now, if we look at it more closely, I would say it serves as the foundation upon which organizations build their credibility, they build trust, and also sustainability. But if we ponder over this issue, what exactly is corporate governance? What is its definition? Or can we really define it? Whether it is a set of principles, or whether it is a set of practices or processes by which a company is directed and controlled, or whether it is a relationship between a company's management, its board of directors, its shareholders, and other stakeholders, or whether it is a provision of clear, accurate, and timely information to shareholders and stakeholders, whether it is a balancing force among the varied interests of diverse stakeholders, which fosters a unified commitment to the organization's objectives, or is it an agent for swift adaptation to external forces, responsive to the changing market conditions, the technological advancements, and the shifting consumer preferences? Or is it a mechanism for early detection and prevention of fraud, corruption, or mismanagement? Or is it a framework for resolving conflicts and disputes within an organization? Or whether it is a benchmark of trust, confidence, fairness, and reliability? I am sure we'll all agree that corporate governance is all of it and much more. It is the compass, the guardian, the enabler of responsible, ethical, and successful business practices. It is a framework that serves as a roadmap for the organizations in order to navigate complex and ever-evolving business landscapes. In essence, it is just not a concept, but I think it's a commitment to upholding the highest standards of integrity, transparency, and accountability in every aspect of an organization's operations. Ladies and gentlemen, over the past few years, a series of significant events has brought about profound changes in the business landscape. In fact, it has reshaped the way organizations function. The emergence of the COVID pandemic has not only underscored the importance of public health, but also heightened our awareness of the challenges that it poses. Concurrently, the escalating climate crisis has reached a tipping point, which is necessitating immediate action to address its far-reaching consequences. Moreover, there has been a notable surge in social justice movements that have captured global attention. There is an increased expectation, particularly for businesses, to actively engage with the society and uphold principles of corporate citizenship. And when it comes to the financial sector, it even becomes more pronounced. The financial sector, whether it is banking, investment, capital markets, insurance, it is a critical pillar of our economy. It is not only the lifeblood of economic growth and prosperity, but also a fundamental driver of innovation. It empowers individuals, businesses, and governments to navigate the complexities of modern finance. Now, by providing access to capital, facilitating investment, and offering protection against unforeseen setbacks, the financial sector plays a pivotal role in fostering economic stability and development. However, this tremendous influence and transformative potential also introduces a set of challenges, and that requires careful management and responsible oversight, especially given the sector's intricate interplay with global markets and the society as a whole. The financial sector's actions have far-reaching implications, and its stability is critical for the overall well-being of economies and societies. Now, to strike the right balance, the dual responsibility of protecting the interest of the stakeholders and the broader society becomes crucial. It needs to be ensured that its operations are not detrimental to its customers, society, or environment. At the same time, all while fostering an environment of innovation, investment, and economic growth. Achieving this delicate equilibrium necessitates the formulation of a regulatory framework that is simultaneously enabling and also protective. And this is where the theme of the session, the challenge of regulation, emerges. Ladies and gentlemen, today, our country, India, is at an inflection point. The resilience has shown that in the face of global winds, be it the pandemic or the geopolitical situation, is notable and praiseworthy, and we are all proud to see the consequent global optimism towards India. The CXOs of the world are convinced that it is India's century, not just a decade. India is poised for even further growth, and if it is at the cusp of its golden decade. We are the fifth largest economy, and going by the projections, we will be becoming the third largest around 2030. The growth of the Indian financial services in the last decade has been phenomenal. Major reforms like the UPI have changed the payments landscape of India, and such a gigantic payment infrastructure is just one piece of the puzzle. The JAM Trinity, the BharatNet, the direct benefit transfers, all of this have revolutionized the financial landscape and empowered citizens living even in the remotest corner of India. They are getting empowered. India Stack, Aadhaar, account aggregator framework, and more are collectively changing the face of financial services. And if I may summarize, what used to take days can now be done in seconds. India is proudly shifting from bricks to clicks with the fintech adoption rate at 87%, the highest in the world. As per a report by ASSOCHAM, India's consumer digital economy is on the roads to be $800 billion by 2030, a 10x growth from 2020. And thus, it can be said that the uniqueness of India right now is its digital public infrastructure. India is uniquely positioned to have all the three functional or the foundational DPIs, which is the identity, that is Aadhaar, the payment, which is UPI, and data, which is the account aggregator. In its India Stack, and it can lead the way in developing the playbook for global DPIs, bringing this ecosystem to the next 6 billion people of the world. All in all, India is emerging as the world's economic powerhouse, the base of which lies a robust financial ecosystem. And the strength of the financial system gets bolstered with an existence of a robust protection system and insurance being at the core of it. Ladies and gentlemen, Insurance is just not a financial transaction. It's a promise, it's a commitment, and a commitment that when an individual or a business faces unexpected challenges or adversity, they will be supported financially as well as emotionally, offering a continued sense of security. This promise underscores the immense responsibility that insurers bear, and hence the role played by effective regulations and governance in the insurance sector is paramount due to the nature of insurance contracts, promises, and assurances. The principle of corporate governance become even more critical in this sector for more reasons than one, necessitating existence of an effective regulatory architecture which should not be an impediment but rather a safeguard. A necessary framework that seeks to ensure transparency, accountability, and ethical conduct in an industry where trust is paramount. However, it is also a challenging undertaking. First and foremost, we must recognize that the world of finance and insurance is inherently complex. The ever-evolving landscape of financial products and services, coupled with rapid technological advancements, has made regulation making a formidable challenge, especially when the insurance sector is also growing at a rapid pace. The insurance sector today is 10th largest globally, and as per the projections made by Swiss Re, it will become the 6th largest by 2032. The insurance industry has an AUM of more than 60 trillion rupees and is providing employment directly and indirectly to more than 6 million people. These numbers are big, no doubt, but at the same time, these numbers can become even bigger, considering the vast population which is still tapped or inadequately tapped. We have 1/5 of the world within India. Such is the diversity that we have multiple markets within one market. These come from multiple pocket sizes and multiple preferences. Our demography is favorable with a majority of young population. The middle class is widening and disposable incomes are also rising. All of this is complemented by the burgeoning digital public infrastructure that has been created over the past 8 to 9 years. The technologies, including artificial intelligence, machine learning, blockchain, Internet of Things, telematics, are changing the way insurance is perceived and also being transacted. For example, I am very certain that there would come a time when even the need of filing claims would be eliminated. Interconnectivity over blockchain would enable to initiate instant payouts based on predefined triggers. Similarly, smart contracts may change the way banking is transacted. Algorithmic trading in capital markets may also take the front seat. As we stand on the precipice of this financial and technological evolution, it's essential for regulators to integrate these innovations into the regulatory framework. This not only means accommodating the new technologies and business models, but also creating a system that fosters innovation while safeguarding the interest of the consumers and the broader financial stability. Therefore, the biggest challenge for any regulator is to draft such regulations which can foresee, which can predict, and which can provide guidance for the events of the future. And this is only possible when we adapt to the changing scenarios, when we keep pace with the economic conditions, the industry innovations, the advancements, and remodel the framework to remain effective without stifling growth and innovation. So adopting a consultative, a participative, and a supportive approach is the way forward. When it comes to, when we talk of the consumers, I mean, particularly from the framework of the insurance, the consumer protection is something which is always at the core. And how do we, keeping those parameters in mind, how do we maintain the overall stability of the sector? Ladies and gentlemen, corporate governance stands as the linchpin in this regulatory challenge. It is that compass that guides decision making. It sets the ethical and operational standards that should be maintained, and it ensures that the interests of the policyholders, shareholders, and the public are protected at all times. When we talk about corporate governance, it's also about building an environment where decisions are made not for short-term gains, but for the long-term stability and success of the institution. It involves diverse composition of the board of directors, independent management, fostering innovation and ethical conduct, and crucially, the alignment of the executive compensation with performance. In the insurance sector, this is even more pronounced. Insurance companies are, in a sense, protectors of our future well-being. They promise security and financial support when we need it most. Therefore, corporate governance in insurance is not only a matter of compliance, but it's a matter of trust. It's about ensuring that when the time comes to make a claim, the insurer fulfills integrity and honesty. But here we cut corners or take excessive risks to achieve short-term gains, and at those times, the corporate governance emerges as an alert gatekeeper, which ensures that such temptations are resisted and the best interests of the policyholders are upheld. There is also a need for a continuous dialogue with industry stakeholders who are engaging in a feedback loop to make necessary adjustments in real time. Not only just the domestic dialogue, regulatory authorities should collaborate on international standards and harmonize regulations wherever possible, given the interconnectedness of the global financial system. This approach ensures consistency and also minimizes regulatory arbitrage. There is a need to shift from a purely punitive approach to one that emphasizes proactive supervision and risk management. Early detection and prevention of issues can be more effective and efficient than punitive measures. The power of technology should be harnessed effectively for monitoring, for reporting, and also for compliance. Now, leveraging big data analytics, artificial intelligence, and machine learning can enhance the ability to detect irregularities as well as emerging risks. But is the onus of creating an efficient regulatory and governance structure only on the regulators or the government? The answer is no. A successful governance framework can only be achieved when organizations, they view it as a strategic investment rather than just a mandatory requirement or a checklist to fill in. The institutions must respect the governance framework and consider it as an investment made with a very clear and unwavering focus on nurturing the long-term health and sustainability of the company, steering it towards a more robust and a prosperous future. Now, how can this be done? It can be done by embracing board diversity as it enriches decision-making processes and prevents groupthink. Upholding independence and accountability is essential, giving an independent board authority to question and challenge decisions. Nurturing ethical conduct sets the foundation for a morally sound culture within the organization. Aligning executive compensation packages with long-term performance objectives incentivizes sustainable success. Engaging with diverse stakeholders, incorporating their input into decision-making, and prioritizing transparent reporting. Integrating the ESG principles into the corporate strategy and practices is also paramount, as it not only ensures regulatory compliance, but also contributes to the company's enduring prosperity. Now, these principles encompass environmental sustainability, social responsibility, and strong governance, playing a vital role in building trust, reducing risk, and enhancing our long-term resilience. But we must remember, even if a regulatory or governance framework is fully adopted with genuine commitment, it won't succeed without the active engagement from the end customers or the policyholders in case of the insurance industry. In the realm of insurance, it is the engagement with policyholder which plays a pivotal role in ensuring a healthy and a trust-based ecosystem. For any insurer, the foundation of a robust corporate governance framework lies in ensuring that this active engagement occurs continuously and consistently. Insurance is a unique financial service where policyholders entrust their future financial security to insurance providers. Therefore, it is not only fair and reasonable that policyholders are aware of their rights, but are also actively involved in making informed decisions about their policies. Informed policyholders are empowered policyholders. They can make choice that best suits their needs, and they can hold insurance companies accountable for their promise. The crucial element in this equation is the corporate governance within insurance companies. One, the framework is the backbone of the responsible and ethical business practices. It is the mechanism that ensures that the interests of policyholders are at the forefront of decision making. Therefore, the board of the directors in particular plays a very crucial and a pivotal role. They must vigilantly oversee the company's operations, safeguard the policyholders' interests, and bridge any trust and confidence deficits that may exist. When policyholders actively engage in understanding their rights and responsibility, it fosters a sense of ownership and accountability. They are no longer passive customers, but informed stakeholders in the insurance process. On the other side of the equation, when insurance companies establish robust governance frameworks, they demonstrate a commitment to ethical business practices and also the well-being of the policyholders. Now, this synergy between the policyholders and insurance companies is what leads to a trust surplus rather than a deficit. It results in increased confidence in the insurance industry and ultimately leads to better policyholder retention rates. The relationship between policyholders and insurance companies thus must be symbiotic. It is not just about buying policies, it's about building trust, fostering confidence, and securing the financial future of individuals and families. So let us all actively participate in this process and create a win-win situation for everyone involved in the world of insurance. In conclusion, I would like to say that the challenge of regulation in the financial space, particularly in the insurance sector, is a multifaceted endeavor that requires active involvement of all the stakeholders. The key lies in finding perfect harmony between fostering innovation and ensuring safety, promoting responsibility and growth, and most importantly, maintaining trust and integrity at the core of financial services. By working together and embracing adaptive governance, we can navigate the evolving landscape of finance and insurance with resilience and integrity, ensuring a brighter and a more secure future for all. Thank you very much, sir. Thank you for giving me this opportunity. Namaskar.
Thank you, Mr. Panda. To say that this was a virtual tour de force would be to make an understatement. And I'm not playing on the word virtual, but the tour de force, really. To say that this was thought-provoking is also an understatement. I think we can chew on all of what you said and see how much we can digest and how much really we can hope the system will implement. And as you said rightly, at both ends of the spectrum, regulators at the one end and the beneficiaries at the other, both have to work together. It does take two hands to applaud. That's absolutely obvious. Thank you very much. I request Mr. Rajeshwar Rao to take over. You want to speak from here?
Thank you, Mr. Damodaran. Good morning, ladies and gentlemen, and distinguished guests. It's indeed a pleasure to be participating in this summit, a gathering that seeks to distill the essence of responsible stewardship in the corporate world. Keeping up with the theme of the session, that is the challenge of regulation, I thought I would reflect a bit on the dynamic landscape of regulation and regulation making, its evolving nature and the transformation which is underway in the financial sector. Mr. Panda has already set the context in terms of challenges of governance and regulation in the financial sector. I would also try to supplement that by outlining a few challenges and dilemmas encountered by the regulators in framing appropriate regulations to manage the transitions. First, let us address a critical question. Do we need regulations at all? Now, many believe that having minimal regulations is the best way to foster growth of the enterprises. But history is replete with examples of how minimal regulation coupled with lenient supervision and maybe restrained enforcements, have often led to financial crisis. In fact, we can all agree that nothing could be more damaging to sustainable growth than a misfiring banking and financial sector. While in an ideal scenario, the invisible hand would ensure that the system functions flawlessly for the greater good with minimum regulatory oversight, in reality it does not happen that way. As such, to control the irrational exuberance in the financial sector, there is a need for a regulator who sets the boundaries and rules and also enforces them for ensuring a sound and robust set of financial institutions and thereby promote financial stability. Regulations usually impose restrictions on entry and operations of the entity while controlling the what and how the business that is undertaken in the sector. This process imposes an opportunity cost on the regulated entities to achieve the desired objectives. However, these are distributable costs to deliver a collective good. Therefore, regulations ensure that the overall financial system fulfills its supportive role to the real sector through financial intermediation, and it remains stable, robust, and responsive. Moreover, financial sector and banking industry is special. The inherent ability of the banks to generate leverage and the potential for triggering a domino effect in case there is a crash makes it unique. Further, the banks are not just custodians of the customers' hard-earned money, but also the custodians of public trust. It is therefore the RBI's role as a regulator to ensure that the trust reposed by the customers and depositors on banks is resolutely upheld. Now, as we look at the challenges in the financial sector today, I think it becomes important to address the profound structural shifts that are transforming the shape of the financial sector. These transitions encompass a myriad of factors, each with its own set of unique challenges. There are also complex, multifaceted issues that demand nuanced and adaptable solutions. Let me also accept that often the pace of change outstrips the agility of the regulators. So striking a right balance between encouraging innovation and maintaining the stability and security of the financial sector is always a formidable task. Let me elaborate a few of the challenges which we are engaged with at this point in time. To begin with, let's look at the issue of climate transition. We are all aware of the global challenge that climate change poses to our planet and its impact which is being felt around the world. The transition to a more sustainable, environmentally responsible financial sector is no longer an option but an imperative. As societies demand greater commitment towards a cleaner, greener environment, the regulators must undertake the task of integrating climate risks into the regulatory frameworks. Ensuring that the financial institutions consider the environmental impact of their actions while simultaneously managing the flow of credit demands a delicate balancing act and requires collaborative solutions. The moot question which the regulators have to deliberate on is whether the climate risk is a unique risk that needs to be captured separately and thus requires a separate framework on a standalone basis, or whether it transverses across the credit market and operational risks and can be captured as a part of the existing risk management frameworks. Another point of debate is whether the risks need to be captured as a combination of Pillar 2, that is the supervisory review, or Pillar 3, market discipline and disclosures requirements specified under the Basel norms, or is it better to capture the risk as a part of Pillar 1, which is the capital and liquidity standards set forth under the Basel norms. A second challenge which we confront today is the technology transition. Technology is reshaping the landscape of finance at an unprecedented pace and has emerged as a transformative force, reshaping operations and customer experiences alike. Digitalization is helping to enlarge the options available to the customers and to the lenders, increase efficiency and competition in the provision of financial services, and more importantly, making these services available to a larger segment of the population. As we embrace the technological advancements, it is imperative that the regulatory frameworks evolve in tandem to ensure that the security, privacy, and integrity of the financial system. In an era defined by data, the protection of personal and financial information has come to the fore. In India, the Union government has recently passed the Digital Protection Data Act. This type of legislation is necessary for safeguarding individuals' rights and ensuring responsible handling of personal data. Banks and other financial institutions, as custodians of the vast volumes of sensitive customer data, must undertake required efforts to adhere to the provisions of the Act and the related regulations. To manage this transition smoothly, the financial institutions must invest in robust data governance frameworks, ensure that they and their data processors collect, process and store data in complete adherence to the laws and the regulations. Managing the transition to a more data-conscious and data-cultured institution necessitates treading a very delicate path. The digital intermediation transition is another challenge, which I think even Mr. Panda did mention that. Post the pandemic, digital lending and emergence of digital platforms providing loans has seen an exponential rise in the various economies, including India. While this has led to increase in the scale and velocity of credit in an increasingly digital environment, it has raised a host of business conduct issues. The question for any regulator to consider is whether they should try to be ahead of the curve to ensure that the financial innovations are enabled only after putting in place an appropriate regulatory and supervisory framework, or to follow a more relaxed approach of allowing the markets to develop on their own. By being more accommodating, does the regulator then run the risk of having to deal with unanticipated business conduct concerns, or in extreme cases, confront and deal with potential events that could trigger systemic risks, which may lead to outcomes that are more difficult to anticipate and manage? There are no easy answers on this debate. Nonetheless, for a regulator, inaction can never be an option. The pace with which the newer business models, players and products are coming up, with such entities often exploiting the gaps in the existing regulations or conducting business operations that fall in a regulatory gray area, continues to be a challenge. The business models that are built to challenge the regulatory perimeters, aggressive marketing strategies, and engagement in exploiting the customers makes it clear that such issues do need regulatory intervention. But the dilemma then resides in deciding the extent of regulatory intervention that will contain and restrict the customer abuse without significantly altering the nature of the fintech-driven innovation. For example, at the beginning of 2020, the lending activities of the new technology-driven platforms involved small-ticket loans granted to a large number of borrowers, mostly falling in the lower income strata of the society, such as students, retail businesses, gig workers, etc. For these borrowers, taking a loan at an exorbitant interest rate meant falling into a vicious debt trap. What made the situation worse was the fact that the borrowers were not even aware of such high interest rates or the charges before taking the loan, as these were not disclosed upfront. There was no interface except the mobile app to raise their grievances, and the recovery practices were harsh and unorthodox. We had also observed that right from the credit underwriting to recovery, every activity was being outsourced with scant regard to customer privacy and protection. Digital lending was operating on rent and regulated entity model, where the fintech platforms were undertaking all the lending activities on behalf of the regulated entity by posing itself as a principal. In many cases, the customers were not even aware of the name of the bank or NBFC which had sanctioned the loan. To tackle this issue, the regulatory stance has converged on regulating the digital lending activity and arrangements between the regulated entities and fintechs, which are providing specific services to the regulated entities. These have been since renamed as lending service providers. RBI's digital lending regulations have laid down a broad regulatory framework under which the fintechs can become enabling partners with the regulated entities. These guidelines are a mix of reiteration of the extant guidelines like reporting to the credit information companies, conducting due diligence before engaging the loan service providers, and some fresh ones, with the regulated entities being the fulcrum around which digital lending entities are required to operate, with regulatory compliance being made their responsibility. The social media transition is another dimension which we need to confront with at this point. Social media has revolutionized the speed and scope of dissemination of information. Information sharing has never been so quick and unhindered as at this point in time. But this also means that unsubstantiated rumors and false news can also spread equally quickly and can adversely affect financial institutions, especially the banks. The recent banking turmoil in USA has jolted some of the widely held beliefs regarding the principles of liquidity management and the nature and speed of bank runs. The banking turmoil in the United States and Europe in early March 23 has had a significant impact on the global financial system. This episode has highlighted a need for reassessment of the global standards in the financial sector regulations. The episode has offered two important lessons. First, trust is vulnerable to perceptions of weakness and misinformed social media commentary. Second is that in the age of social media and internet banking, the speed with which the bank runs occur is unprecedented, and therefore the response time to handle such crises has telescoped to a fraction of what was hitherto considered available to the regulators and supervisors. To address these challenges, constant and effective supervision, complemented by the ability of the bank concerned to monitor and prevent spread of misinformation over social media, has become vital. Now, how is RBI as a regulator managing these transitions? Our approach has been to foster and support innovations and dynamism while balancing it with financial stability considerations. Therefore, in managing these transitions, the pertinent question that we are asking ourselves is, are we doing enough? And more importantly, are we ahead of the curve? Let me elaborate on what we are doing to manage these transitions. The first, of course, has been to simplify the regulations. The regulatory instructions have evolved over a period of time in consonance with the developmental trajectory of the financial system and institutions. The regulatory perimeter has also expanded as the Indian financial system has ventured into newer business models, product lines, and geographical territories. Over time, this may have led to certain regulations becoming complex with concomitant increase in the compliance burden. Therefore, a periodic stocktake is useful to review the regulatory instructions and compliance procedures with a view to streamlining and rationalizing them and making them more effective. RBI had therefore set up the Regulation Review Authority 2 in 2021. This followed the original RRA set up in 1999 under the aegis of Dr. Y.V. Reddy. I was privileged to work as one of his special assistants, so this became a natural recommendation as soon as I took over as Deputy Governor. I thought it was very, very relevant exercise at that point in time. It had not been done for about 20 years, so we thought it should be taken up immediately. And this became a kind of a template where we tried to address some of the superfluous, unwanted, or irrelevant regulations and try to withdraw them over a period of 1 year. And future is, in my view, the regulations must be responsive to the evolving need of the financial system, and for this, we need to adopt a 5-pillar strategy. First, we have to make sure that the future regulations are forward-looking and proactive. Second, we have to be nimble in our approach. This is critical as the pace of change has accelerated. Third, our approach to regulation making has to be more data-driven and impact assessment oriented. This in turn leads to a more analytical decision-making process. There is also a need for provision for a suitable path of transition wherever warranted. Fourth, we need a consultative process to regulation making. Prior consultation with the stakeholders enables us to get a diverse viewpoint and incorporate their views into the regulation. This makes the implementation of the regulations that much better. Fifth and the last pillar is collaboration. We have to engage more and more with the stakeholders, governments, and other regulators and industry to evolve a safe and resilient financial sector. Reserve Bank has been conferred upon powers to make subordinate legislation under a wide spectrum of statutes. This casts a responsibility on RBI to ensure that these instructions are within the perimeter set by the statutory mandate. are clear in language and appropriate and proportional. Therefore, we have increased our focus on providing suitable training and skilling to our officers so that regulations can be written in simple language and there is much better clarity regarding the regulatory intent. In this whole scheme of things, the customer should and must remain the focal point. The two primary objectives of regulation, that is ensuring financial stability and protecting customer interests, leads to two broad categories of regulations: prudential regulations and conduct regulations. The prudential regulation builds the foundation for financial stability, while conduct regulation lays the ethical foundation for maintaining customer trust. Together, both help in safeguarding the integrity of the financial system. It is often said that the conduct regulations protect the customer from the lender and the prudential regulations protect the lender from the customer. Accordingly, our endeavor has been to inculcate responsible conduct on part of the regulated entities. We have asked the banks to design suitability and performance requirements for financial products and financial services, keeping in mind the interests of its customers. This includes board-level oversight arrangements that a bank must put in place in order to meet these objectives. As we further strengthen our approach towards addressing the concerns in this area of conduct-based regulations, the guiding philosophy would be to set certain minimum regulatory expectations with the option for entities to adopt higher standards depending on their size, proportionality, and the customer focus. The ultimate message is that the regulated entities should treat all customers, big or small, urban or rural, educated or less educated, in a transparent and ethical manner. There is also an ongoing debate on whether a principle-based regulation is preferable or whether the rule-based approach to regulation is the better option. At different points in time, one approach has influenced the minds of the policymakers more than the other. The benefit of rules-based regulation is that they provide certainty and firm guidance on what the regulated entities are required to do. And from the regulator's point of view, the measurable and explainable regulatory targets and responsibilities that can be easily monitored and enforced. But in a prescriptive approach to regulation, the regulations might end up becoming more important than the intended outcome for which they were designed, leading to a culture of box ticking of compliance. In contrast, principle-based regulation is like a compass, providing regulated entities with a general guidance to the direction in which they should head, without specifying the precise route which should be taken. The principles are crafted to be suitable for a wide array of situations and emphasize on the desired outcomes. They grant regulated entities flexibility to adapt to the evolving circumstances and to innovate. However, it also requires them to exercise prudent judgment and make responsible decisions. But often, to make regulatory expectations clear, principle-based regulations are required to be supplemented with clarifications, illustrations, and guidance notes. So where do we stand on this continuum of rule-based and principle-based regulatory approach? In RBI, as a matter of policy, we have been gradually giving banks more operational freedom to conduct business operations within the overarching regulatory framework. So we are moving at a good pace towards making our regulations increasingly principle-based. It is important at the same time to maintain a level playing field. A level playing field ensures that all participants, regardless of their size or type, operate within a fair and consistent regulatory framework where the potential risks and rewards of the financial system are evenly balanced. There is a widespread agreement that a level playing field is a key condition for a competitive financial sector. As a regulator, we are following the principle of same activity, same risk, same regulation. This approach can be seen in the case of our guidelines on digital lending, on the first loss default guarantee, or the activity-based approach to the microfinance sector. However, maintaining a level playing field has to be counterbalanced by ensuring that the regulators are aware of ensuring that the regulations are proportionate to the risks posed by the firm to the system. We are quite mindful of the need to ensure that the regulatory burden on an entity should be proportionate to the risks posed on it by the financial system and the size and scale of its operations. This thought has underscored our revised scale-based regulatory approach to NBFCs and the revised regulatory framework for the urban cooperative banks. It must also, however, be appreciated that limiting the potential for regulatory arbitrage and establishing a level playing field for market participants is an important objective for regulators, but it is not an overriding objective. To ensure that the efficient market functioning and more broadly to safeguard the public interest, policymakers may at times need to treat different players differently, even if it affects their relative competitive position. Now, before I conclude, a few thoughts. See, as we increase the tribe of regulators with the increasing remit across various sectors, I think what is important is this entire approach to body of, needs to be a greater study and understanding of the approach, theoretical approach for regulations, what kind of regulation is preferred under what circumstance, maybe, and also there is a need for increasing the training of many of the regulators, because regulation making is now requiring to be a fine art. I mean, it should be far-sighted or foresighted. It needs proper drafting to cover most of the situations. So better quality of regulation making can only be helped with better training and skilling of the staff who are engaged in regulation making. And I do not mean to confine myself to just RBI. I think this is a requirement across all the regulators, not just in the financial sector, but perhaps in all sectors. So I think maybe there is time that we should look at the theoretical framework for regulation making and training for regulation making a very critical aspect, which should be, incorporated by the regulators, and maybe there is a need for a training institute to look at this issue, but those are just a few stray thoughts from my side. But, well, let me conclude at this stage by saying that the challenge of regulation in today's dynamic and interconnected world is undeniable, but it is a challenge that we are fully committed to overcoming. We recognize the ever-evolving nature of financial markets, technological advancements, and global economic shifts. As a regulator, our most important contribution to the society is that we do our job by making forward-looking, risk-based and proportionate regulations and implement them in a consistent manner. At the same time, we need to be conscious that the process of regulation making must yield a net surplus to the financial system. Even as we move forward on these lines, we need to remain steadfast in our dedication to maintaining stability, fostering growth, while also safeguarding the interests of the customers. I will conclude with that. Thank you very much.
Thanks a lot. Thank you, Mr. Rajeshwar Rao, for those extremely insightful observations that have contemporary relevance. And some of the points that you made are based on eternal value systems that technology cannot tamper with. But you also touched on the challenges of technology, the challenge that social media poses, the problem that speed brings in its wake. Speed of transmission also brings problems. And I was reminded, even as you spoke, of the major challenge that people like you have. Somebody said that you got to foster growth and you got to rein in inflation. It's like riding two horses facing in opposite directions at the same time. And this was in the simpler days when you only had dilemmas. Now we have trilemmas and God knows what else. So how many horses you will ride at the same time, I don't know. Extremely insightful. Your 5 principles, the pillars as you called it, are very, very useful going forward. May I venture to suggest one more, which is that all regulations, and not just banking, securities, markets, insurance, whatever, all regulations should have a sunset clause, so that you examine the relevance of the regulation 5 years down the line and see whether it remains to be on your statute book. Otherwise, we will continue to need regulation review authorities going forward. That's a thought I'll leave with you.
Yes.
Mr. Amarjit Singh will tell us what is happening to our markets. And he's only responsible for orderly conduct of the marketplace, not the levels at which the Nifty or the Sensex is.
Am I audible? audible? Yeah. So, Mr. Damodharan, yeah. So, Mr. Damodharan, Mr. Rao, Mr. Bhatia, my fellow WTM, my fellow colleagues from SEBI, ladies and gentlemen, it's a pleasure to be here. In fact, I've been attending this conference for several years, but I'm used to sitting more with you guys than, this is the first time Mr. Damodharan has asked me to speak, and thanks for the opportunity, sir. So I've had the, privilege of working with Mr. Damodharan very closely when he was SEBI chairman. And if I can just digress away from the subject just for a minute. So I used to be in Delhi office. I used to head the Delhi office of SEBI, and he would often come there. And he was invited for many speeches, many events. So I always made it a point to go with him to those events. And it was so amazing for me. This is like 15, 20 years back I'm talking about. He would very casually chit-chat with you in the car. Okay, what do you think of this subject? What is happening? Very relaxed. And at best, he would not carry any notes with him. At best, there would be some old torn envelope, and on the back of that, he would have scribbled some bullet points, and he'll deliver a fantastic keynote speech, which, you could just publish it as he spoke. So, sir, I feel rather diffident, actually, if I can say, speaking in your presence, and also, especially you are the stalwart of corporate governance. So, but thank you very much for inviting me, and let me now share my thoughts with you on the subject. Let me also mention that, when I was not going with him for various events, we would be sitting in our guest house or in our office, and we had a very free flow exchange of thoughts and a lot of discussion on markets and regulation, and also, of course, soccer and cricket, sir, if I can mention that. So it was an amazing time, and I miss those times. This opening session's topic for this conference, the challenge of regulation, and asking the regulators to reflect on that, I think it could have come only from the stable of his out-of-box ideas, if I can say. And if I can say in the lighter vein, when I was thinking about this topic, I felt certainly challenged. The topic is quite evocative, and it stirred few images in my mind. Imagine, you ask a famous music composer to carefully listen to her composition and identify what seems to be the pieces of dissonance to the audience, or asking a renowned artist to closely look at her painting and identify the unexplained elements, some areas which look somewhat dark or not so beautiful in her work. So in some sense, the topic pushes us, the regulators, to the mirror. And let me now share with you what I see in the mirror. What I see looks like a moving kaleidoscope, but some images very clearly stand out. And I'll share with you 3 images which I perceive very strongly in the mirror. So the first image is that of a trapeze artist. The very first one, trapeze artist who's walking on a thin rope and balancing the 3 ends, or the trinity of development, regulation, and investor protection. And trust me, it's not an easy walk. We do it every day. We are faced with a wide variety of market participants with varying sizes and expectations, moving external environment, and constantly changing risks and behaviors of market participants in the market. Regulation, as was said by the previous speakers also, should ideally be a vehicle for progress, and not an obstacle. When regulations are too prescriptive or too cautious, they run the risk of placing undue costs and stifling innovation. At the same time, when regulation is lax or behind the curve, it can facilitate risk-taking. It can lead to a race to the bottom that puts investors, businesses, and economy at risk. And I'm tempted to share some of the events of the last 25 years, both at the global level and also back home, just to illustrate the point I'm trying to make. So some important, and I'll name entities because they're all well known, so it's all been documented, there's nothing secret about it. So some important global mileposts include dot-com burst in US in early 2000s, followed by collapse of Enron and several other big corporates. We are all aware about global financial crisis in 2008-9, a turning point in the history of finance. Bernie Madoff scandal, though it happened in US, but it had a ripple effect all over. I mean, it was a wake-up call for regulators in many ways. The collapse of the LIBOR crisis in 2011, again, which led to a lot of reflection on the part of regulators to review how they should strategize their enforcements. The collapse of 1MDB in 2018, the Malaysian Sovereign Wealth Fund, and sir, we thought we could trust the sovereign wealth funds. They were taken for granted, but even that collapsed. Then there was an accounting scandal at Wirecard and so on. More recently, as was pointed out by Mr. Rao, there are reports that one of the reasons for the failure of the Silicon Valley Bank was the rollback of certain provisions of the Dodd-Frank Act, which led to lenient supervision and lower capital requirements for the bank. And I think Mr. Rao very rightly pointed out the need for more effective supervision. Back home, unfortunately, we've been having our fair share of negative corporate episodes. I'll avoid taking names here. First in the list being a fraud at a well-known software company. That was our Enron movement 15 odd years back. A big private sector bank, a big infra company with more than 300 subsidiaries. A big private sector bank whose promoter is, yes, in lockup. A gems and jewelry company whose promoter fled the country. A famous healthcare company whose promoters were sent to jail. An engineering conglomerate in the power sector which sacked its chairman and CFO. So the list goes on. So what are the lessons here? Why am I quoting all this? Financial misconduct and frauds in the absence of adequate regulation is a recurring pattern in history, and I've given you enough examples, showing that the principles of self-regulation or the belief that the market will take care of itself, that doesn't really work well. So there are no simplistic trade-offs between regulation and growth. In fact, too little regulation can lead to decline in trust of stakeholders and adversely impact growth. On the other hand, adequate financial regulation helps create a high trust environment, increases attractiveness for investors, and thus promotes economic growth. While what is adequate regulation, what is right regulation, it can be debated, it is debatable. But I am quite convinced that the right regulation is definitely not deregulation. Let me now turn to the mirror again and look at my second image. So the first image I just described. And I see the trapeze artist morphing into a consultative reformer who is often misunderstood. Active consultation is key to our work. We are not sitting in an ivory tower. We actively engage with all stakeholders, feedback on policy proposals from our advisory committees, working groups, is regularly taken, which includes members from the industry. Key proposals are also placed for public consultation. So we have one little issue here that, you know, when we come out with our consultation papers, we don't get enough feedback. And oftentimes industry raises objections to a proposal which is already notified. So it would definitely help if we heard about the concerns and issues before it gets notified as a regulation. We are committed to facilitating simplified processes, bringing clarity to minimize the risk of inadvertent non-compliance and removing unnecessary burdens. And we did some quick study of the number of circulars that we've issued in the last 1 year, period September 22 to August 2023. So SEBI has issued 167 circulars. Of these, 44% are developmental and towards ease of doing business, while 48% are towards investor protection and risk management. And the remaining around 8% are towards extensions of timelines and others. Further in tune with our consultative approach, we have recently constituted 16 working groups. These working groups have been tasked with giving their recommendations how to simplify the regulations, how to improve ease of doing business, how to reduce the cost of compliance and so on. So one of the working groups is reviewing regulations like LODR, ICDR, delisting, buyback, etc. from the perspective of ease of doing business. It is also considering harmonization of LODR and ICDR to ease the process of fundraising and also ease the compliance post-listing. So we have invited suggestions from public and the regulated entities, which will be considered by the working groups. The deadline is November 6, 2023, and I would urge all those who are interested to send your recommendations. So just another point before I move to my third image, we've also initiated the idea of Industry Standards Forum, which is being done very actively in collaboration with industry. Objective is that let such fora formulate standards for implementation of specific regulations and circulars in consultation with SEBI. So to begin with, as pilot projects, dedicated working groups have been set up to formulate standards for effective implementation of 3 areas. One is humor verification, and then the disclosures of material events, BRSR core, and structured digital database requirement under PIT regulations. Let me move back to the mirror again for my third image, and the third image which I see is that of a prime mover. So regulatory reform is also about innovating within the regulatory framework to keep pace with technological and other changes. As a regulator, we have been taking the lead in leveraging technology to introduce new processes in our market. So my sense is, sir, that regulators in India have front-led a lot of regulation, a lot of innovation, especially in the financial markets. So introduction of T+1 settlement, use of UPI with facility of blocking funds as a new payment mechanism, which is facilitating reduction in listing timeline from T+6 to T+3, use of eKYC, ASPA in secondary markets, introduction of pledge-repledge mechanisms are some examples which have made our market safer and more efficient. In the coming years, the increasing penetration of our securities market, accompanied with the growth of our economy, sets the stage for greater corporate governance dialogue. I think this is one subject which has always remained in the limelight for very good reasons, and I don't see that going away as the Indian economy grows at a fast pace. Also, some of the trends which are well known, but just to sort of make the mention nonetheless: hyper digitalization of economy, acceleration of artificial intelligence, ESG issues, stakeholders primacy, stewardship, shareholder activism, data privacy, digital and social media, increasing importance of human and intellectual capital over financial capital. These are impacting businesses and reshaping the landscape of corporate governance as well. We will continue to keep a tab on these developments and come up with the appropriate regulatory response in the coming years. To wrap up, I am mindful that the three images that I reflected upon, that of a trapeze artist and a consultative reformer and a prime mover, they may not completely resonate with everyone. Everybody has his own lens. So particularly the regulated entities, some of them, hopefully not all, may see regulators as villains of the piece who are good at spoiling parties. It may sound cliched, but regulation are often convenient scapegoat and can be blamed for worsening economic conditions in bad times and for hampering growth in good times. So it is good times, bad times, doesn't really matter. So there is also the problem of selective bias, if I can say, and this I'm saying out of my experience. People just like to pick one element which is not suiting them well, and just, there's selective bias around that, and they just pick it up, and that becomes a very popular discourse, and it reinforces that negative perception and that negative narrative and obscures the merits and positive impact of 100 other policies. Out of 100, you just pick one and 99 get nullified. And as Mr. Rao also mentioned, the social media, it further complicates the matters. It just blows the negative discourse out of proportion. So, so we really do not think about, well-functioning markets. We do not think about safety of transactions. I'm talking in the securities market context here. We do not talk about the great levels of transparency that you have in the system. They are just taken for granted. They are noticed only when something goes wrong. So regulation aims to promote good and reduce bad. Very simple. It seeks to protect people from harm. It seeks to prevent or reduce the costs of economic disasters. It facilitates innovation and competition, thus seeking to deliver better outcomes to the society and economy. Of course, regulations may have compliance costs. Of course, you will need to adjust in the short run to the new requirements. But costs are warranted, may be warranted, if the regulations will produce even larger economic benefit for the entity and for the economy as a whole. Medical insurance also costs money, but we do take medical insurance for its benefits. Till such time, compliance and governance become a greater part of companies' DNA, we will continue to hear, if I can say, somewhat misplaced noise about high cost of compliance, the complexity of laws, and so on. Am I here just to do compliance when I do the business, and so on? So that sort of noise we'll continue to hear. But thankfully, there are companies today that see value in investing more in good corporate governance and disclosure practices. I hope, as a regulator, to see more and more companies joining this track. That will perhaps make the life of regulators like us little easy. Thank you.
Thank you, Amarjit. Even as you were winding up, I was thinking of a regulator from a neighboring country with which we do not have great relationships, not on the regulatory front, but on the political front. He and I were chatting some time ago. He said, when the index goes up, nobody knows about the existence of a regulator. When the index comes down, they know his residential address and telephone number. Right? It's not an easy place to be in. Kabir anticipated it when he said, "Dukh mein sumiran sab kare."
Yes.
So, in some sense, regulators have a price to pay because they're regulators. I was thinking of your first image, of the trapeze artist, and you are a trapeze artist without a safety net below. Even circuses have a safety net for trapeze artists when they fall. And my last comment, in a lighter vein, don't take it amiss, is you said something like 160 circulars. I have a belief that the more circulars you issue, the more your regulated universe will go around in circles. So just keep that thought in mind.
What's the developmental part? So there were a lot of developmental circulars. So just to define my term. So.
Thank you so much, gentlemen. Ladies and gentlemen, the takeaways have begun. Please put your hands together as we want to thank all our dignitaries on the dais. And we've got a beautiful memento that's being brought on. Can we please have, ladies and gentlemen, let me draw your attention to these caricatures that is going to be presented to each one of our dignitaries on the dais. They have been created right now, right here this morning, and along with that, a certificate for planting 10 trees in the Sundarbans in their name. So this is really special. Ladies and gentlemen, for Mr. Rao, thank you so much, sir. Mr. Singh. And for joining us virtually this morning, Mr. Panda. Ladies and gentlemen, a group photograph right now, I think it's just right. For setting the tone for the way the discussions will flow over the next 2 days. Ladies and gentlemen, the inaugural session. Thank you very, very much, gentlemen, for joining us on stage this morning. Well, after the challenge of regulation, the inaugural session right there, we're going to be moving right now, ladies and gentlemen, into a very short stretch break. We have time for a cup of tea or coffee, but let me share with you that there will be a continuous flow of tea or coffee in the pre-function area. So we're going to give you just 10 minutes to pick up your cup and come on back in, because the next session begins in the next 10 minutes. Please help us be on time. We've got a really special packed day in front of us. Welcome back. The next session is on are professional-led companies professionally managed? There has been a belief that companies led by professionals are necessarily professionally managed. Some events in the past few years have given the lie to that presumption. So the question now being asked is whether having a professional at the helm necessarily translates to the company being managed professionally. Ladies and gentlemen, it is my privilege now to introduce our panelists to you. We welcome our first panelist, Mr. Atanu Chakraborty. Please put your hands together as he joins us. He has been the chairperson of HDFC Bank since April 2021. In a long career in the Indian Administrative Service, he has worked in the areas of finance and economic policy, infrastructure, petroleum and natural gas. He was secretary to the Government of India in the Ministry of Finance, Department of Economic Affairs. He also served as secretary in the Department of Investment and Public Asset Management, where he led disinvestment proceedings in 2018-19, fetching the government 80,000 crore rupees. He has also served as the Director General of Hydrocarbons and the Managing Director of the Gujarat State Petroleum Corporation and the Gujarat State Financial Services. He served on the Central Board of Directors of the RBI. Ladies and gentlemen, please put your hands together for Mr. Atanu Chakraborty. Also looking forward to our next panelist, Mr. Subodh Bhargava, who's the Chairman Emeritus of the Aisha Group of Companies. A loud round of applause, please. He has the distinction of being one of the early non-promoter chairs of a corporate entity. He is also the former non-executive chairman of Tata Communications and Vatsala Limited. He is the chairperson of the Global Risk Management Institute. He has been a director on the boards of several large companies. He is a former president of the Confederation of Indian Industries, CII, a former president of the Association of Indian Automobile Manufacturers, and a former vice president of the Tractor Manufacturers Association. He has been closely associated with central and state government bodies and committees, as also with various IIMs, IITs, and other management and technical institutions. He was chairman of Board of Governors of IIT Mandi. Ladies and gentlemen, please put your hands together, Mr. Subodh Bhargava. Ladies and gentlemen, joining our panelists on stage, we welcome Mr. Sanjeev Aga. He has had an illustrious career in the corporate world, holding leadership positions in a number of entities. He was the managing director of Idea Cellular in its breakout years and stepped down in 2011. He has also been managing director of Blowplast and Aditya Birla Nuvo. He is on the boards of several reputed corporates and not-for-profits and engages in advisory work. He has experience in consumer and services, entertainment and light engineering and telecommunications sectors. Ladies and gentlemen, join me in welcoming onto stage right now Mr. Sanjeev Aga, our third panelist and also our moderator for this session. A loud round of applause, please. Welcome, sir. Good morning.
Good morning, ladies and gentlemen. As the lady mentioned, the topic being are professional-led companies professionally managed. Now, if you go by English language, if a professional is leading it, it is by definition professionally managed. But if you flip the question, the same question, the reverse would be that are professional-led companies unprofessionally managed? And the question here is one of proportion. I'll take about 5 or 6 minutes, and then my co-panelists would also like to share their thoughts, and then we'll open it up for questions and answers. And it is quite possible that our thoughts may be quite divergent, and we may even like to quiz each other or interrogate each other, which is all fine. The first thing is that I'm really glad Mr. Damodaran has put the spotlight in an early session on professionals. For too long, when we discuss and debate what is happening in society in our country, the focus is either on politicians or the focus is on promoters or the capitalists. But their numbers are numerically negligible. They can do nothing without the large professional class, whether it is the managerial class or the officer class or accountants or what have you. And it is my thesis that the state of affairs in the company, good or bad, is determined by the professional class, which is overwhelmingly large in numbers and without which nothing can happen. And therefore I would urge, not so much from a regulation point of view, but from a societal pressure point of view, that this spotlight on how the professional managers or professional leaders are doing their job for the country should come back into top focus. Now, normatively, a professional manager is someone who is selected because of their skill sets and the capabilities they bring to bear. Normatively, it is expected that although they have a finite term, their thinking horizon is long term for the good of the company, and even though they are not proprietors, their mindset is proprietorial. They do what is best for the company's long-term interest. They set a moral compass for the entire set of people and the ecosystem they lead. And if I may add, they are quite aware that they should not be perpetuating themselves, but perpetuating the organization. Now, if one looks at India over the years, over the decades since independence, particularly in the 1950s, particularly I say so because it was unexpected. In the 1950s, we had stalwart professionals who led the company for a pittance. When one thinks of the people who have built the institutions, the companies, their salaries were a pittance. For them it was a labor of love, and they have left enduring legacies which have carried the country forward for years. Now, there are so many examples that I won't name them in the public sector, in the public institutions, but even in the private sector. Before I started working, I had heard of Mr. Prakash Tandon, the first Indian chairperson of Hindustan Lever, and when his term came to an end, I'm told that he just gave in the keys of his company car, he got into his black Fiat Premier Padmini car and drove home, to his home. Now these kinds of examples, these kinds of anecdotes, they become part of folklore, they become part of myths, and they shape the ethos of a company for successive generations. So we have outstanding examples where, professionally led companies have been more than professionally managed, and this continues till today. But I would dare say that perhaps the number of professionals who behave more unprofessionally than professionally is greater than the number of professionals who behave as professionally as possible. I mean, no one is capable of being, completely, upright in any society. but I'm talking of proportions. And here there is a very funny phenomenon. You know, just last week, I met a gentleman, younger to me, and he confessed to me, or he rather, I won't use the word confess, but he related to me that, look, why am I doing for someone else what I would never imagine I will do for myself? And it is not just the risks associated with doing the wrong thing or an illegal thing. It is the, what should I call it? It is the conscience, or it is the degradation, the lack of self-respect what it leads to. When you become old and look back on your life as to what you've done, this is what I've done. So this is a very funny question. He said that, you know, in his own personal life, he may be God-fearing, put all the tikas, this and that. He would behave completely financially, in other terms, in terms of speaking the truth for himself, his family, his children, uphold the highest standards. But when they get to work, there is a different personality. This is not a personality which is being pushed or pressured. In fact, there are people, and I have known them, obviously I can't name them, who compete to come up with ideas and suggest them to their masters. The master could be a politician, the master could be a capitalist, and for no gain to themselves, no financial gain. But this is a peculiar Indian phenomenon, that you have one standard for yourself, you seek no gain, but when you are in a corporation or when you are in an office, there's a completely different, it's a Dr. Jekyll and Mr. Hyde kind of phenomenon. So, I'm here talking that of people, I can understand when you are under pressure. And under pressure, the majority of us are not equipped to take, and we will wilt to some degree. Some people capitulate, some people put up a little resistance, some people play with the straight bat. But here I'm talking a phenomena where you go overboard, there is no pressure on you, but you start behaving in a very funny manner. And perhaps that is why the Britishers in the 19th century, with a couple of thousand people, could rule over a nation then of 30 crores or 25 crores or whatever the popular was. You know, there is a Marxist term which I won't get into because it's not exactly the same thing. It is called comprador class. So anyway, the point I'm trying to make, and what is the remedy to it, I don't want to go on because I would like, I have some thoughts, but I'll reserve them from now. But I just wanted to provoke people into making 2 points. One is that India's governance and professional management across public or private sector will improve not based on what the politicians do or the capitalists do, but what the professional class does. That is going to shape. And I don't think the answer to that is more and more regulation. There are different answers, and it will be a very slow process, but I just deliberately wanted to toss this idea, and I would like, may I request Mr. Atanu Chakravarti to please share his thoughts, after that Subodh, and please come here. I'm through for now.
Thank you, Sanjeev. You have already provoked, in many cases, extremely thought-provoking piece on which it's very difficult to not to step into saying something which is not controversial. So I'll not get away from not saying something which is not controversial without offending anyone. Just to set a context for myself, general ownership, I'll limit myself to companies. I'll limit myself to companies which are commercially run. Sanjeev has taken a much broader canvas, and very rightly so. He's taken up the entire society from where, which is very germane to the kind of behavior which he has very rightly and very correctly mentioned that people start behaving in a certain fashion when they are not even prodded to do so. Incentive mechanisms, frankly, don't work there. However, general ownership, if we largely divide across the world, actually, it's between government and private. Within the private realm, you will have closely held or widely held companies. And also the institutional holding has become another piece. This institutional holding could be banks, private equity funds, VCs, and so on and so forth. So I'm deliberately putting down an ownership structure to really get down to that middle layer. And they would always buy labor, and labor is naturally, first set is the managerial class, and that's what we are referring to, that over a period of time when the organization have grown, typically Webranian style, when the roles have been divided, the managerial or the officer class was born. And similarly, when the organizations are set up, they grow, always the major shareholders, owners, or if it's widely held, large number of owners possibly cannot run the company, so they hand it over to a professional. Sometimes it's professionally run, professionally managed, professionally led. However, here we are referring specifically to, as Sanjeev has mentioned, that somebody who is actually leading the organization, reporting to a board. The board could be consisting of the owners and the rest of the set. It could be widely held, as I had mentioned before. What are the various, we are supposed to think that that kind of a thing would be panacea for all ills, because professional-led company, they will bring in right kind of behavior pattern and take away from the typical Marxian issues which came up with respect to too much of the strong ownership of capital, which tends to bring in the kind of issues which come in running of a society or running of an organization. However, you find the same issue perpetuating and people capitulating to the similar kind of greed, making the similar kind of mistakes which were made if they were being run by a family-run organization. In the morning, I was talking to a gentleman and talking about this issue. He referred to me something very interesting statistics, that 50% of the world market cap is still delivered by family-run organizations because they have a strategic focus. So somewhere, possibly, the widely held corporations or, if you may say so, the professionally led organizations have not delivered as much as they ought to have delivered in an ideal world. 2008, if I take certain milestone, and for India, 2013, the Company Act on the corporate governance really brought large amount of changes. However, we are repeating the same mistakes. Silicon Valley Bank collapsed recently, and very similar things which have happened. Mr. Amarjit Singh recounted quite a few of them, so I'll not go over the same list again. Do show that the same symptoms do tend to appear with unfailing regularity to an extent that you can predict them. Why do they tend to happen? Because we have a prescription that we have separated ownership also from running the organization. We have boards, we have regulators, we have professionals running the organization. But still, the problems keep coming up. Let me state that my bias is more towards a kind of a setup where the professional is given more powers, as they say that let him run the company, let the boards keep off, keep to the policy, keep to the strategy, and keep generally as a peeping Tom kind of a view on the manner in which things go. But again, as I have seen, that simplistic formulation has not really held water. And it collapses time and again. And corporate world, again, I'll not name, has seen professional managers who have become prima donnas, to say the least. They have perpetuated coteries. They have perpetuated their own existence. They have taken salaries, incentives far more in excess than possibly a promoter would have taken. All that has happened. Stories abound. We had in 2018 a big collapse. Again, that was in the public sector / private sector kind of a space. So all spaces have been affected by that kind of a disease. I was giving a thought to it as to what possibly could be the possible causes, and very quickly, Sanjeev, with your permission, I'll take a few minutes to just expand on them. A board or a promoter brings in a professional, a relationship is set up that of a principal-agent relation. Till so far, the relationship is very simple, very straight. Things tend to work because there's a very strong oversight. Organizations become big, giant, that's what they're supposed to become. Then that oversight tends to become very loose. As I said, everybody wants to usko kaam karne do bhai, day to day usko chalana. Now where that day to day ends, nobody really knows. And the agent then tends to perpetuate himself. That agent is that professional who is leading the organization and his cohort or his coterie. This is a very standard management issue which has remained for quite some time, and to my mind possibly applies here also. The agent is simply perpetuating himself, and that leads to, again, our corporate governance framework talks about performance, measurable performance, aligning incentives. However, who is setting performance standards? Who is measuring them? Whether the measurement is correct? More often than not, most of the performances are measured after incentives are decided. Tell me a single corporate setup where the person doesn't go crying to the CEO, who is a prima donna, कि सर मुझे पूरे पैसे नहीं मिले, ESOP थोड़े कम मिले हैं, चलो थोड़ा बढ़ा दिया तुम्हारा. How is that done if there was a very clear-cut structure laid down? More sophisticated organizations have more sophisticated ways of doing so. But again, the same thing happens with unfailing regularity, which puts a cap on the growth. So a principal agent issue then translates into the incentives. And when the incentives are not against a real performance, but a perceived performance, when the real performance could be much better. You could be growing at 50% and you're growing maybe just at 15%. Or you are doing something which you need not do. You're fudging books, nobody will get to know till the fraud is actually detected. Then everybody is looking at the past, looking at the history, but by that time, a lot of water has flown under the bridge and a lot of damage is done. What can boards possibly do in these kind of issues would be, or what could a promoter do in these kind of cases, is something which needs to be debated, where measurability of performance, measurability of incentives. Government's response many times in these cases to set up a regulator. So we have now so many regulators that we even don't know their numbers, and regulators also don't know that what they are supposed to regulate many times. I know of one particular case. However, regulators are not supposed to be running the company. They are only supposed to set up broad framework for that sector. The company should be run as per the norms of corporate governance by shareholders and on their behalf by the board, with very clear-cut set roles for the managers thereon. But how many times does that happen? And that is where the arbitrage or the play or the capture for the profession-led manager comes in. And the times when the values are really getting compromised, this really becomes an issue. Next is the issue of, and Many of you are on the boards of very distinguished companies, and a standard subject which is discussed is whether there is a smooth flow of information between the board and the management. Box is ticked. Frankly, very little information flows to the board. If it ever really went, none of the items would be cleared. If you ever ask people to write a simple summary of a particular board note, most of the people will not be able to write that properly. Information flow, only that information flow tends to go up in a case of a prima donna-led company, is where only that much is shown to board or a regulator which is required to be shown. So that is another asymmetry which comes in. How to again correct it is something I'm just laying the issues on the table, diagnostics on the table. Frankly, those issues need to be held and sort of identified, handled on day-to-day basis through very rigorous work by most of the boards as well as shareholders who have lots of stakes, especially institutional shareholders, especially when it comes to voting on incentives, salary, etc. Most of the time it doesn't happen. And incentives, salaries, all these things are voted as, and as very correctly mentioned by Sanjeev, there are people who delivered, people like Prakash Tandon, and there are many more who have delivered far more for far less. But well, that's where the nub is. I guess salary, incentive, their relationship to the performance is something which we need to see it more and more. The other thing is selection of board members themselves. Again, if I am a prima donna, I'll pack the board. Over. Nothing needs to be done. Thereafter, you keep cleaning the board for next 20 years. That's the kind of time that is taken. How to handle these issues is something I don't have ready-made recipes for that. However, a couple of suggestions I will leave on the table. Regulators have started doing it in BFSI sector, possibly needs to be done in the Companies Act also, to limit the tenure of CEO itself. That itself stops perpetuation. And why should one has reached a zenith not allow others to come in? We talk about succession planning. There should be a succession for CEO. We have successions in any case laid down for rest of the members of the board. The other is possibly mentorship of the CEO by the board itself. Far greater engagement, better relationship on taking him through the paces on the governance issues where more information flow takes place, communication takes place between the board, CEO, and rest of his team, so that strategy making and performance goal setting, some amount of measurability comes down. But I do hold measurability of performance as a very key element to determine whether the organization is really professionally led or not. Rest, a lot of faff is put around it. I will pause for now, and thanks very much for listening to me patiently.
Thank you, Mr. Chakravarti. I think you reserved your best punches for the end, and both thoughts which are worthy that should there be, in fact, like the US, they don't allow more than 2 terms for a president. And there is some thought behind it. It may not be a perfect thought, but there is a lot of reasoning behind it, and that is something which is worth considering. And there were many other points which I would love to react to and admire, but as we are a little crunched for time and we would like also the audience, may I request to both my colleague and senior friend to share his views.
Good
Good afternoon, ladies and gentlemen. Let me start with a simple statement that professional-led companies are and also not professionally managed. It's a mixed bag. That's the ground reality. Therefore, with your permission, I'm going to share my own personal experiences because I've had the opportunity to work under different environments. I started my career with a British company 60 years ago, which was totally professional-led. I enjoyed my innings there for my personal development, learning, growth for 10 years or so. And when the turn of events took place and the company was taken over by an Indian business group, what happened? Asset stripping, confusion, politics, all types of issues, and some of us started feeling uncomfortable. Didn't enjoy ourselves being in that company. But once again, there was a lucky turn. The government of India took over the company. It was great news. A professional came in to lead the company. But alas, the situation became worse. It was nepotism, it was all types of discomforting positions. Many of us chose to leave the organization because of the discomfort. Many professionals amongst us who were the skilled, trained people thought that was not the place to work. In fact, I was offered a job in an owner-led company, owner-managed company. The headhunter, when proposed that assignment to me, I said nothing doing. I want to work with a professional-led company only. But then, quirk of events, I happened to meet the owner, and the rest was history. For 25 years, I enjoyed every single moment of my association with that company. My learning at the end of this experiences was that in a professionally managed company, the hallmark of a professionally managed company is its people. People who enjoy working there, people who are happy, people who are proud to be associated with company's name and brand, whether they go in the corporate circle, any circle, family circle, they are proud of their association with a professionally managed company only. If it is not professionally managed, I'm afraid I have my head down even at home. What I learned was also that professionally managed companies are strong in terms of their processes. They are using the right, appropriate resources, and they have a strong management team comprising many more professionals down the hierarchy, peer and below too. All of them are highly skilled, and they are competent to deal with issues which are assigned to them in running the organization, whether it is strategy or it is performance. Professionally managed companies, as I see them, administer the management team of professionals, administers the organizations, its operations, in a very systematic and transparent manner. And that's why the monitoring becomes reliable when it is based on data, it's systemic and transparent. Professional managed companies also have decisions which are not focusing only on the interest of the maximizing shareholder value, but they look at not only just the top and bottom line, but they look at the entire spectrum of stakeholders, and most importantly, that of the enterprise itself. Many of us talk about stakeholders, social, government, regulation, but I don't know if how many of us actually verbally talk about the institution being the stakeholder. The sustainability with the growth, with development for future years. How many of us focus on future expectations of our stakeholders and deliver on that? And I think, to my mind, that is a professionally managed company's character. Let me just take a few minutes to say that the focus of the professionally managed companies is they have got flatter organizations, not too much hierarchy, not a tall pyramid. Their people are empowered. There are teams which collaborate with each other, and I think most importantly, a professionally managed company, you will find that professionals work to make others also successful, not only for myself. They make others successful. They give credit to others when the job is done well and achievements are recognized. Their leadership style is that of participative nature. They involve their team and other professionals. And actually, the most important thing is that the professionally led company, the leader, is the first amongst equals. It can't be the other way around. The moment it is different, the professionalism evaporates. Slowly, maybe. The philosophy, very clearly, of a professionally managed company is based on values. And as I said, they look after the social interests and other stakeholders' interests also. The philosophy of the professionally led companies is in terms of what I said, a corporate culture which is demanding, yes, accountability, yes, but also focuses on work-life balance of its people. That's how they remain happy, that's how they enjoy. And that's not that you shortchange their work in any manner. The strategy of professionally led companies is largely stable, slow growth, somewhat risk-averse. They are more cautious in taking risk or disruptions. And two other things, they have a very strong board, diversified in every manner possible, the skill sets, gender, demography, and they rely on their board for oversight and guidance. They don't have puppets in the board, the professional-led companies. Now, there are professional-led, as was mentioned earlier, which have the owners also, and they have the wider public holding only. And there are companies, not only just the MNCs and their associates, but Indian companies, Larsen & Toubro, ITC, ICICI, LIC. Can you say they are not professionally managed? And therefore, if have those focuses and including a strong board, the end result is the performance which exceeds the market expectations. They perform as planned. Let me just take one more minute to say, if it was not a professionally managed company, but professionally led, what would be the attributes there? Lack of autonomy, people will feel strangulated. Lack of accountability, leaders feel even more worried. Politics within the employees. Employee satisfaction scores low, attrition high. And here I may say finally, I somewhat differ with my moderator, Sanjeev and others. When it comes to the proportions, my personal view, which you might like to evaluate yourself, if the criteria which I shared with you seems the right one, then I would say that professional-led companies more are professionally managed, if not most. And I'm not saying that owner-led companies are not professionally managed. Many are perhaps even better professionally managed because of certain attributes like higher risk-taking, etc. I'd like to pause here and then would be happy to be questioned. Thank you.
Thank you so much, Mr. Bhargav. And between you and Mr. Chakravarti, you have brought in so many points. I'm tempted to ask so many questions. But our panel time is just an hour. And I think it is fair that we bring in the audience who may have a lot of questions to answer. We don't have to necessarily reconcile all our views because we are all human beings, and I'm quite happy to concede to Subodh his point of view where the disagreement is. Not the disagreement or divergence. But at this point of time, there have been so many, but one thing is common. I think that, professional does not mean necessarily the best. Professional has implications. It suggests integrity, selflessness, perpetuity, doing the best thing for the long run. But we can have proprietorial companies which are top-notch, and we can have professional people who may not be as good. And so we should be careful in using the term professionally, or rather look at it in a more wide sense that just because you have got a professional, therefore things are hunky-dory. But these have been such fascinating points which have been brought out by both my panelists. I think it's fair that we now give time to the audience who may have a lot of questions. But please identify yourself and if possible, address your question to a specific person so that we can economize on time. Any questions, please? Mr. Damodaran, is that all right? Would you like to shoot the first question?
No, I have questions, but I won't ask them, otherwise we will be here till evening. Just 2 points to make. One, whoever is asking a question must identify himself or herself. Number 2 is ask a question.
Please go ahead, identify yourself and ask the question.
Yeah, this is Surya Narayanan, sir. Good afternoon. And this question is to the panel. I mean, I don't have a specific query to any person. See, in a company which is not promoter driven and which is widely held, the culture can keep changing dependent on who is on the top, whether it is the CEO or the board or whatever is there. Is it possible that in such an organization, the culture of professionalism is implanted into the DNA so that it continues forever, irrespective of who is leading the company? So that is my question.
Very good question. Courtesy demands that I hand it over to my fellow panelists, but I'd like to break the courtesy just for a minute. I think a corporation which has the right value systems down the line will expel a leader who is not himself compliant. expel is a strong word, but cultures sustain or perpetrate when they are deeply embedded down the line. And then it becomes difficult for a top man to come and completely switch the culture. So I think this is my view, but I'd request my panelists if they have the same view or a contrary view.
If I can just supplement what Sanjeev said, apart from what is deeply embedded cultural dimensions, I think the leader, the choice of the leader is extremely important while succession planning. And in a professional-led company, it's like a relay race. The outgoing leader hands over the baton to the next one, and I think the first principle they adopt is legitimize the past, even if there were mistakes. You are here because of past. You are here because the last leader, whether he was 1 term or 2 term or 5 terms. So I think this, and Hindustan Lever is the greatest example of that continuing leadership where the culture, the competence, the capability, all has been retained over decades.
Nothing new to add, I guess.
All right, next question, please. Please go ahead.
Hello. Hello, can you? Yeah. My name is Jitender. My question is basically to the non-executive chairman of HDFC Bank. Normally, behavioral patterns are fueled by money. My question is that in the case of commercial organization, incentive-based, performance-based incentives are fine. But would that be really applicable, and would it be good for a bank or a financial institution to have incentive-based, performance-based incentives?
This particular issue of only money and performance and money being related directly on a very short-term basis has its corrosive effects. We have seen that on the ground. And many times I don't think that's always a good idea, and there the broader aspects of service to the consumers tends to get lost. Attrition tends to increase if they are linked on a very short-term basis. That's why for the senior management is always ESOPs and those kind of instruments which have a certain cliff and are delivered over a longish period. However, having said that, beyond a point, I don't think it's money anymore. It's also the challenge, the environment where one has to work, the fulfillment that one gets in a role, the role definition, clarity, and as Subodhji has very rightly mentioned, lack of politics. These are all components which would also define how an individual is nurtured, how the professionalism of the organization in overall term gets defined. Money, certainly very important, but not the be-all and end-all, and on a very short-term basis, on a very short-term objective it's linked. Actually, it is more detrimental than really very, very effective. Therefore, to use and align an incentive with performance correctly is something which, depending upon the sector one is, industry one is, a level at which one is defining, because a person should also be in money, perhaps a manager much higher up can be in money later, whereas a person lower down needs to be in money very quickly. Those are the kind of trade-offs one has, not easy trade-offs. And as I had mentioned, the measurability. Now the measurability is where most of the issues come up, if you ask me very frankly. We can define all very well, have the best consultants doing it, but correct measurability, honest measurability, not giving up one's achievement to the other person happens rampantly across the entire corporate setup, public or private. It's something which really affects the morale and the manner in which people work, and then distorts the personality. So those are the kind of things, so their values become very important. That's what the first question had come up, and Sanjeev and Subodhji had alluded to. So organization driven by value and subsequently then through incentives is what I would see at the right waterfall.
Performance-based incentives.
Of course, yes. I had just taken out various nuances. It must have.
Jitu, thoughtful question, thoughtful reply. This is a complex subject, and there'll be many. In fact, last week I got to know that the present MD of Mahindra & Mahindra has done his PhD on this very subject of incentives, ESOPs and so on. And so what kind of incentives are appropriate for which sector, and which tend to be corrosive, which tend to be value adding, is an evolving subject. And I'm, and there are so many shades of opinions, but I think they're all gradually getting synthesized. But if I may move on, there was a hand over there. Yes, please.
Thank you, sir. My name is Mahendra Chauhan. We talked about the, Ms. Chakravarti particularly, you talked, one point I like is the CEOs need mentorship by the board. Since this is a seminar on corporate governance, it's of course important that we talk about the behavioral aspect of the CEOs and professional managers, but also the responsibility of the board, and particularly the responsibility of NRC. So my question is to you and to Mr. Bhargav both, that in your wide experience, you have chaired a couple of companies, you've been independent directors and part of the remuneration committees. How courageously do NRCs really intervene when it comes to deciding the remunerations and incentives, beyond the presentations of professionally invited consultants who recommend certain packages and the incentives?
Thanks, Mahendra. You see, firstly, I think when it comes to board-led governance, I'm a votary of CEO and chairman role being separate, and preferably a non-executive chairman, where the conflict of interest is then minimized or eliminated. Second is the composition of the board and how the CEOs or the professionals take, or do they respect the board or no. And I think any competent board led by the right person would have to keep two things in mind. The market, the talent retention is not easy, especially at the fairly senior level. There are competitive bids all the time. There's always poaching taking place, whether it is pilots of an airline or a leader of an aircraft to leader of a corporate. So under that situation, and to keep the talent retained, not lose out, and also there is a degree of motivation in the financial rewards, as Ms. Chakravarti also said. I think again, the hallmark of professionally managed company is that they create ESOPs or remunerations within the boundary lines which do not attract unnecessary jealousy, unnecessary criticism. And once again, I would say most companies today, even owner-managed companies, have to be very careful in retaining talent, whether may not be the CEO, but under CEO there is N-1 and N-2 who need to be retained. And the remuneration, including ESOPs, is really becoming a hierarchy. If many companies have down the line, at the lowest executive level today, ESOPs. So we are moving with the market, with the global trends. We can't get away from that. And I think we do a reasonably good job. Okay, there are exceptions always.
I think we may have time for squeezing in just one or maybe two quick questions.
Sir, my name is Anil Khandelwal. You know, the other day, Reserve Bank Governor made a statement in the case of financial sector, especially keeping in mind the private banks, increasing cases of about 50% of attrition. Normally, it is taboo for CEO to take human resource issues in the board. At NRC is definitely not the forum where they would know what is happening inside the company. And there's a lot of toxicity in recent times in many organizations in the name of performance. And we just discussed performance and money and compensation and all that. How do we make human resource and human capital issues bring into the central nervous system of the company? What are the dilemmas of the board? Because normally the board and CEO normally would consider these issues as delicate issues, not opening the Pandora box, and yet board has a responsibility. How do you deal with this dilemma?
Whom would you address the question to?
Mr. Atanu, who is heading a bank, and of course, to all of you who are very seasoned people on the board.
Shall I come? Well, I can only say that it depends on the character of the board. There are boards and boards. There are boards who are interfering boards, do backseat driving on every issue, including HR management. There are intervening boards who do right thing at the right time when required. And thirdly, there are engaged boards. And I think the engaged boards, both with the CEO, owners, we have in most professionally managed companies getting the vertical heads getting exposed to the board from time to time. And also there are occasions when board members, especially the independent boards, members have their own separate deliberation with the, whether it is the vertical heads and without the CEO around or the teams. They visit offices, locations, and I think it's the engaged board which is able to do justice to this HR issues. It is not possible for board members to be engaged with the knowledge and operations of individual employees, but I'm sure the communication channels where within the organization, within the management team and across with the board, the communications are open channels, they share, they have objective data available for rewarding or evaluating performance. The boards are able to then judge that reasonably, to my mind, competently. Because the moment board makes a mistake, shows bias, shows favoritism, shows incompetence, there will be turmoil in the organization. The attritions are being high is not only just the market opportunity, it's also the dissatisfaction with the operating system, whether it is from the board level or my immediate boss level.
Thank you, Subodh. That's a most comprehensive and illuminating reply. We'll have one last question, please, because we're out of time.
If I can just ask my question, I'm just going to try and connect the morning session to what happened earlier just now, is that in the morning we talked about the importance of governance and regulators and how that actually creates more transparency and encourages investment, which I completely agree with. At the same time, there are a lot of organizations who get away with not sticking to the regulations. And we have good laws in the country, but the implementation on the ground can be much better. So what, in your view, can we do as a country, as corporations, to make sure that the laws which we have are good, can also find better implementation at the grassroots level as well? Because that also creates professional organizations in the long run.
I'm tempted to take that because time is short, but you can contradict me. I think eventually it is the character more than laws. And character is a tough thing, it's an elusive thing. And it's not just character at the top, it's the character of the organization. And these are things which expel poor behavior and attract the right behavior. And these are self-perpetrating. But it's a very broad answer. I can't, at this point of time specify A, B, C, but this is what I broadly think is the correct answer to your question. If I may take a last, and you can please tell us whom you want to address it to, and that will be the last because we are out of time.
Yeah, I am Babra here. I would like to request Atanu sir to give me some idea. I think, sir, you have touched upon a very important point because the information flow from the management to the board is very asymmetric. Because I have seen in some companies, they ration the information, they are not very transparent. So there is very limited information flows to the board. On the other hand, some companies tend to give us too much of information, I think, which we are not able to actually read, understand, make a kind of observation of it. And many times this information comes in with a very short notice. Tomorrow is the board meeting and the previous night it comes. So we have a wide spectrum. Some companies rationing the information and some companies who actually overflowing information. So how to strike a right balance and make the management understand? So they have to be a transparent and at the same time they have to give the information what is required for the board for a decision making. So I would like your comments on this.
So if you look at the G20 Charter on Corporate Governance, which had come from the OECD Charter, is fairly comprehensive, though it has gaps with respect to consumers. It talks about markets somewhere. I found consumers missing there. More or less put board between the rest of the stakeholders and the management as an intermediary of sorts. I'm using the word intermediary in a very, very broad sense, which means that the board itself has to put in far more work than they tend to do now. Many sectors, they do put in a lot of work, but that is more under regulatory constraint than on their own. So many items come in and a frequent refrain in the boardroom is, "Ye to regulatory item hai, chaliye," and it gets over. Very important, later on sometimes when import is somewhere else, doesn't get discussed along with business. So what really gets discussed is something which perhaps would have very limited importance. Therefore, it is for the board to lay down in what form to read, first to read the agenda itself. Many directors come very underprepared. That's an understatement. Many of them are very, very well prepared, but that tribe, as always, is limited. Therefore, there could be nosy directors. That's an issue which I'm sure a lot of CEOs have faced. But if I am a CEO, I would rather have a nosy director than a director who is underprepared and cannot back me up when really chips are down. As I said, my bias is more towards letting CEO have lots of elbow room, but for that, a CEO also requires a lot of policies in place, a lot of measurabilities in place, and a lot of communication there. And how do you really mentor a CEO if you are not really reading the board notes to start with? That's the first material. And then lay down in various committees. Let me tell you, post-2013, the structure of governance is pretty good. Now it's actually time to flesh it in various companies. And the better companies flesh it better, but that number is small. And as a quick last word, we are needing a lot of capital for growth, and the capital would come to those areas of the economy where the governance is good. That's where the trust is built up. And there are many facets of building up that trust.
I think since we've overshot our time, I'll have to bring this session to a close. I think the only remark I would like to add is that we could go on. This subject is the heart of improving governance in India. And the approximately 70, 80 people here are going to be big constituents of that change. Thank you so much. We could have gone on, but I'll close it here. Thank you so much.
Thank you so much, gentlemen. That was a very, very absorbing session. I can see that the questions kept coming in. We'd like to request Mr. Damodaran to kindly join us on stage to present the memento to our dignitaries on the dais. Thank you very much for that session. We didn't want it to end, and doing us the honors right now, Mr. Damodaran will present a memento. Now, these mementos have been very specially put together. We've got a caricature for each one of our panelists on stage. And along with that, a certificate that is going to share about planting 10 trees in the Sundarbans in their name. So, ladies and gentlemen, for our moderator, Mr. Sanjeev Aga, thank you very much, sir. Thanking our panelist, Mr. Subodh Bhargava. Thank you, sir. And ladies and gentlemen, the caricature and the certificate for planting 10 trees in the Sundarbans to our panelist, Mr. Atanu Chakrabarty. A group photograph, if we may. With that, we come to the end of this session on our professional-led companies, professionally managed. Thank you. We're moving on, ladies and gentlemen. We are going to set the stage and moving on to the next session titled Startups and Corporate Governance, Leaving It Too Late. As we get ready to set the stage, we're going to play a short video. Ladies and gentlemen, requesting you to continue to be in the hall. We're moving on to our next session. In a minute, we've got our video. Ladies and gentlemen, we now move on to our next session right here. Thank you so much for your patience. Inviting you to kindly take your seat. Now this next session is titled Startups and Corporate Governance, Leaving It Too Late? Startups constitute the expression of an entrepreneurial spirit married to an aspirational behavior pattern. Growth becomes an obsession with the founders of as well as the investors in startups. Are they giving corporate governance short shrift in the early years? If so, with what consequences? Ladies and gentlemen, we have our panelists right here with us. Please put your hands together as we welcome our first panelist, Mr. S. Raman. Welcome, sir. A former officer of the Indian Audit and Accounts Service, has been the Chairman and Managing Director of Small Industries Development Bank of India, SIDBI, from April 2021. Before joining SIDBI, he was Managing Director and CEO of the National E-Governance Services, NESL. Prior to joining NESL, Mr. Raman was the Principal Accountant General Audit in Jharkhand. Earlier, he worked with SEBI for 6 years, initially as CGM and later as Executive Director between 2011 and 2013. He also worked as First Secretary at the Indian High Commission, London, for auditing the accounts of various Indian embassies in Europe. Ladies and gentlemen, put your hands together. Our first panelist, Mr. S. Raman. Joining us virtually is our next panelist, Mr. Nitin Kamath, the founder and CEO of Zerodha. Despite being under the weather today, thank you very much for joining us today. After trading in stocks from a very early age and having to overcome hurdles, he bootstrapped and founded Zerodha in 2010 and changed the landscape of the Indian broking industry. He co-founded Rain Matter Foundation at Zerodha and constantly pushes the industry to think about climate and environment. He is a member of SEBI, Secondary Market Advisory Committee. Ladies and gentlemen, put your hands together. He can definitely hear us loud and clear, Mr. Nitin Kamath. And joining our panelists on stage, Mr. Siddharth Pai is founding partner, CFO and ESG officer at 314 Capital. He is the youngest executive council member of the Indian Private Equity and Venture Capital Association and is part of startup councils of CII and AIMA. He has recently been appointed as a member of SEBI's Alternative Investment Policy Advisory Committee and International Financial Services Centers Authority Working Group on development of non-resident individual business and ease of registration for GIFT IFSC. He is a member of the Indian Software Product Industry Roundtable, a Bangalore-based think tank. Ladies and gentlemen, put your hands together for our final panelist and our moderator, Mr. Siddharth Pai. Handing over to you, sir.
So thank you very much. Thank you, everyone. It is actually great to end up speaking at an august forum like this. As Mr. Amarjit was also saying, I'm actually used to sitting in the audience, so it's actually a great pleasure and a privilege to end up actually speaking on stage with luminaries such as Mr. Raman and the person who's actually birthed the entire fintech revolution that India is actually going through as of now. The Indian startup ecosystem is actually a remarkable organism similar to the IT services companies that actually came out in the late 90s and the early 2000s as well. India is the third largest startup ecosystem in the entire world, galvanizing over $144 billion of capital, boasting of 115 gross unicorns. Some of the valuations may have come down as of now, so it's better to stick to the highlight gross figure that's there, and actually boasting of more than 1 lakh registered starters with DPIIT. The unofficial figures end up actually putting the number of startups who don't meet the government definition, but still consider startups at a much higher number when it comes to that. They have in a very remarkable short span of time ended up evangelizing the digital India, the digital public goods that we've had, and ended up actually creating a revolution which has increased the financial penetration that we've ended up seeing, and some of these have become household names as well. I think all of us, when you look at our phones, maybe 6 years ago versus as of now, all the apps that we end up actually using and the convenience has actually been brought to you by this entire unique breed of entrepreneurs who've actually come up with that itself. And indeed, growth has actually underscored the entire startup phenomenon, not just in India, but across the entire world. The greatest mantra that the startups ended up espousing, which was famously actually said by Mark Zuckerberg of Meta, formerly Facebook, is that you need to end up actually moving fast and breaking things. And indeed, we've actually seen that predicate the entire startup playbook over the last decade. And this was buoyed by the fact that we had historically low interest rates. So investors were actually chasing growth, and growth is something that startups promised, and more often than not end up actually delivering upon. But since COVID, for that matter, and the fact that interest rates have actually risen, we've actually seen a sudden freeze end up happening across the entire board. We've seen WeWork, which has been the poster child of everything that's actually wrong with the startup industry, actually filing for bankruptcy as of now, for over $47 billion of peak valuation to something which is actually pennies on the dollars for that particular matter. So we've seen the playbook now actually move from move fast and break things to actually reflect and rebuild. I think that's actually a perfect segue to speak about the role that governance has actually seen. And I think the Indian startup ecosystem has also been marred by several issues of corporate governance that have actually come to the forefront as well. And one of the reasons why these governance issues come about is because of the frenetic pace of growth that these startups have ended up engendering and ended up actually creating for themselves. We've actually seen situations wherein progress has actually outstripped processes of these particular institutions, which was fine when there was an unlimited tap of capital that was actually available for them. Because capital is a great Ganga Jal that ends up actually baptizing any of the sins that people end up actually facing for that matter. So the day the capital tap ended up drying up, we've actually seen, and the tide has actually receded, it's actually become fairly evident who's been swimming naked versus who's actually been fully clothed, for that matter. So we've actually seen this sort of thing of corporate governance come in. And corporate governance at the end of the day is a lot like personal hygiene. When you do it well, people don't actually notice it, but when you do it badly, there is nothing that can end up actually hiding that particular stink, for that matter. So we've seen this sort of governance, these run-ins end up coming about. And here to actually explain and to go deeper into this entire field, we have a very august panel. So I'd like to actually start off with the question, with a question open to the entire group as of now. So given the fact that the Gatekeepers of Governance Conference has actually reached this particular edition, I think the entire audience and everyone is fairly well versed as to what corporate governance ends up entailing and what corporate governance is. So along the lines of the disruptive nature of startups and the antithetical behaviors they end up espousing, what I'd like to ask the panelists, as of now starting off with Mr. Raman, is what isn't corporate governance, for that matter? So everyone knows what it is, but what is it not? What are some of the proxies that people end up using to give them the veneer of governance while paying lip service to it without actually following through on what governance ends up actually entailing?
So, very good afternoon to all of you, and thank you to Mr. Damodaran for inviting me here. Sir, it's an honor to be here. Thanks, That. You, I think, really gave an excellent preamble, and you threw a very difficult question as the first ball. Now, I think somewhere corporate governance gets sort of hidden within the chase for valuation. So, you know, typically, and I think this was brought out in the earlier session by really some chieftains of the industry, to what extent does money cover up the, you know, gaps? And I think when, as you said, the going is good, people presume that corporate governance is in place. Now, I think that is really where we should maybe point the finger and say that this is not corporate governance. So, you know, the financials are kept aside. Corporate governance has its role, and it has to sort of be seen in isolation of what the company may or may not be doing for its shareholders. But I think there is a larger point when we really talk about the larger industry. So, you know, there is a listed space and there's an unlisted space. Now, I think a lot of what we are talking about in corporate governance is the listed space. And we've all spent many years, Mr. Damodaran has been a, you know, sort of pioneer in making corporate governance grow within the listed space. But the entire regulations of SEBI are really addressing the listed space. It is the unlisted space in which we are now talking, and the context really here is, you know, the alternate investment funds and what is it that they are bringing to the table. At a very macro level, I would say that there is a competition between the listed space and the unlisted space. A lot of corporates today somewhere are rethinking whether they even want to be listed. Now, corporate governance, therefore, is lost because many of SEBI's rules do not apply to the unlisted space. So I think there is a huge need to look at this again. Maybe the Companies Act does not have enough on corporate governance. I mean, I'm really not getting into the depth of that because I'm no expert on that. But it talks about principles. Now, who is going to flesh out those principles is really left to the stakeholders. So, you know, what is not corporate governance is a question that does not arise initially when a company is, you know, sort of starting off, gets its investors, because there is a crazy idea that the founder has got. And he needs to chase that. He is really not bothered about corporate governance. So let me just, you know, sort of pause there and...
No, very interesting. You've also opened up several avenues for questions, but I would actually like to come to you now and to actually hear from the entrepreneur who's actually built up a bootstrap company. I think more than unicorns being specialties in the Indian startup ecosystem, a bootstrap unicorn for that matter is actually the most unicorn of all unicorns. So I'd love to actually hear from you as to what you believe is in corporate governance, and I do have a few more questions along the lines of how you actually built up Zerodha as well as a practice.
No, thanks. So I have like a bad throat, so so I would allow to be there. Thanks to Damodaran sir for inviting. I think both you, Siddharth and Raman sir, kind of covered it well. No, I was actually thinking, why am I on this panel? Because and I was just the first thing I did was actually Google for what is corporate governance, and it said it's about just running your business well. I mean, that's really what it meant. It said, is that you need to, if you're running your business well. And I was like questioning, what is running a business well? Which is doing what is right for your customer, doing what is right for your, your team, and not maybe thinking short term, right? Because I think one of the, the way I think of startup is it's kind of, I think, a regulatory arbitrage, which is, the listed universe is slower because of all the legacies. And startups can be faster. And this is a game about fast beating the slow, right? It's not about the big beating the small anymore in a tech-first world. And I think, investors in the space almost play it, right? As in, VCs, etc. know that the play here is you can be kind of a little easy on how you're running the business, just to be able to be fast and catch up. And I think that is not the right way to run the business, right? Because, and hence it is probably not good corporate governance, is how I was thinking about it. Is that when you start prioritizing what is right for the short term over what is right for the long term, you, I think, end up compromising on a lot of decisions that you take as a business. And when I was thinking about what we've done all right at Zerodha is probably that every time we think about any decision, it's always 10 years away, saying that, is this something that will kind of help us in 10 years from now? Is this something I would do to myself as a customer? And, it's just, I think that kind of decision framework is what has, I think, helped us, run this business decently of sorts. But I think coming back to the question, I think what is in corporate governance is probably, just doing it a bunch of check boxes, right? Like putting a tick next to a checkbox saying, these are 10 things you asked for it, and this is what I've done in a letter, and that's probably not corporate governance.
No, true. I think that's actually the way most of us. I mean, I actually wrote my exams fairly recently, for that matter. So not recently, about 10 years back or something. But that's more or less the way we ended up actually studying for exams. It doesn't matter what the syllabus was. If we knew there was a question bank of 200 odd questions that would actually come from, might as well learn the 200 questions and never end up reverse engineering the answers as opposed to following through on the practices that are actually there. But so coming to you, as now, you did actually touch upon the role that regulation actually plays when it comes to corporate governance. But just to actually counter that, every regulation is actually one clever lawyer away from subversion, for that matter. We've actually seen, I think, the Companies Act being fairly replete and become extremely onerous on compliant companies who wish to actually follow that, whereas the ones who wish to subvert regulations end up actually doing that. And the regulation as a deterrent is actually a function of enforcement. And there's still, I think, a few ways to end up actually going for enforcement. So what role does regulation have to play to end up engendering corporate governance, given that Nathan has also said that when actually the simplest razor to apply to governance is the fact that I would actually like to do what would actually be done to me. So what role does regulation have to end up playing over that, and how does it play into the Indian framework when it comes to it?
So let me start by tipping my hat to Nikhil, that if you've actually gone and looked up what is corporate governance today, truly, I mean, you've got it right. So I'm just saying that that one, sort of reply from him is, if we weave that into a reading of the Companies Act, the Companies Act is not asking for you to stand on your head when you're running a company. Now, if you're by character and by interest to serve your customer, you are taking a certain set of decisions and you're moving ahead, you probably are not going to find yourself in those situations of conflict of interest. So, at the root, at the heart of, corporate governance is really conflict of interest. And I think all regulation is trying to narrow down those conflicts situations. So, we are getting obsessive maybe with regulation, but again, I'm clearly making a difference between the listed space and the unlisted space, because in the listed space we have the retail investor. And I think really a lot of regulation is because of the fact that we have investor protection of a retail investor. And therefore, it is equally, argued on the other side that when you have an industry called the AIF industry, which is now sort of, as you said, we are the third largest, etc., etc. But we are still, I think, very small on that entire AIF industry. It has a huge future if we were to just look at it as people who do not need investor protection. Then how would we approach the entire problem? So you're then talking about, it's the Companies Act and the rules thereunder which govern the companies that are put together by the AIF industry. And we are really talking about some serious, the unicorns. I mean, it's a matter of valuation, but the fact is that those unicorns are for real. I mean, they have created huge value and people have benefited. So, we are talking about the need for corporate governance to come in to a host of companies where regulation can be kept at the door. We don't have to allow regulation to come in. Now, that's a debate that's going to continue forever. And I think if we are talking about leaving it to the stakeholders to guide the company forward, we probably should continue down that plank, and where we find that there is a rotten apple, that's really when the covenants and clauses of the Companies Act would really kick in. And it's open for any stakeholder to then knock the door and take that forward. So I think we have seen, again, I'm talking from the AIF industry because, as SIDBI, we have now supported, I think, over 110 AIFs, which have then gone on to putting money into over 1,000 startups. And in that 1,000, we've got, I think, 23 unicorns as of yesterday. I don't know what the value number is today. But the point remains that as LPs in an AIF, what are we doing to engender corporate governance in those startups? And those are of high value. So, do we need a SEBI regulation to help us? Probably no. But to the extent that we have investors who may end up going and knocking the door of the regulator and saying, listen, we've been sort of, sold a lemon, then you have a problem. So it's really about drawing stricter boundaries. And I would really say that in the entire AIF industry, if we are talking about bringing in domestic capital, which certainly exists, we just have not tapped it enough, and of course the large pools of global capital, we would be wise to go back to the drawing board and ask ourselves that question again, that how much regulation do we really need within this space?
No, that's actually a very fair point, because what is supposed to be a light touch regulation should not actually become onerous for that matter, because the sophistication of the investor is something that has to be a tangible input into any regulatory framework that ends up evolving as well. There's no point actually creating a sort of nanny state in terms of set of regulations if there are people with eyes wide open who wish to actually take certain kinds of risks they must be able to accept the downside of that risk as well, not only expect the upside to end up actually coming there. But I'd actually like to shift to Nitin as of now. Nitin, given the fact that Zerodha is actually the bootstrap beacon of the entire startup industry for that matter, and you yourself said that investors actually have a role to play. But when you started off Zerodha with your brother, and consequently actually has a investment fund known as True Beacon. I wonder if both of them are actually linked. How did you guys actually think through these kind of particular practices for that matter? Because we've always heard about corporate governance being a function of independent directors, externally driven mandates, a set of regulations. But you actually created a very, very well-run shop for that matter that's actually engendered trust during the entire space. So there would have been occasions where you also would have had to tackle with going for the low-hanging fruit, actually taking what I actually like to call regulatory innovation, or taking that kind of risk that actually violates the spirit of law as opposed to the letter. So what is the kind of moral compass that you actually kept in place that I'm sure that other founders would love to actually learn from and end up actually emulating over time?
Yeah, no, thanks for that, Siddharth. No, so when we started, so before Zerodha started, I mean, the way it started was Nikhil was a better trader than I was. And so the plan was he continues trading and I'll attempt building a broking business, or be a broker that traders like us didn't get, right? And so I think, when I was thinking about panel and questions, and I was thinking about it, like, how is this whole decision-making framework, right? Because it's not like I read a book or something like that. I mean, and to be very honest, I actually for the first time saw what's the definition of corporate governance today. And, but I think what helped was as a trader, right? I think, the way you can trade well is to think of everything as a risk and everything as an opportunity, right? The problem, I think what I see generally in the ecosystem, especially in the startup world, is that everyone's looking at everything as an opportunity and not as a risk, right? Eventually, everything comes down to risk to reward, right? I mean, it's like, what do you do? What do you don't do? And, and you need to be able to say, what is not worth the risk, because the reward is not enough for this, right? And this is, I think, in my genes right now. In the sense is, like, anytime I do anything, I'm just evaluating everything in terms of risk to reward. And, like Zerodha today gets a lot of credit for tech and, low cost, kind of bringing down prices, etc. I think actually the true disruption, what we did back in 2010 when we started, was actually in terms of transparency, right? We thought financial services businesses are very opaque in the way they work. And that was a real problem to solve, right? And we said the only real way for it to be solved is that if you have just one offering for all of your customers, right? So, which actually was very disruptive. A lot of people had tried low-cost broking before us, right? But what was different was that we said every customer of ours will get the exact same deal, which means it will give us kind of an opportunity to be very transparent as a business. Right? I can talk about, like today we have, 1.3 crore plus customers, and everyone has the exact same deal. There is no differentiated offering, right? In today's tech-first world, it seems a norm, but then this isn't, this isn't how financial services businesses work, right? And I think for the first time, I kind of realized the power this transparency brings to the business, right? So I was probably the first guy in the financial services ecosystem to start blogging. Right, I used to openly answer people's queries. Right, as in you never probably have seen a CEO. I mean, I still do it till date because there is nothing that I can't say. It's just I think it's a superpower. Like if you're just brutally transparent, and then I think everything else, right? All the decisions that I've taken as a business, that we have taken as a business, is saying that we cannot compromise on transparency, right? As in if customers come on a platform and lose money, we should be transparent about it. I mean, like before SEBI put out these regulations of mandatory disclosure of how many people lose, we've been constantly actively saying, these are the reasons why people lose money. This is how many people lose money. And that stock market is not is not like how it's perceived to be the easiest place in the world to make quick money, as in it's probably the hardest place in the world to make easy money. So I think just that, like I said, this whole chase of saying we want to be transparent on every aspect of the business, I think helped us kind of build everything around it. That was like the core. Like the realization was very quick that this is a superpower, and I think a lot of our competitors will have a problem with this. I think one of the reasons we didn't even raise capital. I would say is this, because we didn't want to lose the superpower. Because, we're like, at some point of time, if we have to prioritize growth over everything else, would it force us to lose some of these things that, today we have the freedom to say and do, right? And because at the end of the day, I think as an entrepreneur, you need to be able to say and do things which is hard for someone else to say and do, right? And yeah, so I think that's really how we thought about, and the transparency doesn't end just with customers, or it's actually internal as well. So we have a forum within Zerodha which we call Inside the Zerodha, and it's extremely active, and I've taken the hardest of questions, like, out there, as in this isn't, like a moderated, like a forum. I know that, a lot of our competitors will never be able to do it because, if you're not transparent, then you cannot say things on an open forum, right? And I think that as culture has kind of that's really what I'm attempting, which is to make sure that, like the next person in line after me also can follow some of these things, because this is how we want Zerodha to run in the longer run. And so I think just being brutally transparent to your customer and to your team, has helped us, I think, kind of stick to the broader definition of corporate governance, as they say it.
No, that's actually a fantastic insight that you actually have. When you have nothing to hide, you actually have nothing to lose, for that matter. So there is no information arbitrage or something that people can actually hold up against you. And I do agree that, as with the statement you made, that the industry is actually full of black boxes when the regulator is actually moving to sandboxes, for that matter. So I think it is important and essential, therefore, for us to end up actually being a lot more transparent in some of these operations that end up actually being over there, rather than actually closeting a large amount of this. But just picking up on something that you said for that, about the role that investors have and how investors end up actually influencing some of this. Even the large hyperscale growth that we've actually seen, a lot of entrepreneurs place the blame on investors, and a lot of investors place the blame on the entrepreneur to say that, look, you were the one who gave us these projections, now we're actually holding you up to account for that. So given that, sir, given the fact that, sir, that SIDBI is actually the bank that launched 1,000 AIFs in the country and 1,000 fund managers in the country, you are actually placed in a unique vantage point from a domestic capital perspective, and also as a custodian of public finances, actually channeling it to one of the riskiest asset classes in the entire country. What are the kind of lessons you can end up actually giving? What are the conversations you've had with your fund managers when it comes to governance? Have any of your managers been affected by the sort of startup governance dislocations that we've actually seen? And what is the playbook that SIDBI is developing as of now to guide these GPs and these fund managers to end up actually speaking to the companies, getting them to be a lot more transparent and making sure they walk the straight and narrow and not get seduced by some of the low-hanging fruit that have long-term repercussions for them as well?
No, Siddharth, I think, we're talking about the LP, the GP, and the founder. Now, frankly, sometimes the LPs do not want the GPs do not want the LPs to come too close. Now, it's natural. So, we're not saying anybody is good or bad, but the larger point is that there is a consciousness within SIDBI that if we've committed nearly now, a 1.2 billion US dollars in this space, what are we doing about it and how are we protecting it? Now, you must understand that we are one amongst several LPs. We might be at 17 to 25%. That's typically the kind of share we would have. But we need to go with the rules, and there is therefore an LPAC, the LP Advisory Committee. Now that, I think, really needs to steer the entire conversation with the founder. And to the extent that through the LPAC, you can actually take decisions on individual portfolio companies. It has to be done with a certain boundary. It has to be, if you ask me, there should be an SOP for this between the GP and the LPs. And you need to therefore remain within those boundaries, because otherwise, you're not allowing the GP to do his work if you were to transcend those boundaries. But the larger point is that somewhere the portfolio company is driven by the GP so hard that I actually feel at points of time, and we've seen some aberrations in the last 12 months. Now, 2 of those were companies where SIDBI has, is there as an LP in those AIFs. Now, when we drill down further, we know that the GP is just chasing that quarter-on-quarter profit. And this was a problem with the Satyam case, if I were to go back, some number of years ago. Now, where does the LP come in and restrain the GP? There's no easy answer to it, but I think that has to be done because the LPs cannot remain passive. You are therefore will be called to account because somebody may say that, listen, as a stakeholder, what is it that you are doing? So it is something which we should possibly flesh out, and it should be done within the industry. I would not even invite, SEBI to come into this, because as an industry, as an AIF industry, which is now blossoming, it's got a huge way to grow going forward. If we have to be responsible, we have to become a self-regulatory organization amongst the AIFs, and therefore there has to be this larger debate between the LPs and the GPs as to what is the LP's role. Now, we know for a fact that we can determine the kind of investments that are done by the GP, because you have a 75% share of voting, and if you get that, you can actually sort of direct the GP. Now, I think these are things which have not really been tested, and to be very honest, I can admit before all of you that as an LP, SIDBI has not really taken on an activist role. Probably, we'll be, blessed by our GP saying, they're asleep. They're not really interested in what we're doing. But I think somewhere we have to, sort of heed the wake-up call. We have to move forward and, interfere a little more in what the GPs are doing. And I think this is really the right way to set a trend in this industry, which we are very clear that it is an industry which is not within the purview of SEBI as a regulator in terms of the investee companies or the portfolio companies. You're there only because money is being collected and you don't want, the kind of CIS related issues which used to take place. So, you are here more as being regulated for collecting money rather than being regulated for investing that money. Now, that investment is really where I'm saying, let us make it a, a sort of dialogue between the GP and the LPs, and let's strengthen that dialogue. Let's even put it into some kind of a guidance and let people try and abide by it.
No, sir. So you do actually raise a very important point about the unique straddle point that an AF has. It's actually a bit like my Hindi is a little bad, so just bear with me. I'm actually from Bangalore, in the south of India. AF is actually like the dhobi ka kutta, na ghar ka, na ghat ka. So you end up having a situation wherein you have the regulator who's actually more for public markets and retail investors, end up actually regulating a product that is meant only for sophisticated investors and allocates a large number of the assets, where even on the asset side of the balance sheet is not regulated by SEBI, and the equity side and liability side is also not actually regulated by SEBI, but yet SEBI is placed in this sort of unique vantage point to end up actually regulating this kind of industry. And the point that you actually brought about it, I think the industry should also, given the fact that it's a 100 billion, it's an 8.3 lakh crore industry, grown at a CAGR of 112% from December 31st, 2012, all the way to March 31st, 2023, for that matter. I think it's about time the industry evolves to actually start regulating itself. I think the important part is also from the regulator's standpoint, they don't want to interfere. They expect maturity to come in from the entire industry, where the industry says, look, we will actually create a set of operating guidelines and create these sort of rules. And we will enforce it amongst our members to make sure that anyone who's not walking the straight and narrow, we end up taking suitable action against them. Otherwise, we end up with a situation, and also the panelists in the first, the panel were actually speaking about, where the regulator ends up actually reacting to bad actors in the ecosystem, and the unintended consequences of that are actually felt across the entire industry.
So there are some hygiene issues in which I think the regulator should, keep the bar high. So it's like, the demat of shares. Now, it's a demat of shares of the portfolio companies, the demat of units which are held by the LP. I think these are great steps forward. The need for standardization and valuation. I mean, can we disagree with that? I mean, it has to be there. Otherwise, we're not talking the same language. I mean, what you are calling, unicorn, I will say, no, it's a sunicorn, so. So, I think, the basic minimum hygiene standards are a must. But beyond that, if you want to make this grow, and you actually are now calling upon this global capital to go forward in immensely different areas. We're talking about deep tech, which is now suddenly and rightfully so, coming up on the horizon. Now, with deep tech, you're talking about several $1 billion, and we would be happy to have global pools of capital looking at India as a mature market where governance is, sort of expected to be arising from within the dynamics of the LPs and the GPs. And you have a regulator which sort of is asking the right questions, but does not have to enter and, bring that big stick down.
True. No, I think I think the regulator is also slowly moving towards that, where they expect the industry to end up regulating, and they prefer to create the rules at the playground rather than telling you who has to bowl at what particular point in time, what stroke you end up playing, and actually becoming more prescriptive that way. So coming to you, Nitin, as of now, I actually don't want to speak to Nitin, the entrepreneur, but I want to speak to Nitin, the investor. Through Rainmatter Foundation, Rainmatter Capital, you guys have become very active in the entire early stage space as well, taking several investments into larger companies, into companies that are fledgling and growing up also. But given the fact that you primarily invested in the listed markets, where there are active market mechanisms to punish and reward bad behavior. For example, if the investor actually puts out a negative report on a particular company citing governance lapses, the stock price immediately falls. They can end up actually liquidating it and moving on. So bringing that kind of mindset, coming into the unlisted space where you don't have that kind of latitude. If you have a problem, I think we've also seen where investors have walked out en masse of startup boards for that matter, but companies still continue, life actually goes on. Those are, of course, nuanced issues that go far deeper into that. But what are the kind of market mechanisms you would like to see evolve in the startup space, similar to the listed space itself, to make sure that bad actors are actually held accountable for their actions? Taking them to court, no investor wants a reputation of dragging one of their founding companies to court. So how do you, in your unique position as a founder, an entrepreneur who's built something, as well as now donning the investor's shoes, what kind of mechanisms you would like to see, and what kind of advice can you end up giving for budding entrepreneurs for that, to your own portfolio companies for that matter?
No, I think, like what Munger says, right? As in, show me the incentive, I'll show the outcome, right? I think a lot of these issues, like Sir rightly said, also comes because of the investor itself, right? I mean, this is a question that we keep asking internally, right? As in, what is the value we bring as Rainmatter to a startup? As in, why should a startup raise money from us? And the way we have structured it is it's as perennial investments. Is that we are invested forever, right? So that means we are not in a hurry to make money, right? As in, I think the whole issue, as in wherever I've seen issues, is really, I think it all comes down to that, which is like someone trying to grow too fast and then compromising on a bunch of things. Now, can you just blame the entrepreneur for this? I don't think so, right? As in, I mean, you have to kind of blame the investors as well. And so I think we have to fix that. And I think market itself corrects over time, right? I mean, I think this, whatever is happening right now, the lull, will fix this problem. I think, as in, today the investors ask for the right kind of questions. And so since the investors are asking the right questions, I think the odds of the issues that we have seen in the past will probably reduce. I mean, I'm sure a lot of issues are currently hidden in the closet, because this is the legacy of, the bull market in the Indian private market space. So it'll probably start showing up. But I'm saying the new vintage of investments that's happening now, the odds of corporate governance issues showing up, I think will be much lesser, because the investor is asking for the right kind of questions and is benchmarking, correctly. Now, but at the end of the day, there are going to be rotten apples, as in the sense, it is, it's how it is, right? As in, there are in public markets, there are in private markets. If someone wants to make money quickly, as in, he's going to compromise on a bunch of things. I mean, I think one thing that we don't want is that you don't want regulations for that rotten apple kind of slowing the entire sector down. And we've seen this happen, say, in broking industry. We've seen this in the banking industry, etc. Right? Is that because of a few rotten apples, you almost make it very hard to innovate, right? As in, because regulations eventually end up stifling innovation. And at the end of the day, we want to grow this country, right? As in, like each, the way I think about what we're doing in Zerodha and Rainmatter is that we're participating in the growth of this country, and that can only happen if we can continuously innovate. right? So I hope what doesn't happen is, we get up one of these days and there's a big blowout and a bunch of regulations saying this is how you need to run your business, right? I mean, even in the private space, right? So it's no, I think I think the first fix here is for investors to be pushed to ask the right critical questions, and I think that we are already seeing. Other thing that I've been thinking about is that India is a hard market to build a sustainable business, a resilient and sustainable business. It's not a US, right? So the fund life cycle in India should probably not be the way it is in the US, right? So maybe it should be much longer, so because if it's much longer, then the investor has enough leeway and time to allow the startups, to grow. The LPs are not asking the GPs that where is my money in like 4 years, 5 years. So maybe they're gonna wait for much longer period of time. So I think maybe there is a use case here to say that should the fund life cycle in this country be much longer, because it takes a much longer time. At the end of the day, India is a poor country. I mean, we need it to become richer. So for a startup to, the way I think about Zerodha is that, we started in 2010, but there was 10 years spent before that as a trader and a sub-broker, etc. I think of Zerodha as a 23-year-old business, right? And we got lucky financially only after 16 years, right? So if someone had said to get lucky in 5 years, I mean, it wouldn't have happened, and I'd probably have had to compromise on a bunch of things. So I mean, I think these 2 points maybe.
No, I think that.
Can I just butt in there?
Please,
just
please,
a point to Nitin. I mean, I think you alluded to the fact that the Indian investors are, therein for, a shorter period. And your ask is really that should the funds not be for a longer time or a life period. But there's nothing in the regulations which prevents you and me putting our money together for a 30-year fund. It's allowed. So, it's just that the investor behavior is such that you want to see your returns in 7 years. Now, you don't probably trust the investment manager sufficiently enough, saying that, no, I mean, 7 years is the max, now I want my money back. Now, that's really the, sort of hurdle that we have to cross. So, we are actually talking about the deep tech space, where we're saying that we need 15-year funds minimum, because otherwise you're not going to be able to incubate that company sufficiently well. And you might end up, looking for a secondary market where valuations again will be entirely different. So, we have to grow that culture. And in fact, some of the greatest global investors have 30-year funds. So I think, that's something which maybe, you should look at. I mean, you should be a, pioneer in that.
No, one of the reasons we talk about it is the way we've structured it. I mean, we have the freedom to do this, so it's because it's our own capital. But the way we've structured it is saying it's a forever fund, in the sense we are perennial investors and we're going to stay invested forever, So, but I don't think everyone will have the freedom to be able to structure stuff like this. But I'm saying it should maybe not be 7, but like you said, it should probably, you need to, like how you do that purchasing power parity between US and India and say, what, India should be this or that, so maybe it should be twice of what's in the US and not, cut copy paste to what's happening in the US.
No, very true. I think we've always been scarce of capital. I think now we're also scarce of patience. And patient capital, I think, is a bigger myth to end up finding than anything else. But I do actually like what you said, Nitin, about the fact that investors are now looking, rather than just being greedy, they're looking at the DD as well and taking more informed decisions to what they end up actually doing. But just around the role of investors as well as how they end up shaping these sort of fast-moving enterprises. Vinod Khosla of Khosla Ventures actually had a very interesting interview that he did recently, where he said that he doesn't allow some of his team members to actually end up taking both seats, saying that, look, what role are you going to end up actually playing on the board? Have you actually built this kind of business, gone to the kind of travails that a entrepreneur has, to end up giving them that kind of information that's actually relevant at that point in time? Because what we've seen happen, especially in the unlisted space, for that matter, the role of the investor on the board is not for the stated purpose of increasing governance or actually making the company a lot more sustainable or anything like that for the matter. The role of the investor on the board is far more myopic, because it is there to ensure that the investor's rights are actually protected. And given the onerous obligations that are placed upon them by LPs, as well as by regulations to make sure that their interests are actually best protected, we are actually seeing the convergence of, I would say, more myopic behavior. that would be counterproductive and counterintuitive to the overall growth of the company itself. Because corporate governance, as Mr. Damodaran said, is not just a factor of looking after shareholders, it's looking after stakeholders as well. If any of these large companies end up actually going down, it's not just investors who end up losing money. That is actually the name of the game. It is equity risk that you are taking. But the dislocation in terms of jobs, the dislocation in terms of services provided, ends up actually increasing the entire ambit that's there. Whereas investors have a counterpoint to say, look, the way new regulations are written as of now, even if I didn't participate in the decision, there is a good chance that I will be held accountable for matters that I didn't necessarily give my consent to. So there is a gap in the regulation, especially for unlisted private companies, for that matter, compared to the listed ones who are there. So I just want to get, and this is something for the both of you, it's more an open question. What are the roles, given the fact that the investors sort of boxed in by that matter, from the LP side to make sure that they protect their interests, from the regulation side where they're held accountable for things that are out of their concern, and from the promoter and the stakeholder side where they have to balance out their own needs of a short-term fund, of generating liquidity, creating IRR, etc., as well as ensuring more sustainable businesses. How should investors actually end up navigating this sort of trilemma and this sort of dynamic that ends up coming in?
So honestly, I mean, if we were to just keep regulations out of the picture, you are talking about a GP going and investing and sitting on the board of a portfolio company. Now, the only thing that he has on his mind is how to make his investor happy. His LP needs a return, because he's already thinking about the next fund that he needs to raise. So, you know, you're talking short-termism right through. I think, sir, you said it. I mean, you know, the extreme short-term and money, they have a corrosive effect. I completely agree. Now, here, we're not talking, you know, sort of even 5 years and 7 years is short-term. If the GP's only concern is that I have got a 100 crore fund, and now, you know, with successful investments, I'm already looking at setting up my 500 crore fund. Now, what does he expect? He has to put on his pitch deck the fact that 5 of his 8 companies are giving an IRR of 18% plus or 64% or whatever it might be. Now, this is really the, you know, trilemma, or, you know, the simple conflict of interest. I mean, let's not get into too many variables. It's just a single variable of a conflict of interest where you do not really have the interest of the business at heart. It is about your returns and your management fee from the next fund. So, you know, this is really how it's sort of driving the industry. My view is really that if an LP wants those returns from the from the portfolio company, they need to sort of look at a much better secondary market. So, you know, why have we not seen the secondary market develop? Now, this is really coming close to the public equity market. You know, you have the entire, you know, exchange and depositories were created only because you have a secondary market. Now, if there were to be a large secondary market within the unlisted space, then maybe you would have the ability for different investors with different risk appetites coming in at various points of time, and therefore holding on to that particular portfolio company in a much better way. So that's a lovely bit of music, yeah. So
is that a kind way of saying that lunch is served? Or? Huh?
So, I mean, this is really my take, where the LPs have to, you know, get an exit, and therefore we've already seen the graduation within the Indian space of the angel and the VC and the, you know, sort of Series C and then the PE. So that is coming in, but let's grow the secondary market. I think a lot of troubles that we currently have right now might, you know, abate.
That's actually a very interesting thought, because one of the greatest marks against the Indian AF industry and the VC industry has been the fact that your translation of paper gains to actual hard cash, I think that's actually a fairly large chasm to end up actually doing. And like you said, there are restrictions, some regulations. SEBI doesn't allow you to extend a fund despite 100% LP approval for that matter as well. So it places the fund manager in a unique position of mismatched expectation, where they have to maximize gains to end up actually doing within the shortest span of time. and that ends up actually leading to kind of undue pressures that come in over there. But Nitin, the one thing I actually want to come to you on that, the entrepreneurs also have a role to end up actually playing over here, because valuations are ultimately is an expectation of the entrepreneur, say I want to be valued at so much, and they end up actually giving extremely optimistic projections for that particular matter. And I don't think an Excel sheet has ever refused any number you end up actually feeding into it. And life doesn't work as a sort of linear equation for that matter. You can't just write 5 numbers, drag it to 20 and say, this is how I'm going to end up actually growing over time. So how would, given the fact that the theme of the event is, theme of this panel is also corporate governance too late, what is the role that entrepreneurs and what is the obligation and responsibility that entrepreneurs need to end up taking up on their table? Because investors can't be the only ones to end up blaming for that matter. Even the entrepreneur can decide, I want to build a 30-year business as opposed to a 5-year one. So they end up committing to a 5-year exit, which sort of exacerbates the entire problem for everyone involved.
Yeah. No, I think, I mean, that Vinod Khosla interview, right? As in after that, I was thinking of ourselves as investors, saying, what is the value that we bring on the table, right? As in, because I think what Khosla said in that interview is that operators can somehow bring more value. And I was thinking, as an operator in a company, what value do I bring to a new company? I mean, because everything that we did at Zerodha, I mean, I think for all successful business, right, it's a lot of happenstances, right? I mean, right place, right time is so important, right? So my advice on how we build Zerodha may not be really apt for someone else starting today, right? As in, so as an operator, me giving this advice, does it even help him or not? Is a question, right? As in, so I was thinking about it and I was like, what's the value we really bring on the table as someone who's done this is to set the expectations right? I mean, like the one thing I think, like one of the best things about my life is freedom that I have to say, and do what I want to say and do, right? And that's because, you set the expectations right across the board, right? And I think what happens is, I think this was a phenomenon of the last 4-5 years of Indian bull market in private space. Overselling got incentivized, right? As in if you, the kind of guys who raise money, if you look at it, they're actually good salespeople, right? I mean, a lot of investors have ended, funding people who can speak well, right? And who can sell a dream of sorts. And that's not, like, it's hard to, like you said rightly, right? As in putting up an Excel sheet and saying, dude, I'll get here at this pace. I mean, I usually, like there's this, a lot of the startups from the fintech space, the people who are building for capital markets, they come and say, Nitin, India has 3 crore people who are investing today actively. It'll be 30 crores in 5 years. I'm like, dude, what are you smoking? I'm like, where will 30 crores come in 5 years? So, and typically, yeah. So I think if right from day one of the business, if people think of this expectation as a long-term obligation, right? Because this what you said as an expectation, you are bound to it through the journey of your business. Like, it's like going on that first date and marrying someone, right? As in, what is that expectation you set on that first date, right? As in, and because then if you set the wrong expectation, it's going to be a bad marriage, right? There's no going around it. And you're absolutely right. I mean, this is one of the reasons why we talk about this actively as well, because today, I get a lot of credit for Zerodha being whatever it is. And trying to tell entrepreneurs at every stage, it's harder for people who already raised money, but we also, because of Rainmatic, get access to a lot of people who are just starting up. And the one advice I usually have for everyone is that you rather undersell versus oversell. I mean, and because if you oversell, then you're forced to, take decisions to meet that expectations that you've sold, and then you will have to end up compromising on a bunch of decisions you wouldn't have taken. And also this thing, about people who come to trade the markets also, the problem is the same. People think it's easy to, make money trading the stock markets, and people think it's easy to make money building a business. It's hard, as in it's like, I mean, it's probably like, I don't know if you heard Jensen's recent thing, on Acquired, the podcast, on NVIDIA, right? As in, when asked if he would do it again, he says he wouldn't. He
said no.
Right? Because I mean, it's so hard. I mean, would I do this again after everything that I've gone through over the last 20 plus years? Maybe not. I probably would go do well in my engineering college and get a job or something like that. If I have to redo this again, So yes, I think it's just, I think operators have to set the expectations right with new entrepreneurs saying it's hard, it's not easy to make money. Building a business, I usually, through the foundation, we work in the climate space, and every time I meet anyone, any scientist in this whole agriculture space, my question is there a way to grow a tree fast? Is there a way to grow a forest fast? You know, like I want, like, you know, in 3 years, can we have a, you know, can you restore a piece of land and grow like a, you know, like a biodiverse forest? And they're like, dude, you can take a tree, put some steroid, and you can grow one tree fast. But a forest is an interconnected system of like so many things, and this is not something that you can do it in 3-5 years. You know, and a business is like that. It's, you know, it's not one person sitting and doing one thing. You know, it's an interconnected kind of a system, and it's really extremely hard, and the chances of doing it and coming around successful is also very, very, very low. You know? So I think these are some things that, you know, people have to kind of, you know, anyone building a business has to kind of ingrain, you know, and not, like I said right at the start, I think look at everything as a risk and as an opportunity, and maybe think of the risk before you think of it as an opportunity.
No, so I think the analogy of a forest is fantastic, because I don't think capital can end up actually raising a forest quicker. It's the wrong kind of liquidity applied to the right kind of asset that ends up coming up with that. But the point you made on entrepreneurship, I think, is also fair. I think that's the reason why we've seen most of the founders end up being fairly young, because they don't know where they can go wrong, for that matter. So I think just being actually blind to some of the outcomes that you end up facing actually emboldens you to take those kind of bolder bets and to actually create that kind of value that comes in there. Given the fact that I think we have about 8.5 minutes left, the theme of this entire panel was actually startups and corporate governance. Is it too late? So the open-ended question to both the panelists as of now: what is the right time to end up instituting governance in a startup, for that matter? Is governance really a function of size or scale? Because startups accelerate through the entire business journey within a short span of time, courtesy of capital, as well as the high growth that's predicated in that. But the flip side of that is something that becomes part of corporate culture and corporate DNA becomes impossible to dislocate over time itself. So what would be your final thoughts on when should a startup end up instituting corporate governance? Or are there situations where the company becomes too large to end up actually instituting these kind of frameworks and these sort of guardrails that can end up creating value for everyone?
So, you know, I think it's, in my mind, I'm very clear that startup is serving a particular constituency and is solving a particular problem. And therefore, if you stick to the knitting, I think corporate governance is inherent. You cannot go wrong if you are serving your customer well, and you are therefore solving problems of potential conflicts in favor of your customer. So, you know, you have to get it right, because you are not extracting something which the customer is unaware of. So if we were to look at any startup, it's really the pressures that the startup gets from, I would say, the VC and the private equity saying that you need to grow 10 times faster. Then you start looking at the regulatory environment around you and say, this is so onerous, let me cut corners. So, you know, it's really a, set of, variables that a startup faces, and at each point you end up taking a decision which is always in favor of a quicker return. Now, that is really, I think, somewhere we need to sort of put part of the blame on, onerous regulations and the lack of ease of doing business. But I would really say that if a portfolio company wants to take 5 years more and therefore not invite a private equity on board, they probably might be better off. And therefore, having said that, a private equity has to come in with a very good understanding of what is corporate governance for that particular company, and therefore is infusing a greater amount of corporate governance rather than, eroding it.
Your thoughts?
Yeah, I think, if corporate governance is running a business in the right way, I think it should be from day one, right? I don't think there's anything early or late. As in, you should just do it right from the start, and it becomes easy. Then it becomes part of the culture. The other flip side here is that if you make corporate governance as a bunch of check marks, right, as in like a tick boxes, I think you then potentially start doing something like what regulators tend to do, right, which is kind of stifle innovation, right? Because these tick boxes then become about, it slows decision-making process. See, at the end of the day, I think in today's world, it's about the fast beating the slow. There is no status quo, like you can, get disrupted anytime, right? So like the way we think about Zerodha is that if we are slow in the way we are thinking about our decisions, you will, someone will do to us what we did to someone else. It's just that, we'll probably be irrelevant very quickly. So how do you, I think for entrepreneurs, thinking about this is that you have to do it well, but also you need to make sure that your decision-making process doesn't end up taking time. Like we deal with banks, right? I mean, it's so slow. I think today banks in India are just covered by the fact that becoming a bank is so hard, right? If not for that, I think, banking in India would get disrupted, so it's that, I think here, I think as an entrepreneur, like I said, it's about risk to reward. I think we need entrepreneurs to prioritize long-term versus short-term, like what Sir rightly said. And that'll probably happen if investors are aligned with the vision. Two is to look at everything as a risk, but not slow the business down. I think this is something that as a founder I keep thinking about it, is that if tomorrow morning I am not the CEO of this business and we end up hiring someone, if I'm always constantly saying think about it as risk to reward, what if he just prioritizes risk and doesn't look at anything as an opportunity? Then I don't know. I mean, I don't know the answer. Probably as I grow more and I'll probably have an answer to this question, but I don't know what is the right mix there. As long as your founder mindset, you're going to look at everything as risk to opportunity. But as soon as you put executives on board, either they potentially go only as opportunity or look at everything as a risk. How do you make sure they look at it as a right balance? I mean, I don't have an answer to that, but this is something I keep thinking about it, because I'm like, what if tomorrow morning I get up and I don't want to be the CEO of this company, right? Like what happens then?
No, that's actually a fantastic way to end up actually putting it, because I think ultimately with great capital comes great responsibility, but also great liability for that matter, to end up returning that. Because I think it's also contingent on the entrepreneur to end up actually deciding a value that they can end up actually growing into, rather than investors holding them accountable to say, look, this is the valuation you promised me, here's your deviation from your plans as 70, 80, 90%, how are you going to grow into it? So that kind of pressure ends up becoming a self-fulfilling prophecy, because the moment you seek a high valuation, there are much higher obligations to end up actually delivering upon that kind of valuation, end up actually growing into it itself. So it becomes a sort of very weird, in physics it's something known as a three-body problem, where for a two-body problem it's very easy to end up figuring out and calculating the forces and end up applying to it. But the moment it becomes a three-body problem for that matter, it is impossible to figure out all the forces that end up actually acting upon that entire system. And if you look at startups also as of now, you have fund managers on one particular side, you have the entrepreneurs on the other, and in the last you end up actually having regulation, where each one ends up actually pointing the finger. It's one like the old Spider-Man meme. Everyone points the finger at the other person. No one knows who's right, no one knows who's wrong. But I think the important part is to actually take a collective decision to make sure that be transparent when it actually comes down to it, be accountable for every decision that you make. No one has a gun to your head to say you have to grow at 100% month on month or year on year or anything else like that particular matter. If you do require more time, be mature about it, be transparent about it, as Nitin actually said, and make sure you end up actually finding the right kind of investors to match your kind of business model to end up actually doing about. So I think with that, we can actually bring this entire session to an end as of now. We do have 1 minute, 55 seconds for that matter, but I think since lunch is fairly imminent, never be the person between an audience and lunch. I've actually learned that sitting in the audience itself. So with that, I'd like to draw this entire session to a conclusion. Thank you very much, Mr. Raman. Thank you very much, Nitin. Hope you feel better. Hope you feel better over time also for that. I hope this is not reflective of the current market for that matter. You don't fall sick when the market goes sideways.
There is no winter. There's a lot of money available in the country.
That is true. That is true. I think the winter is also waiting for people to, you're looking for the right opportunity rather than just running through inertia. So I think that's also circumspect, and it's an important aspect to keep in mind for investors for that. So thank you very much.
Thank you very much, sir, for those deep insights into the world of startups. We actually heard violins in the middle, which means that everybody was falling in love with what you all were saying. All right, well, now, ladies and gentlemen, to do us the honors, we're now going to welcome on the stage Mr. Damodaran to kindly do us the honors once again. Ladies and gentlemen, these mementos are truly special because they're caricatures of our speakers, our panelists. Our moderator, ladies and gentlemen, put your hands together. Thank you so much, Mr. Pai. Thank you. We'd like to thank Mr. S. Raman. Thank you very much. There's also a certificate there for 10 trees that are going to be planted in your name in the Sundarbans. And we'd like to also thank Mr. Nitin Kamath. Ladies and gentlemen, thanking our panelists. We're going to request you to join us for lunch, which is on the second level. So you move one level up, move on over to Orloff and Cullivan. Enjoy lunch. We're going to start the next session at 2:35. So ladies and gentlemen, requesting your presence back here, 2:35 for the next session.
मैं गर्मी हूँ, भयंकर गर्मी।
मैं अभी आया।
अरे बैठना यार, किधर जा रहा है?
ब्लू स्टार इन्वर्टर एसी का फास्ट कूल टेक्नोलॉजी, गर्मी की छुट्टी। ब्लू स्टार।
जरा देखेंगे, मेरा टायर हो गया बस्ट। अनिल हो या सुनील, पर पेमेंट फास्ट। ओहो। आई मोबाइल पे ये इन क्यूआर कोड्स पे चलेगा? आईसीआईसीआई बैंक का आई मोबाइल पे सारे क्यूआर कोड्स पे चलेगा। अंकल, किसी भी बैंक के अकाउंट को लिंक करो और किसी भी क्यूआर कोड पे पे करो। करो पे विद आई मोबाइल पे।
त्योहार है, घर में नया फर्नीचर ले आते हैं।
तो दीवारों में मैचिंग कलर भी तो करना होगा।
यहाँ एसी भी तो लगना चाहिए।
HDFC बैंक एक्सप्रेसवे आ गया है ना।
अब इतना कर ही रहे हैं तो दुकान में नई मशीन भी लगवा लेते हैं।
सबके चेहरे पे रौनक लाते हैं। इस फेस्टिव ट्रीट्स जो चाहिए जल्दी से लेके आते हैं। अब इस त्योहार नो इंतजार, HDFC बैंक लाया है एक्सप्रेसवे, जहां मिलेंगे लोन्स, न्यू अकाउंट्स, कार्ड्स और उन पे ऑफर्स भी झट से।
फिक्स डिपॉजिट खोल दूं?
नहीं यार, सेविंग्स अकाउंट।
FD is better. FD मतलब हायर इंटरेस्ट बेबी।
सेविंग्स अकाउंट मतलब पैसा। पास में बेबी। सेविंग्स अकाउंट।
हाई इंटरेस्ट से तकलीफ है क्या?
FD तोड़ने की पेनल्टी से तकलीफ है।
FD
सेविंग्स अकाउंट।
कोटक एक्टिव मनी, अब FD वाला इंटरेस्ट सेविंग्स अकाउंट में up to 7% per annum। एक्टिव मनी।
XUV 700. Man comes in front, XUV stops. Automatically.
Gorilla comes and the car stops? Zombie comes and the car stops?
Yeah.
My father-in-law?
Mm-hmm.
Why?
XUV 700 with ADAS brake assist. You drive it and they just talk about it. Mahindra SUVs.
Check this. Hello, check. Hello, check.
The future belongs to those who believe in their dreams. A dream to create. A dream to grow. Every dream is a seed waiting to be nurtured. And today, SIDBI is supporting growth of the ecosystem which nurtures these dreams. planting a bright future for India, where sky is the limit.
A vision becomes a milestone when it helps make our lives richer with love and laughter. When it helps make a cleaner, smarter, and a more beautiful planet. So that you can set off on joyous new journeys and adventures. Building stronger bonds and bridging impossible distances, which take you from the ever new to the forever beautiful. Opening up vistas and windows to a vibrant new world. A vision becomes a milestone when it touches millions of lives. Aditya Birla Group, big in your life.
What? हर महीने नया इंटरेस्ट, लास्ट मंथ पॉटरी, इस मंथ डीजिंग।
अरे यार, अगर हर महीने इंटरेस्ट मिलता रहे तो हर महीने कुछ इंटरेस्टिंग होना चाहिए कि नहीं? क्योंकि मेरा बैंक जो है वो मेरी तरह, सॉरी तुम्हारी तरह है, यंग एंड फ्रेंडली।
आपकी तरह। आपकी तरह। जैकेट?
लिया।
चार्जर?
लिया।
करेंसी?
अरे यार, रोम में सिर्फ रोमिंग होनी चाहिए, इसलिए मेरा फर्स्ट पॉप क्रेडिट कार्ड लेता है फॉरेक्स के लिए 0 चार्जेस।
वाह नानू, 0 चार्जेस।
लेट्स गो। क्योंकि मेरा बैंक भी है मेरी तरह, सॉरी तुम्हारी तरह यंग एंड फ्रेंडली।
आपकी तरह।
तुम्हारी तरह यंग एंड फ्रेंडली।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
मैं गर्मी हूँ, भयंकर गर्मी।
मैं अभी आया।
अरे बैठना यार, किधर जा रहा है?
ब्लू स्टार इन्वर्टर एसी का फास्ट कूल टेक्नोलॉजी, गर्मी की छुट्टी। ब्लू स्टार।
अरे अनिल कपूर, जरा देखेंगे, मेरा टायर हो गया बस्ट। अनिल हो या सुनील, पर पेमेंट फास्ट। ओहो, आई मोबाइल पे ये इन क्यूआर कोड्स पे चलेगा? आईसीआईसीआई बैंक का आई मोबाइल पे सारे क्यूआर कोड्स पे चलेगा। अंकल, किसी भी बैंक के अकाउंट को लिंक करो और किसी भी क्यूआर कोड पे पे करो। करो पे विद आई मोबाइल पे।
त्योहार है, घर में नया फर्नीचर ले आते हैं।
तो दीवारों में मैचिंग कलर भी तो करना होगा।
यहाँ एसी भी तो लगना चाहिए।
HDFC बैंक एक्सप्रेस वे आ गया है ना।
अब इतना कर ही रहे हैं तो दुकान में नई मशीन भी लगवा लेते हैं।
सबके चेहरे पे रौनक लाते हैं। इस फेस्टिव ट्रीट्स जो चाहिए जल्दी से लेके आते हैं। अब इस त्योहार नो इंतजार। HDFC बैंक लाया है एक्सप्रेस वे, जहाँ मिलेंगे लोन्स, न्यू अकाउंट्स, कार्ड्स और उनपे ऑफर्स भी झट से।
फिक्स डिपॉजिट खोल दूं?
नहीं यार, सेविंग्स अकाउंट।
FD is better. FD मतलब हायर इंटरेस्ट बेबी।
सेविंग्स अकाउंट मतलब पैसा पास में बेबी। सेविंग्स अकाउंट।
हायर इंटरेस्ट से तकलीफ है क्या?
FD तोड़ने की पेनल्टी से तकलीफ है।
FD
सेविंग्स अकाउंट।
कोटक एक्टिव मनी। अब FD वाला इंटरेस्ट सेविंग्स अकाउंट में up to 7% per annum।
एक्टिव
मनी।
XUV 700. Man comes in front, XUV stops. Automatically.
Gorilla comes and the car stops? Zombie comes and the car stops?
Yeah.
My father-in-law?
Mm-hmm.
Why?
XUV 700 with ADAS brake assist. You drive it and they just talk about it. Mahindra SUVs.
The future belongs to those who believe in their dreams. A dream to create, a dream to grow. Every dream is a seed waiting to be nurtured. And today, SIDBI is supporting growth of the ecosystem which nurtures these dreams, planting a bright future for India, where sky is the limit.
A vision becomes a milestone when it helps make our lives richer with love and laughter. When it helps make a cleaner, smarter, and a more beautiful planet. So that you can set off on joyous new journeys and adventures. Building stronger bonds and bridging impossible distances, which take you from the ever new to the forever beautiful. Opening up vistas and windows to a vibrant new world. A vision becomes a milestone when it touches millions of lives. Aditya Birla Group, big in your life.
क्या नानू?
What?
हर महीने नया इंटरेस्ट, लास्ट मंथ पॉटरी, इस मंथ डीजिंग।
अरे यार, अगर हर महीने इंटरेस्ट मिलता रहे तो हर महीने कुछ इंटरेस्टिंग होना चाहिए कि नहीं? क्योंकि मेरा बैंक जो है वो मेरी तरह, सॉरी तुम्हारी तरह है, यंग एंड फ्रेंडली।
आपकी तरह। आपकी तरह। जैकेट
लिया।
चार्जर
लिया।
करेंसी।
अरे यार, रोम में सिर्फ रोमिंग होनी चाहिए, इसलिए मेरा फर्स्ट पॉप क्रेडिट कार्ड लेता है फॉरेक्स के लिए 0 चार्जेस।
वाह नानू, 0 चार्जेस।
लेट्स गो। क्योंकि मेरा बैंक भी है मेरी तरह, सॉरी तुम्हारी तरह यंग एंड फ्रेंडली।
आपकी तरह।
तुम्हारी तरह यंग एंड फ्रेंडली।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
मैं गर्मी हूँ, भयंकर गर्मी।
मैं अभी आया।
अरे बैठना यार, किधर जा रहा है?
ब्लू स्टार इन्वर्टर एसी का फास्ट कूल टेक्नोलॉजी, गर्मी की छुट्टी। ब्लू स्टार।
जरा देखेंगे, मेरा टायर हो गया बस्ट।
अनिल हो या सुनील, पर पेमेंट फास्ट।
ओहो। आई मोबाइल पे ये इन क्यूआर कोड्स पे चलेगा? आईसीआईसीआई बैंक का आई मोबाइल पे सारे क्यूआर कोड्स पे चलेगा। अंकल, किसी भी बैंक के अकाउंट को लिंक करो और किसी भी क्यूआर कोड पे पे करो पे विद आई मोबाइल पे।
त्योहार है, घर में नया फर्नीचर ले आते हैं।
तो दीवारों में मैचिंग कलर भी तो करना होगा।
यहाँ एसी भी तो लगना चाहिए।
HDFC बैंक एक्सप्रेसवे आ गया है ना।
अब इतना कर ही रहे हैं तो दुकान में नई मशीन भी लगवा लेते हैं।
सबके चेहरे पे रौनक लाते हैं। इस फेस्टिव ट्रीट्स जो चाहिए जल्दी से लेके आते हैं। अब इस त्योहार नो इंतजार, HDFC बैंक लाया है एक्सप्रेसवे, जहां मिलेंगे लोन्स, न्यू अकाउंट्स, कार्ड्स और उन पे ऑफर्स भी झट से।
फिक्स डिपॉजिट खोल दूं?
नहीं यार, सेविंग्स अकाउंट।
FD is better. FD मतलब हायर इंटरेस्ट बेबी।
सेविंग्स अकाउंट मतलब पैसा। पास में बेबी। सेविंग्स अकाउंट।
हायर इंटरेस्ट से तकलीफ है क्या?
FD तोड़ने की पेनल्टी से तकलीफ है।
FD
सेविंग्स अकाउंट।
कोटक एक्टिव मनी। अब FD वाला इंटरेस्ट सेविंग्स अकाउंट में up to 7% per annum.
एक्टिव
मनी।
XUV 700. Man comes in front, XUV stops. Automatically.
Gorilla comes and the car stops? Zombie comes and the car stops?
Yeah.
My father-in-law?
Mm-hmm.
Why?
XUV 700 with ADAS brake assist. You drive it and they just talk about it. Mahindra SUVs.
The future belongs to those who believe in their dreams. A dream to create, a dream to grow. Every dream is a seed waiting to be nurtured. And today, SIDBI is supporting growth of the ecosystem which nurtures these dreams, planting A bright future for India, where sky is the limit.
A vision becomes a milestone when it helps make our lives richer with love and laughter. When it helps make a cleaner, smarter, and a more beautiful planet. So that you can set off on joyous new journeys and adventures. Building stronger bonds and bridging impossible distances, which take you from the ever new to the forever beautiful. Opening up vistas and windows to a vibrant new world. A vision becomes a milestone when it touches millions of lives. Aditya Birla Group, big in your life.
क्या नानू?
What?
हर महीने नया इंटरेस्ट, लास्ट मंथ पॉटरी, इस मंथ डीजिंग।
अरे यार, अगर हर महीने इंटरेस्ट मिलता रहे तो हर महीने कुछ इंटरेस्टिंग होना चाहिए कि नहीं? क्योंकि मेरा बैंक जो है वो मेरी तरह, सॉरी तुम्हारी तरह है, यंग एंड फ्रेंडली।
आपकी तरह। आपकी तरह। जैकेट
लिया।
चार्जर
लिया।
करेंसी।
अरे यार, रोम में सिर्फ रोमिंग होनी चाहिए, इसलिए मेरा फर्स्ट पॉप क्रेडिट कार्ड लेता है फॉरेक्स के लिए 0 चार्जेस।
वाह नानू, 0 चार्जेस।
लेट्स गो। क्योंकि मेरा बैंक भी है मेरी तरह, सॉरी तुम्हारी तरह यंग एंड फ्रेंडली।
आपकी तरह।
तुम्हारी तरह यंग एंड फ्रेंडली।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
मैं कर्मी हूँ, भयंकर कर्मी।
मैं अभी आया।
अरे बैठना यार, किधर जा रहा है?
ब्लू स्टार इन्वर्टर एसी का फास्ट कूल टेक्नोलॉजी, गर्मी की छुट्टी। ब्लू स्टार।
अरे अनिल कपूर, जरा देखेंगे, मेरा टायर हो गया बस। अनिल हो या सुनील, पर पेमेंट फास्ट। ओहो, आई मोबाइल पे ये इन क्यूआर कोड्स पे चलेगा? आईसीआईसीआई बैंक का आई मोबाइल पे सारे क्यूआर कोड्स पे चलेगा। किसी भी बैंक के अकाउंट को लिंक करो और किसी भी क्यूआर कोड पे पे करो। करो पे विद आई मोबाइल पे।
त्योहार है, घर में नया फर्नीचर ले आते हैं।
तो दीवारों में मैचिंग कलर भी तो करना होगा।
यहाँ एसी भी तो लगना चाहिए।
HDFC बैंक एक्सप्रेसवे आ गया है ना।
अब इतना कर ही रहे हैं तो दुकान में नई मशीन भी लगवा लेते हैं।
सबके चेहरे पे रौनक लाते हैं। इस फेस्टिव ट्रीट्स जो चाहिए जल्दी से लेके आते हैं। अब इस त्योहार नो इंतजार, HDFC बैंक लाया है एक्सप्रेसवे, जहां मिलेंगे लोन्स, न्यू अकाउंट्स, कार्ड्स और उन पे ऑफर्स भी झट से।
फिक्स डिपॉजिट खोल दूं?
नहीं यार, सेविंग्स अकाउंट।
FD is better. FD मतलब हायर इंटरेस्ट बेबी।
सेविंग्स अकाउंट मतलब पैसा। पास में बेबी। सेविंग्स अकाउंट।
हाई इंटरेस्ट से तकलीफ है क्या?
FD तोड़ने की पेनल्टी से तकलीफ है।
FD
सेविंग्स अकाउंट।
कोटक एक्टिव मनी। अब FD वाला इंटरेस्ट सेविंग्स अकाउंट में up to 7% per annum।
एक्टिव
मनी।
XUV 700. Man comes in front, XUV stops. Automatically.
Gorilla comes and the car stops? Zombie comes and the car stops?
Yeah.
My father-in-law?
Mm-hmm.
Why?
XUV 700 with 8S brake assist. You drive it and they just talk about it. Mahindra SUVs.
The future belongs to those who believe in their dreams. A dream to create, a dream to grow. Every dream is a seed waiting to be nurtured. And today, SIDBI is supporting growth of the ecosystem which nurtures these dreams, planting A bright future for India, where sky is the limit.
A vision becomes a milestone when it helps make our lives richer with love and laughter. When it helps make a cleaner, smarter, and a more beautiful planet. So that you can set off on joyous new journeys and adventures. Building stronger bonds and bridging impossible distances, which take you from the ever new to the forever beautiful. Opening up vistas and windows to a vibrant new world. A vision becomes a milestone when it touches millions of lives. Aditya Birla Group, big in your life.
What? हर महीने नया इंटरेस्ट, लास्ट मंथ पॉटरी, इस मंथ डीजिंग।
अरे यार, अगर हर महीने इंटरेस्ट मिलता रहे तो हर महीने कुछ इंटरेस्टिंग होना चाहिए कि नहीं? क्योंकि मेरा बैंक जो है वो मेरी तरह, सॉरी तुम्हारी तरह है, यंग एंड फ्रेंडली।
आपकी तरह। जैकेट
लिया,
चार्जर
लिया।
करेंसी।
अरे यार, रोम में सिर्फ रोमिंग होनी चाहिए, इसलिए मेरा फर्स्ट पॉकेट क्रेडिट कार्ड लेता है फॉरेक्स के लिए 0 चार्जेस।
वाह नानू, 0 चार्जेस।
लेट्स गो। क्योंकि मेरा बैंक भी है मेरी तरह, सॉरी तुम्हारी तरह यंग एंड फ्रेंडली।
आपकी तरह।
तुम्हारी तरह यंग एंड फ्रेंडली।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back, ladies and gentlemen. Inviting you to kindly take your seat. The next session in the main ballroom is about to begin. Planning for a better planet. Ladies and gentlemen, we request your presence as we look forward to welcoming our panelists on stage. Welcome back, ladies and gentlemen. Thank you so much for your presence back here this afternoon. We hope you enjoyed lunch and, of course, a good conversation. There was so much to take back in the first half of today. But it's time now for us to step forward into another topic, another discussion that's going to unfold on stage. Our next session is Planning for a Better Earth. And it is rightly said that every generation has the responsibility to leave the planet a better place than the one we inherited. With ESG moving center stage, responsible corporate citizenship is beginning to manifest itself. Ladies and gentlemen, in traveling on this path are the financial aspects of doing business, getting adequate attention, or are stakeholder interests being sacrificed in the process of trying to look good? Welcoming on the stage our panelists, ladies and gentlemen, join me in doing the honors. We welcome our first panelist, Mr. Chandru Badrinarayan. Welcome, sir. A loud round of applause as we welcome on the stage Mr. Chandru Badrinarayanan is the Chief Operating Officer of Blue Sky Analytics, a new age climate technology firm converting satellite data into actionable climate data sets. He has over 35 years of experience across sustainability, ESG, climate change, investments, risk management, credit ratings, and banking. He was previously managing partner at eCube Investment Advisors, Country Head India, an ESG research leader at MSCI, and a senior director at CRISIL. He is also a member of the Global Policy and Reference Group of UNPRI. Ladies and gentlemen, our first panelist right here with us on stage. Good afternoon, sir, Mr. Chandru Badrinarayanan. Joining us next is our panelist, Mr. Govind Sankaranarayanan. Welcome, sir. Thank you for joining us. A loud round of applause as he joins us on stage. Is presently co-founder and chief operating officer of EcoFi, a pioneering climate finance NBFC. He was for 27 years with the Tata Group and led teams in India, UK, US, and Canada. For much of the past decade, he was the group COO and CFO at Tata Capital and helped to considerably scale up the business. He was also the global CFO of Tata Communications, a New York Stock Exchange listed company. He has also been a board advisor to several fintechs. Ladies and gentlemen, please put your hands together for Mr. Govind Sankaranarayanan. Welcome, sir. And our third panelist, Mr. Jamil Khatri, joins us on stage. Is the co-founder and CEO of Uniquis Consultech, a tech-enabled global platform which offers ESG and accounting and reporting consulting. Prior to this, he headed the accounting advisory practice of KPMG globally, the only professional within the Big Four to head a global business unit from India. While with KPMG, he also headed the US GAAP and the SEC practice. He has assisted several Indian companies in transitioning to international accounting practices and in meeting their financial reporting and governance obligations for overseas listings. Ladies and gentlemen, put your hands together, Mr. Jamil Khatri. Our moderator for this session, please, we're going to hand over to you, sir. Mr. Govind Sankaranarayanan takes this session forward, opens it. Sir, all yours.
Thank you. So, everyone, welcome back after lunch. We've had the privilege, I think, of seeing some excellent sessions, most recently the session on governance and startups. So the challenge I think all of us have is of making this session lively and interesting, it being the post-prandial session, so to speak. ESG is arguably one of the most written about acronyms, at least of the last decade. And the challenge with something being written about quite so much is that there is a level of skepticism and fatigue that gets created when one discusses this. As it happens, this is also a, it's an area which is dealt with within the business context, and frequently there are question marks around its utility. So I want to sort of try to sort of moderate this session in a way where we address some of the ESG questions as directly as possible, avoiding the temptation of skirting, of sort of fussing around the difficult questions. First, I'm going to request our panelists to give me some examples of where ESG actually works, because there are people who believe that it makes no difference. So, it'd be useful to know from people who are operators in that space about how it works. For something in a business context to work, it's also important to measure how it works. And I think that is where both of our panelists, both Chandru as well as Jamil, have a lot of expertise in telling us how we can measure it and therefore prove that some of these things actually make a difference and also work. It's not sufficient, I suppose, to know that ESG and the various elements that it comprises is useful. It's also necessary for people to be able to manage that process. One way, of course, is to rely on the goodness of people's sort of character and conscience, and to simply hope that there are enough good people on boards. But I think what we want to also discuss is systematically what could board members, many of whom are here in the audience, proactively do in order to ensure and enhance ESG across the companies. I think it's also important to address some of the very, very relevant questions that have been raised about the utility of ESG. Are we in some way depriving legitimate financial shareholders of something that they bought into by talking about ESG? Most investors would agree that they didn't sign up for the welfare of lots of other stakeholders. They signed up for their own returns. And this view is now widely being discussed in other parts of the world, notably in the US. Some academics, for instance, have had strong views on the subject and so on. There is also a view that ESG is a kind of tariff barrier. I mean, even the Indian government has sort of been hinting darkly at it on occasion by suggesting that, look, if you have a cross-border mechanism, I have a carbon tax, and things like that. So I'd like us to also be able to discuss some of this and see, whether while companies are addressing some of these emission-related issues, is it widespread enough to address a tariff kind of situation? In particular, nearly 2/3 of all emissions, which is an important part of the E part of ESG, takes place in the SME space, and our Indian SMEs geared up for it. And of course, finally, once we go through all of this, we hope that we can come with some conclusions which has led to everyone being a little more informed than they were before the session. So, Jamil, you've been in KPMG, a very distinguished auditor for most of your career, and now, of course, with Unicus, you are advising people on ESG. Some people believe in it, so some of the larger groups, I think now it's well entrenched. But what would be great is to understand from you some instances where you have actually been able to demonstrate line of sight of the value that an E or an S particularly, or even a G, but G I think I take for granted, E and S brings to the table. So where you can actually go to the CFO of the company and say, if you do this, I think you will have on the round better results, and you can actually go and talk about it to analysts or to your shareholders. And in fact, they can hold you to account. So it would be great to hear from you what you've seen, what you've actually been able to implement somewhere.
Awesome. So first of all, thank you. And maybe I'll just set a little bit, go in the context to this before I respond to that. I was reflecting on the session theme, which is planning for a better planet. Like all good things in life, the question is who will pay for it actually? So of course we all want to plan for a better planet, but this takes a lot of money. I don't know how many of you track this area, but there are estimates that if we really had to achieve the carbon targets which all very well informed bodies have set for the planet, it will cost $275 trillion to deliver that, right? Over the next 30 years. You cut the math, maybe a few trillions go off, stuff. And the way I look at it is, who are the actors who can pay for this actually? Actor number one, consumer. I think if we think consumers are going to pay just because something is a sustainable product, I don't think people have understood how this game is played. I work with a fashion retailer in Europe, and they tell me that the kids buy these t-shirts, they buy it for $11 in that market. If they had to make that same t-shirt using sustainable, truly sustainable means, which will get them to what we call zero carbon or whatever, it'll cost $38 actually, right? No kid is paying $38 for an $11 t-shirt. So customers, knock them off, not paying. Government's paying. Actually, if you look at the state of all government finances today, it's not in a state where any government effectively will be able to pay the cost of doing this out. Development financial institutions, you say there's World Bank, there's IFC, all of these institutions have been given this really nice mandate of funding the transition in some manner. Middling. I wouldn't write them off completely, but not a big fan. Who's left? Corporates. Number 4, right? So I think what is going to happen in my mind is, before I respond to what you asked, Govind, I think companies will realize that if the world has to solve this problem, and there are many parts of the world that believe there is no problem to be solved. I don't know how many of you follow the United States. I do a lot of work in the US. It's a split house out there. The Republicans believe climate change is not happening. The Democrats believe something else altogether. So the limited point I'm making is that I think if we have to genuinely deliver on this, whether by a choice or whether by regulation, companies will have to deliver on this. So that's the first thing I think I would like the group to reflect on. Happy to be challenged. If there's a fifth person, keep God out of this, but that's not happening. But out of these 4, we have to pick one who will pay for it. I think then the second layer is what you said is it a risk or is it an opportunity or is it both? And I think the truth is it is both actually. I think from a risk perspective, if I can just touch upon that first, Govind, I think clearly regulators, because of what I described, are putting pressure on companies to disclose as much as possible so that they are held accountable by different people. In India, we had 2 SEBI kind of members in the morning. As you may know, sustainability data on what is called the Business Responsibility Sustainability Report is required to be audited for the top 150 companies. I don't know how many of you know, India is the first country in the world that's mandated that. There's no other country that requires that. Not even the EU, not Europe, none of that, right? So the reason I'm highlighting this is I think regulators will force companies to disclose more, which then exposes them to 3 different risks at play out here. First is investors. I think anybody who's been in a corporate role as an executive will realize that investors are putting a lot of I work for a colleague of yours from your past organization. They said they used to have an ESG 1 slide in a 25-page slide deck on ESG. 11 out of 25 pages are now on ESG, right? So you will have to adhere to, and you may lose investors who actually, for whatever reason, right or wrong, don't believe in the philosophy with which, with the way the company look at sustainability. So it's a pool of capital issue. Lenders are getting much more kind of impacted by that as well, right? And the third part is customers. We know, for example, I don't know how many of you are from the IT services industry here, but I know RFPs where clients have said that if you do not have a ESG plan and a program, you're not eligible to bid for an RFP. Now that's as bad as it gets from a risk perspective. So what are the opportunities here? I think each of these risks actually in my mind translates into a type of an opportunity. And what are we seeing in practice? We are working right now for a very big home textile company where their biggest customer is an American retailer. The way they see it is if they have invested in sustainability and they have a well thought through ESG program, it's not necessary that they will get $1 more in terms of supplying to that customer. But when that customer, when that retailer looks at the supply chain, to look at the emissions and look at which are those kind of vendors and partners who have best in class ESG, they will gain from that. And in fact, that's what has happened. Their asset utilization has improved because many other kind of partners in the supply chain don't have an ESG program or a sustainability program which is in line with what this company may have. So that's something that I think a lot of companies are looking at, that how do you get an advantage in the supply chain? It all depends on who your customers are. You know, we are in discussions with a South-based a contract manufacturer for a European automobile company, same consideration. How do we make ourselves more relevant to the supply chain? I think the other area from an opportunity perspective that we see is genuinely if you have a well thought through path, you'll realize that there are enough energy efficiency opportunities. Renewable today is not just about sustainability, and Govind, you know this. Renewable is as much about operational and energy efficiency. So how do you really have decarbonization programs that help in cost reduction, help in operational efficiency? We're seeing a lot of that. We're seeing a lot of companies through this journey adopt low carbon technologies actually, and that's again something you could innovate, you could kind of improve upon that. And finally, I think green finance. There are enough pools of capital available for people to have programs which effectively help you work in the power sector, where somebody has got financing for dismantling an old power plant before the useful life, effectively funded by a development agency, which then helps them to move to a more renewable source of power, which has its own kind of benefits, right, from a generation perspective. So I think there are many examples here, but I would actually step back for every company to really say, what are the risks and opportunities for our business? What is material to us? And then what do we do to play that to our strength? Actually? So, and would love to kind of build on that, but yeah.
So I think, Jamil, that's extremely helpful. It's good. I think you have articulated some very good points. I agree with you fully that if you sort of go directly to customers and ask them to pay more for a t-shirt and so on, this is unlikely to happen. Correct. But what we are seeing, for instance, and in ECO5, which is an Indian government-funded climate financial institution, which I currently lead, we do see two things. One is there is clearly a mindset change among millennials. So there is a much greater degree of desire to be somewhat sustainable, maybe not at any cost, but at some cost. So the significant sort of interest that you see in the electric vehicle business, for instance, is an example of that. The second point you made is, I would say, about the negative elements of ESG, which is you are going to lose business because some of the large companies are inevitably going to ask for this. What we do, for instance, in our business, where we do a lot of climate finance to SMEs, is to ensure that SMEs are adhering to at least the basic ESG requirements. So they don't have the ESG heavy that a top 1,000 company would have, but they still need to fulfill a minimum set of requirements around, say, non-discrimination, around avoidance of pollution control, around managing safety, some degree of sort of gender diversity and so on. And I want to bring Chandru in at this point, which is many of these are areas which appear soft. So, unlike financial accounts where you have, measurement systems which have been sort of devised from the time of the Renaissance, these are new things. Now, Chandru, in Blue Sky Analytics, you only do measurement to a very large extent, of things which are difficult to measure. So wanted to hear a little bit from you about, what you folks do, your view on ESG, and particularly the kind of things that you can measure so that, some of the people over here can go back and say, look, these things which we thought were just fuzzy actually can be measured, and these days with IoT and so on, some of this is actually measurable quite easily and hopefully at low cost.
Thank you, Govind. Govind and me, we were ex-colleagues, but he has promised that he is not going to make this session easy for me. So thank you for that question, Govind, and thanks, Jamil, for all your inputs and insights. I'm part of Blue Sky Analytics. It's an Indo-Dutch firm. We are in the business of converting satellite data into climate intelligence. What I mean by that is we monitor assets, we monitor different kind of climate parameters for air, land, water, and fire. We also produce high-frequency data, and physical risk data is something which everybody talks about, saying that there is not enough data. But we provide observed data. We observe, we calculate, and then we provide all this data. These are useful for many constituents, for banks especially, for financial institutions, and for actually, we were talking about trees. I think a lot of people here, the speakers were given actually said that 10 trees are being planted in Sundarbans. So we can actually monitor those, and we can actually show where these trees are. So those are the kind of things which we do through satellites. And satellites have different sensors. So it's been a very fascinating journey for me in actually understanding how satellites work, how these sensors work, and how these actually can lead to bridging the trust deficit between various stakeholders and lead to more efficient markets. So this is the angles from which we are working on, but at the same time the solutions will also have to be very economical for the users, clients, and it needs to be accurate. So these are the things which we are doing. For example, I can just show, can I get the slide on emissions, please? Okay, so this is from our platform. These are all our data sets and everything. Can you move to the next one? Okay, this is what we are doing. This is one of the parts which we do. So we are monitoring power plants across the world. The emissions from the power plant, and all the small dots and everything, you can actually see these are all power plants. Likewise, we can do cement, we can do steel, which does actually, all the cement, steel, and power plants. These contribute to 60% of the emissions. But leave aside this. So what we also do from this is we can actually tell you that what is the kind of emissions which are coming out of a chimney, what is the CO2, SOx, NOx, all these kind of things. Now, where does this help? This actually helps investors and so many other stakeholders in understanding whether there is greenwashing happening or not. Now, let me just take this example of a company is actually publishing its BRSR or whatever report it is. They say our scope 1 emissions this year is this many tons. And you just compare it with your previous annual report and say, okay, so between these two, whether the company has actually increased or decreased. But you don't get any insights other than that to understand whether this is the right emissions or if there are any other issues which are actually happening continuously on how this plant is operating. And this is a lot of use cases. One of the banks we are discussing with, they want to understand, because emissions are actually a proxy for manufacturing activity. So they want to understand, what exactly is happening when you're monitoring it on a day-to-day basis. So we can actually do this part. So this is one of the products, which we do. And this, is, as I said, has many use cases in actually understanding, what's happening. And this also is a part, where even corporates are trying to actually use this, because currently the way the emissions are calculated is you take the fuel consumed, you apply a GHG emission factor, and then you come out and say that this is the actually emissions which we have emitted. Now this is calculated emissions, this is not actual emissions. So actual emissions and calculated emissions can differ widely because of the grades of fuel you use. You don't get GHG emission metrics for all the grades of fuels. So when you do this, there is an approximation. There is an approximation again because of the boiler efficiency or the scrubber efficiency. And then the reporting can go haywire. So that is one of the reasons, what is it that which we do. We do similar kind of stuff for actually, next slide please. This is a interesting thing which I mentioned about the trees. So you want to understand, how many trees are there in a particular area. We can provide you precise tree counts using satellite imagery. Now this is again, plenty of use cases, because there are corporates who say that, okay, we have, and there are mining companies which need by regulation to actually, showcase what is the kind of greening which they do. Now most often the intention may be excellent, but down the line there are a lot of slip-ups. And people really don't know, they can't go counting, there are 1 lakh trees in a particular area. So this is something, which we can actually do. And not only that, we can go back in time. So this is a project we have done in Bali, where we have gone back in time for 20 years to show how this greening has actually happened across the, years. And we can do this, 20 years back, the satellites were not so much, but for the last 10 years, we can actually provide this data. And again, this is actually an excellent input in carbon markets, where there has been a big trust deficit. The markets have been actually having a big problem. So we are bridging the trust deficit, and we are actually working with also, we are trying to work with a Singapore government entity, where they are going to use blockchains for actually taking all this data and putting into that. And this is also going to lead to fractionalization of the market. Today, you can't sell carbon credits by fractions. So the liquidity of the market doesn't actually move up because of that. So these are the other use cases we have. We have many other use cases like, we can monitor the pollution and say that which is the plant which is emitting or, which is actually, polluting a water body. So we can give 4 parameters there: turbidity, carbon dissolved matter, organic matter, and carbon monoxide or something like that. So there are 4 parameters which we can find out, and we can do this part. We monitor reservoirs. Can you just go through the next slide, please? I'll just end very quickly. Okay, so this is actually Tungabhadra Reservoir, and this is for 3 years. This gives a lot of data about, actually what's happening in that water body there. We do this for actually across the world. And whether it's a lake or whether it's a reservoir, we can actually continuously, provide this data. Many use cases to see for the reservoir or for the hydropower generator itself. But banks are also now trying to see what could be the credit stress in that vicinity if there is an actually water scarcity like this. Likewise, we are doing for real estate. We are actually able to measure the floor space, the height. We are able to do for roads and tell you how many potholes are there in a road and whether it can have a flood risk and everything. So many use cases like that.
Good. So I think Chandru, that is, sorry, go ahead. Yeah, go ahead, Chandru.
Yeah, I think I want to just I want to step back a little bit here. This is just one part of the data problem actually. I think the bigger issue, which I think companies and board members here might want to think about, is that if you look at the information on sustainability, on ESG that companies are putting out, is the rigor on that data the same as you would put in your financial data actually? Yeah, I think that's the big question, honestly. Yeah, we just to share an example, I was with a fuel cell technology company in the Bay Area, where the product itself is green, and they've been putting out a lot of disclosure over time. And the chairman of the audit committee, many of you folks may be, called the chief internal auditor and said, "What work has internal audit done on all of this information we're putting out?" She said, "Nothing," because that is sustainability department's problem actually. Finance is different, CFO is different, controller is different, and I think the broader question really is that what is the integrity and rigor on data that is going into all of our ESG and sustainability reporting? These are tools, there are many tools, right? But I think the important part, actually I would leave for the group is, if you're involved with a company, whether as a preparer, as a management, or as this thing, how do you get comfort on data integrity is something that I just wanted to highlight.
So I think, the challenge here is the following. Data is cheap. Taxonomies are cheaper still.
Yeah.
So, whether it is GRI or PRI or SASB or, the IFC protocols or whatever, this, and each person looks at the ESG issue from a different lens, a different slice. And if you ask each of them, they would, I suppose, justify, at least justifiably for themselves, say that theirs is the best and most of the others are pretty useless.
Correct.
This is not very helpful for boards of directors. So if you are sitting on a board and you kind of just about understand the business, and then you have to, you have the necessary responsibilities of signing off on the accounts and so on, you need someone to dumb the stuff down for you.
Yeah.
There are 2 ways to do it, or 3 ways actually. One is scoring, which is not meaningless, but is very difficult to interpret. The other is again to have a taxonomy of some sort and get a certification. And the third is for someone to explain this stuff in English.
Yeah.
And to say, guess what, if we don't move to electric, 90% of the market will not be with us. And if that 90% isn't with us, guess what? My revenue will fall from, 100 billion to 10 billion. It's the last one which is very rarely spoken of. It's very difficult to find somebody on making an ESG case. Now, similarly, that let's talk of S, for instance. Even more difficult to sort of fathom. Now, there is widespread lip service paid to the fact that you need more women in the workplace, on boards and so on. But especially on the front line, actually, you just don't see them in banking and so on. Now, no one has ever told me, and I'm sure studies would exist, and I'm sure companies can take the trouble to do that, to say, look, if I had more women in wealth management or relationship management, I'd get more business. So if I had more women, or at least I would have lesser frauds, which is also seen to be sort of common when you have sort of more diversity in the workplace. What do you have to say about that? I mean, because the usual response to this is always, let's get some kind of score because that feels objective.
Yeah.
But it also feels pretty useless sometimes.
Yeah.
So,
Yeah. I think, yes.
And how do you help boards, therefore, how do board members do, figure all of this out and actually call it out and tell the CEO that, I don't believe this.
Yeah.
It doesn't seem right. Otherwise, he has to accept, all the check boxes that the CEO has given.
Yeah. I think first thing we have to acknowledge is that the whole ESG space is where probably financial reporting was 30 years ago, actually. I think that's the honest truth. Everybody is trying to figure out what does this mean. The reporting frameworks, as you correctly said, are all over the place. If I even made up an acronym, nobody will know whether it's a made up acronym or a real acronym. Okay, TCFD is real, TNFD I don't know. Maybe you figure it out. But it's a mess right now. So I think the first thing is up to I think bodies are trying to get to a common ground, right? So that's the first part. I think where ratings help, in my mind, is it help to just put together an understanding of what are the different components which go into assessment of what is a sustainable company. Now, you may agree or you may disagree. I work with a port operator, and there's a rating called DJSI, the Dow Jones Sustainability Index, for those of you who know, and there's another rating called MSCI, your former organization. This company is scoring beautifully on DJSI. They're pathetic on MSCI, actually. So for the first kind of few weeks, there was all angst on why are we bad on MSCI. Everybody's blaming everybody. And the truth of the matter is, MSCI, and please do correct me, this is what my team told me, so I could be half wrong here. But MSCI has a particular focus on safety incidents, fatality, etc. Remember, they're a port operator. Stuff happens, right? So in their case, despite all safety measures, they've ended up with a bunch of incidents which bring down the MSCI, right? The reason I'm telling this story is, if I was a board member or a management, I sometimes feel that it's not very difficult. As long as you have you ask the right questions and you have the right people explaining it to you, to say, what are those elements that are bringing us up or down? And is that important enough? Is that solvable? In some cases, you may say, like in this port operator example, the safety measures are very good, but the inherent nature of the business is such. You may say, I'm not going to do anything about it. But if there's another cue that's coming up from these ratings, that's something effectively to kind of focus on. I kind of tend to use that approach, when I look at these problems. I think to your point on how do we really know the business impact of certain things, that is again only going to come if from a board perspective or from a management perspective, you start looking at this holistically to say what are the risks and what are the opportunities, and that's really when the business impact starts coming in, actually.
Chandru, any thoughts?
That's one of my favorite topics. Okay. So I've been in ratings, CRISIL and then MSCI. I think the issue starts with calling ESG ratings. So, when you actually call it as ESG ratings, you start comparing with credit ratings. Both are different animals altogether. Credit ratings is actually where the company gives a mandate, while ESG is where the investor gives a mandate. In credit ratings, you actually are privy to a lot of financial information and everything, while in ESG ratings, you're not. And the biggest problem, elephant in the room there, is how do you quantify all these things. So how do you quantify? I think between E, S and G, the E part or the climate part is much more quantifiable. G, there are a lot of actually now empirical research which is available. S, very less. It's just actually a gut feel kind of thing which we need to do. And I think that's been the bane of this ESG ratings, that you start clubbing everything together rather than actually looking at it in different components. And that's why both are, each of it is, it's rubbing off. And that's why we have these problems in the US, or now, that regression which is actually happening in other countries. And the mix-up of ESG with climate change, which is a different agenda, which has an overlap, but then, there is a lot of this mixing up also, the social and all the other things which actually keeps happening. But I think largely it is that ratings piece which come across, which is a problem. But then, I would also say that it's not to the defense of the rating agencies or anything like that. But I think, I'd be very worried if all ESG ratings give me the same information. I'll be very much worried because I have no information value otherwise. Only if as an investor I'm looking at it, if there is a little bit of a difference, that's fine. But also whether it's Sustainalytics, MSCI or any other rating agency, they're supposed to actually, and they do, give out the methodology. It's there available. And there's an app also, MSCI has an app. You can just go and then see what are the actually parameters on which it's rated. But you're right, Jamil, that there is no standardization as far as this is concerned. Maybe that has to move to that standardization, but the qualitative assessment has to be different. So that's where I think the information value will actually come. But I think the other problem is the access to information by this rating agency. So when I was in MSCI, when we started doing actually ESG at that point in time, and Mr. Damodaran in the morning said that governance at that point in time, people said it's not going to work and everything. I used to hear the same thing about ETFs and ESG. Nobody's going to care about it. But then what happened is we started the ratings of around 100 companies, the top 100 companies. This information went to sovereign wealth funds and pension funds, who then actually started asking questions to not either the companies directly or through the funds. And probably Bala here should also know that how this actually happened through the times. And then what used to happen is I used to get very angry calls from corporates, saying that why you're actually having this one, there's a problem, we are not supposed to be on this rating. Then we went back, we said that, we have asked for such information, it has not come to the rating agency. So there is a gap. And plus, if you put it up in the public domain, we'll pick it up. So those are the issues which has happened. But I think over the period, the importance of ESG has actually started moving up, and there are more focus from the boards on this part.
Sorry, may I just make one point? I think the last point that was made about the number of cases where we realize that executives in a company don't know what rating agencies are doing. So only when there is a bad rating that comes out, people are running around trying to fix it. So one just a simple suggestion is that if you are a covered company, just keep an eye out that at least enough public information is being put out, not wrong information. And in many cases, it is because companies have not put out information, and therefore rating agencies such as MSCI might just be taking what is out there and making a rating assessment. We have realized, like I said, in a very short period of time after you realize it, you put out information and then automatically you see the impact of that. But you may want to kind of do that a little bit more proactively. I just want to highlight that.
Sure. I think on we've spoken so far about the challenges of, let's say, getting a universality across ratings, as well as, how sort of boards can make sense of some of these things. I want to shift slightly to focus on opportunities and to get a sense of what we can do over here. You made the point, Jamil, that some large number, 275 million sort of a trillion is so staggeringly large that, it's difficult to believe, but that is needed. I have a counterpoint. I feel that if climate was the new digital, we would solve this problem very fast. Because the problem as I see it is, there is inadequate evidence, or it is inadequate conviction that people will make money through the green transition. If people saw that, we had Nikhil of Zerodha in the morning, there is notwithstanding the so-called funding winter and all, fundamentally there remains a lot of belief in tech. If we had the same belief in climate, then I think many of these issues would be solved. Now, the green transition is frequently associated, and a lot of the conversation is around essentially renewable and so on. But if you take it industry by industry, you have new opportunities that come in. So if you look at vehicles, for instance, there is the entire charging station industry that is going to get created. There is a residual value industry being created because many of these vehicles are liable to come up for reuse. There is uncertainty about their residual life and so on. In the case of rooftop solar, for instance, there are second uses for rooftops after a certain number of years. There is almost certainly going to be a battery recycling and reuse industry. So the transition involves all of these. I mean, energy efficiency, of course, has been fairly largely written about, so I think people kind of get that. How much of this kind of discussion do you see in the companies that you deal with? So, above and beyond just, look, I want to reduce my emissions, there's a lot more. So when you talk to cement companies, do they just talk of reducing, their emissions, or do they talk about the fact that certain types of cement work in coastal areas, certain types of cement are going to be greener and so on, therefore, targeting those markets actively and all that. So we just wanted to hear from you about that, about the opportunities.
Yeah, I think I go back to the point that this is a very nascent conversation. I think it always first starts with the risk, right? And that's really where that starts. But I think increasingly people are talking about some of the nuances, and I'll break them into three, four parts. I think we are seeing enough people now question product mix actually. There are, I won't name this client of ours, but a power company that actually started on a journey realizing that renewable is going to be a very important part of the portfolio mix. They've got to 38% of their portfolio being renewable as a generator, as a developer. And then another company in the same space we know where 4% is renewable. Now, who will end up better in the long run? I think we are all clear. The question is, one saw it as an energy transition opportunity, the other did not. So that's one type of stuff in terms of product mix. I think the other thing that I don't know how many kind of participants are aware, maybe show of hands here. So CBAM, who knows CBAM? 1 out of 81 people, good score. So I think this is really where we are kind of, we really need to play the CBAM, very simply without boring you with this, is an EU regulation which effectively will start asking for carbon offsets to import steel, cement, aluminium and fertilizers into the EU from January 1, 2026, right? Now there are two ways to play this. One is to say, oh, we are going to be impacted by CBAM and therefore, we are kind of this thing. But we already have conversations with companies which are saying, can we set up alternate manufacturing facilities which are more low carbon intensive? Think renewable, think other kind of low carbon technologies, so that when the regulation comes, we gain a competitive advantage over other exporters into the EU who may effectively have that offset cost while we don't, right? So I think the product mix discussion is coming into right now nascent. I think an entirely new industry that are playing out. You mentioned EV charging infrastructure, big lubricant company. Everybody thought lubricants dead industry, right? So everybody started questioning, when the world moves to EV, what will this listed lubricant company be worth? But they've started this journey into the EV charging infrastructure in a fast manner because they know that's really the opportunity that comes from their business. I think each one of you, your business would not have existed if it was not for the focus on climate change. So I think data services, data verification services, or financing. So I think the opportunities are immense. The question really is, what does a company kind of do? I want to come at a country level towards the end, but I'll leave that towards the end. But that's really the way I see this whole story. I know.
Okay. Now see, opportunity, I agree there are risks and opportunities for companies. And I'd like to just take up on that $275 trillion, this one. On the other side, we have actually, there are studies which say that in under 50 years, $1 billion people are going to die. So what is it that we need to actually then do for this? So there is an existential threat, and definitely I think there is also money which needs to be done to actually see that the temperatures do not rise beyond 1.5 degrees centigrade, which is the Paris Climate Accord. And if we do that, we are already actually seeing the effects of all these things which are happening. And many of the syndromes are like that boiling frog syndrome. So it's just happening little by little. We don't just realize it, and then suddenly we get hit by that. So these are the kind of things, conundrums which are there. Now, if you take a corporate, I think there is an internal risk, which is an operational risk for actually, as far as climate is concerned. If you're not having enough water, you can't exist, you can't operate. Your cost goes up. If the heat goes up, your AC bills, the cooling bills actually start moving up. So emissions are a big problem. Health of workers and staff is a big issue. We're seeing that in many places actually happening, and not just for manufacturing, even for services industries. And then you have the external environment, the investors' perspective of your company, which is important because investors are looking at it, saying that if there's going to be a water risk to this company, or if it is in a coastal area and there's an erosion, you're going to have a problem for these kind of things. You have regulators actually breathing down your leg. Lenders. In the morning, the Deputy Governor actually spoke about climate risk for actually banks. Banks are getting affected because their assets are also actually exposed. It's not just from an equity investor point, even from a lender's point, this is actually very, very important. So there is a lot of focus from the outside, and then you have the transition risk. So which is do with policy, consumer, technology risk and everything, and which is where we have seen automobile industry actually moving on. So these are the risks, but there are also opportunities. Last year I was called to actually speak upon this with a 50-year time frame between immediate and the future by one of the largest funds across the world. And I had to actually put on my thinking hat and look at a very, very wide spectrum and look at it, what are the opportunities which are there today and maybe in the next 20, 30, 40 years. So when we look at that, there are plenty of studies which shows that the tropics, you can't actually live in the tropics in the next 50 years. It's going to be extremely difficult for people to live in the tropics. So what will happen to humans? So one is you might still have 1 billion people dying, but we still have 7 billion. Where will all these people go from the tropics? So the answers are Antarctic. So it might look a little bit fantastic today to say that people will actually move to the Antarctic. They can't move to the Arctic because Russia is there. But still the Arctic pole is opening up. And if you look at how the Arctic is actually playing into geopolitics, it's really, really very interesting. Because as the Arctic warms, the shipping lines are opening up. As the shipping lines open up, there's more commerce flowing there. And traditionally, wherever actually shipping lines have been moving, that is where a lot of business actually starts taking place. So there is a issue about what happens in the next 50 years, but also on the I say 4 pillars of this challenge. One is energy security, food security, land security and water security. So when you look at these points, there are again many, many opportunities on the energy side. We are talking about only about renewables and these are actually like solar and wind and everything. Now ammonia and hydrogen have come into play, but nuclear we will see actually will start playing a much better role as we go about. The Chernobyl and the Fukushima incidents, they are getting forgotten because there are new technologies which are coming up. Fusion is moving to fusion. Then you've got small and modular reactors which are actually coming up. So there's a new opportunities there. Then there are even more better opportunities coming up. There's something called a space-based solar power. So by the time the sun comes down, a lot of energy is lost. So companies are now actually experimenting with putting solar panels in space and trying to actually bring it down through infrared radiations down to the ground. So opportunities like that are plenty.
So let me sort of draw on some of the various points that you made, Chandru, and also redirect ourselves a bit to the S of the E, S and G. We've had 2 or 3 sort of global crises in the last 15 or 20 years, the one in 2008 being maybe the most spectacular one, but other challenges like the pandemic and within India on and off, some, the occasional, at least financial crisis of a smaller magnitude possibly. We live in a country which by all yardsticks is not rich, needs quite a lot of development, has a serious employment problem which appears almost intractable now, and you have a lot of social challenges. So you have, for some reason, the women's participation rate in the workforce is sort of plateaued out. You have data privacy related sort of question marks, and you have the sort of, I won't say threat, but the challenge of AI which hovering over you. Companies are having to deal with all of this, and there is a risk that over the medium term, an inability to deal with all of this is going to result in maybe social tensions, maybe dramatic re-rating of the capitalist model that you have. So it doesn't mean that, we would sort of overthrow the capitalist model, but you would have things that you could not have imagined maybe 10 years ago happening. So, 20 years ago, if someone had said that trade barriers would be raised again and again, people would have said, no, it's never going to happen. It's clearly happening. Even Western democracies are sort of doing that. So, given this background, what do you feel, Jamil, that and Chandru, that how do you think regulators should react? And I just add one more sentence here. In the previous session, there was a very important question about the long and the short term. The fact that capital is very short-term focused. Some of it is mandated. In fact, even pension funds are supposed to be long-term, actually go and tell LPs, especially in the public markets, that look, you need to be able to exit investments within like 90 days and so on. And in the private markets, of course, you have slightly longer sort of tenors, but it's never more than 7 to 9 years and so on. And change that is, and social change that we speak of, and the S part that many large companies will deal with, is not going to sort of pay off within 3 or 5 years. So how would you, what do you think you would advise, let's say, to a regulator to be able to bring about some change?
Wow, that's a tough one. What do I tell a regulator? But
You're very smart, so
no. So we heard that in the morning. Sid Pai already said that, so I'm not repeating that. But no, look, I'll break this up into two, 3 parts. I think first of all, on some of the matters on social, I think it's about, as the focus on ESG happens, one of the fallouts, I believe, is going to be people can't ignore the S factor. Now, whether they do it for whatever reasons they might be, they will realize that, so I with this company I will not name, and we were talking about energy, they're doing an IPO, and suddenly somebody within the company itself said, look, we do so much for our delivery partners, we do so much, does that count, right? And we said, of course it counts. And then they said, but why are we not focusing on it? Why are we not doing more, right? So in my mind, as if companies start focusing on ESG holistically, I'm hoping that the S will start getting that attention. Many companies already are doing a lot of things, and then it'll kind of, just maybe create that momentum for others to do as well. So that's one part of it. I'll tell you, I think there is an interesting opportunity for India as which is not regulator, but actually more government. I go back to the birth of the IT services industry. 30 years ago, when, or a bit more, when the government gave incentives in the form of tax holidays, etc., to the IT industry, honestly, I think that gave a big fillip, amongst other things, for the growth of the outsourcing industry in India. I personally believe that there's a similar opportunity on ESG type outsourcing and developing India as an ESG center of excellence. How that happens, because we have human capital, right? So one element really is how do we do a COE approach in different areas of the transition that might be at play. That's one thing to think about, what incentives are possible, should be given. The second thing, and I've said this in many kind of discussions, is just like the information technology revolution, the digital revolution saw a lot of focus and investments. I think material science is going to see an amazing amount of investment going forward. So by whatever name you call it alternative materials, you call it climate tech, could we use our human capital to develop an ecosystem around that as a country? We have all the enablers. We have the government. We know that when the government wanted to create a world-class tech stack, whether it is payments, and people spoke about it in the morning, we could. We have systems which are better than the rest of the world. Could we duplicate part of it in other parts of the transition economy? Definitely something worth this thing. One of the things I highlight is that South Korea has 6,600 low carbon technology patents, and that's because they have started harnessing their human capital towards low carbon technologies, which they believe is the future. So I think it all boils down to different types of opportunities. Some of it will come through company level R&D, but a lot of it potentially, going to your question, could come through a very strong government and regulatory ecosystem, and that's the conversation I would like to hear more. I'm not hearing enough of it, but those are just thoughts I thought may be useful.
Chandru, any thoughts from your side?
Yeah, I think your question was on the regulators, right?
Well, yeah, my question was...
Renuka has answered that question.
Okay. No, I think as far as the social stock exchange, see, there are two elements, I would say. One is how do you actually then look at ESG within this, the S part within the ESG framework. And I think, things like the BRSR or SFDR and these kind of things are actually dealing with that. And I think, India has set a good example as far as the social stock exchange is concerned, which I think can be a concept which can be exported to actually other countries. So that's definitely there. But looking at S as a business opportunity also, I think a lot of us would have seen that recent Economist article as saying that how countries are aging much faster now. I think there is a bundle of opportunities there, which are business opportunities. And these are not like, doing a charity or anything like that. And I would also actually not look at the S part only as a charity. It's not just CSR. There is good business opportunities there. And, people should definitely, and I know that people are latching onto it, right, from old age care and so many other things which are actually happening in that perspective.
Should we open up for questions, Rohan?
Yeah, so I think, both Chandru and Jamil, I think it's great that we are getting, at least from the two of you, some sense of consensus. If the government gives a zero tax holiday, Unicus is the new TCS.
Yeah, indeed.
Yeah,
no, Unicus will be the next TCS without incentive.
Without the tax, okay, of course. I think, at least we are able to agree that there are many sources of data that are now available and people just need to sort of hunt for it. Ratings are not entirely useless. They provide a framework which boards should ideally try to use. And of course, the government can do everything that within its power, I think, to bring India and Indian companies to the forefront of ESG and indeed to become a kind of a powerhouse in the analytics and the assessment that is needed for this particular transition. So, I thought, given that we've sort of asked between the three of us spoken for more than 50 minutes, we would sort of throw this open to the audience and sort of take any questions you might have on this. And just please do introduce yourself and then, if you want the question addressed by any particular individual, please do tell
Thank you. Yeah, my name is Umakant. I'm an academic who studies corporate governance. I have two questions, so either of you can answer. So my first question is, in the lot of global ESG discussion is also including anti-ESG, for example, in the US. So I don't know if that momentum is likely to percolate into India at some point of time or how you visualize that, because already in 2023, a lot of investors have voted less on ESG matters in the places like the US. So how do you see that as number one? And the second thing is there's a lot of discussion globally on whether E, S, and G, because there was a lot of discussion with E, S, and G, should they be disaggregated? Because the fact that they're lumped together may be one of the reasons for a lot of the problems. So would you be in favor of disaggregating it so that you can address some of the issues, or is it still possible to lump them together and deal with them?
I'll take the first one, if you don't mind. And you can maybe... I think, look, like everything, this will go through cycles. As you correctly said, in the US, as some of you may know, there are states which have said that if ESG is a factor in your voting, they don't like it, they believe that's discrimination. We're seeing a lot of that, which is why the US is a very late starter in the whole journey, right? Now, I think one thing, however, is coming out. We're doing a lot of work with American companies, and when I look at that work we are doing, actually none of it is because they believe in ESG. A lot of it is because they're suppliers to Europe, actually. Yeah? So I think the point is the world has become so interlinked that if one set of people believe in it or not, I think is not going to be relevant. It's like that ecosystem that will develop over time, but it will go through its ups and downs. So I agree with that. Whether it will percolate into India, I don't know. Because the way I always see it is, as long as you use it, India used renewable beautifully, if you ask me, actually. I was with this investment banker in the US who's a Republican, and he, very provocatively asked me, why are you guys supporting ESG in your country, right? And I said, what do you mean? He said, no, you are a developing country, you should oppose ESG. And I said, of course, we will do whatever the market wants us to do. And but when I highlighted to him that maybe that was one of the reasons, because we wanted energy dependency or whatever that might be, we started focusing on renewables and how we made progress on that. I think it's always looking at it from that perspective. That's the way I see it kind of happening. But on the rating split, maybe you want to comment.
No, thank you. I just actually add on a little bit to what Jamila is saying. I think what has happened in probably US and UK is that both sides actually have been swinging to the extremes, and it is the louder voice which is actually winning through. And I think the Ukraine war somewhere actually has triggered this anti-ESG movement with people like Strides, one of the presidential aspirants, Vivek, who has actually launched this anti-ESG movement. And where he made money also, showing he just wanted to show that by investing in fossil fuel companies, you can make money. While the before the Ukraine war, when gas and everything was not so much in demand, the companies or the rating agencies, where I was also part of, we were showing that okay, companies have been the share price has been moving up if you are doing good on ESG, and this is what people like Ashwath Damodaran and Tariq Fancy have been picking up and breaking it apart to show that there is a lot of people trying to ride this gravy train of ESG. And that has actually played on a little bit to the Republican sentiments. I think that's what has happened. But as Jamil rightly said, I think there has been quite a lot of climate extremism also. Definitely. Like people saying that you'll have to shut down fossil fuels next day. And we have had dramatic things in UK where they actually brought on a fossil fuel plant in front of everybody to showcase their leadership in saying that they want to get out of fossil fuel. And we have seen what's happened in Germany. They shut down actually all the nuclear power plant, and then when the war happened, they couldn't sustain. Now their economy has gone down. I think from that perspective, India has been very nuanced and balanced. I think hats off to the policy which has been happening in India. It's not we are saying this is a journey, this is a transition. And I like to say that without energy, you'll have anarchy. And we have seen that happening in places like Sri Lanka. So for such a large country, we can't shut down actually fossil fuel plants overnight. And it's a journey, but I think we are doing extremely well in actually moving towards renewable energy. So that's where I think the balance lies. And for your second part on whether we need to look at E, S and G separately, that's my personally, I do believe it has to be looked at separately because they all got lumped together after actually 2008. I'm sure that one is looking at these things because the quantifiability and the attribution is a big problem. You can do probably with E and somewhat with G, but S the attribution, saying that if I'm spending $1 on actually S, does it lead to actually a kind of a benefit? So that part, even though there are intrinsically you can actually justify that, but when it comes to actually, because the world still looks at quarter to quarter, you're still looking at, you're used to looking at financial numbers and everything. So that is where this kind of issue actually comes up. But, I would say that, probably if you break up E, S and G, so people like Jamil will probably get more business also.
I'm out of supply, by the way, right now. So my problem is talent.
Any other questions from anybody? Yeah, please go ahead.
Questions? Yeah.
Yeah. Good afternoon. Thank you for such a wonderful insight, particularly on CVAM and on how the credit rating.
You were the one person who knew. Good of you. Yeah.
Yeah. So I could relate to a lot of these things. So I have two questions. One is on greenwashing. Basically, of late we have been seeing many companies are projecting their products as greener. However, in reality, this is not the case, right? And we also see that these products are also backed by independent credit agencies, rating agencies, right? So how do you think we should actually, or how do you think the regulator should tackle this greenwashing? Because this is something which is sort of a misreporting, misrepresentation, particularly since the theme of this session is on corporate governance. So this is my first question. And the second question is on CVAM. With the CVAM being introduced, India has also decided to challenge it in WTO. That is one leg of it. But then there have been also recent reports that India would also introduce something very similar to CVAM, where goods which are coming from European Union, we would be taxing on the same. So I just wanted to pick your brains and your thoughts on the same.
Wait, I'm mindful of time, so if you don't mind, I can
take CVAM one.
No, I'll take the first one. Actually, it's very easy. You may sit down. I think the truth of the matter is a lot of companies which call their products green, honestly, they were done by the marketing department. Okay, and this is very well reported in the H&M case. The jeans maker, they actually came up with a green product and stuff. It became a hot selling thing. And finally, somebody asked a question, Can you explain how you categorize it this way? At the end of it, they realized there's a big kind of mishap. They did a recall. There's a class action suit, etc., etc. So I think this is a real problem about products not going through due process before they're categorized as green product. And I go back to that point on data integrity, which I spoke about earlier for the other company. I think on CBAM, it was touched upon earlier. I think the risk really is we will get into another round of non-tariff barriers, right? And you alluded to this, Govind, earlier, that if we're not able to deal with this sensibly and nobody knows how this will kind of play out, you'll see a tit-for-tat response. So that can't be ruled out.
Good. I think we are running absolutely sort of out of time. So if there are no questions, I'd love to sort of thank Chandru and Jameel and, call the session to a close.
Thank you, Govind. Thank you very much.
Thank you.
Thank
Thanks.
Thank you so much, gentlemen. As you continue to be with us on stage, we're going to request Mr. Damodaran to kindly join us. Leaving the planet a better place. Thank you very much, gentlemen, for shedding light on this very, very important topic. Appreciate it. Ladies and gentlemen, we've got the caricature that was made right now during the session for each one of our panelists. We'd like to thank Mr. Sankaran Narayanan for moderating the session, ladies and gentlemen. Mr. Jamil Khatri and Mr. Badri Narayanan. And along with the caricature, we've got the special certificate that has the planting of 10 trees in the Sundarbans in the names of each one of our panelists. So that's just an apt takeaway from the session. Ladies and gentlemen, our panelists, leaving our planet a better place. Thank you. You've got the caricature open as well. That's lovely, ladies and gentlemen, if you can catch a glimpse of the caricature. Thank you, Mr. Damodaran, as well. Ladies and gentlemen, we've got a couple of videos that will play, and we move directly into our next session right now. Can we please have the videos? Thank you. Ladies and gentlemen, moving on to our next session right here. A session that is Institutional Investors' Journey from Entry to Exit. More often than not, the voting behavior of institutional investors tends to impact on the decisions being taken in the corporate universe. How do institutional investors choose the companies that they invest in, and what decides their behavior pattern while they are invested until they exit the company? So, ladies and gentlemen, inviting our panelists to join us on stage for this panel discussion, Institutional Investors' Journey from Entry to Exit. Our first panelist to join us is Mr. A. Balasubramanian. A loud round of applause, please. The Managing Director and CEO of Aditya Birla Sun Life AMC. He is the stalwart of the mutual fund industry with over 3 decades of rich experience. Prior to assuming the role of CEO in 2009, he served as the Chief Investment Officer for 3 years. Earlier, he worked with the General Insurance Mutual Fund and Can Bank Financial Services. He has been on the board of AMFI since 2009 and was its chairman from 2016 to 2018, being reappointed to the same position in 2021. He was till recently chairman of AMFI. He's a member of the Board of Governors of the National Institute of Securities Markets, NISM, and a member of the Advisory Committee of SEBI, Investor Protection and Education Fund. He's right here with us on stage. Ladies and gentlemen, Mr. A. Balasubramanian. Joining him on stage, our next panelist, Mr. Rajiv Gupta. Good afternoon, sir. Welcome. He is the founding member of Upward Financial Group, a merger and amalgamation investment bank, Upward Capital, and a mid-market private equity buyouts firm, Upward Partners. Prior to setting up of Upward in 2012, he was a global partner at the Carlyle Group and earlier the joint managing director of DSP Merrill Lynch. Ladies and gentlemen, please welcome on the stage with a loud round of applause, Mr. Rajiv Gupta. Good afternoon, sir. And joining us and completing our panelists on stage, ladies and gentlemen, please welcome with a loud round of applause, Ms. Renuka Ramnath. Welcome, ma'am. Good afternoon. She is the founder and managing director and CEO of Multiples Asset Management, which she set up in 2009. Prior thereto, she was the managing director and CEO of ICICI Ventures, the venture capital arm of the ICICI Group. She has also served within the ICICI Group across investment banking, e-commerce, and private equity. She is the chairperson of the Indian Private Equity and Venture Capital Association. As an independent director, she is the first woman professional to be a chairperson in the Tata Group of companies. Ladies and gentlemen, with a loud round of applause, Ms. Renuka Ramnath. Moderating this session, I'm going to hand over to Mr. Bala Subramanian. Sir, all yours.
Good afternoon, everyone. Of course, it's tough to have sessions one in the afternoon, and second, after multiple round of speakers who are experts in their respective field and talking about institutional investors' behavior in the capital market. Of course, I have been part of the mutual fund industry for the last 32 years and seen the industry is evolving. We've also seen governance evolving each passing year for a variety of reasons. One, of course, the fiduciary responsibility that mutual fund industries have got on them, given the fact that large pool of retail investors have been coming into the mutual fund industry. And each passing year, the regulatory tightening also have been ensuring that all of us and institutional investors are able to deliver the fiduciary responsibility that we have and invest in the best interest of investors. At the same time, we avoid any accident. At the same time, create value for investors. So that's, I think, we have dual job. One, we have to generate return. At the same time, we have to pay attention to how the companies are run. And we also cannot play the role of an activist, unlike Renuka and Rajiv, who can play an activist role, but mutual fund cannot play an activist role. And ensure we ask the right questions to the management on capital allocation and so on and so forth. These are a few things that we can do. I think as post-2009 crisis, of course, it was a Satyam period where all of us as industry players, I still remember that we got together. That's the first time the mutual fund industry, all money managers came together and drive one single agenda of changing the behavior of corporates. That's something we started doing, and since then, there is a lot of changes that have come in the Indian mutual fund industries, whether it is investing in fixed income, give money to the investors on the fixed income space, or in the equity capital space. The other thing which of course has come is the stewardship code was introduced. Of course, the last few years, there has been a huge amount of discussions about stewardship code which has to be followed, especially the voting has been made mandatory. I think when we started voting, we always as institutional investors, mutual fund players, we take the middle path in the sense that if it becomes assumed as a neutral, you take a call of abstaining. And invariably, till about 2014 to 2019, all of us would have only abstained from voting. The best way actually to be neutral, given the fact that we have a public image, and second is whatever we do, it comes in the public platform. If it is good, of course, we will appreciate it. If it is bad, it also get equally negative publicity. Therefore, so I always used to maintain either for or abstains or against. Then as the time progressed, industry players started realizing the importance of even saying against. In fact, sometimes it goes to an extent that against you do for such things as increase in salary of a managing director or any professionals you recruit on the company's board at outside the market comparable salary. And sometimes as a money manager, we vote against that. I still remember a case where Tata Motors, when they were trying to revive the whole business from where they were, there was a resolution being passed for appointing a gentleman from overseas, and all of us as a money managers felt, why should somebody be recruited, that to outside the country when you can't get a talent within the country, and get a person from outside the country, and that too at $1 million of salary. In fact, the first round of voting, all the entire mutual industries voted against. Then as a CEO of the company and came to know from the management, then I had a second round of discussion that understood the importance of getting a talent from outside the country and get that person for reviving the company's prospects to create the shareholders' value. That's the way then the company went for a second round of voting. Then after having a deep understanding, all of us voted for. So that's the kind of I've seen in the past. And since then, the money managers have been exercising the full right to vote for and vote against. In fact, voting against also have gone up. Just to give you some statistics number, till 2014-2019, 88% of the votes were in favor of for, and 3% of the votings were against, and 9% were abstained. And the same number in the year 2020-23, it actually doubled. Against the voting has gone up from 3% to 6%. So that again is the progress that is being made by institutional investors, especially in the mutual fund space, as the size becoming bigger, as the number of companies in which make investments is becoming larger and larger, and more companies coming to the capital market in general, and regulatory stewardship responsibility is also quite a lot in ensuring that whether the board is constructed properly, whether they have the right set of talent, skill set in being part of the board, and assess them very clearly, and basis which you assess. That's something I've seen, an improvement that I have seen. From 3%, the vote against has gone up from 3% to 6%, and the people who are abstaining, which used to be about 9%, significantly got dropped to about 2%, which essentially means the institutional investors like mutual funds have been exercising the right to ensure that managements are asked the right questions and so on and so forth. Also, we have gone through the dilemma. I think there used to be, when I was a CIO till about 2009, most of the public sector companies, the independent directors used to get appointed, and even myself used to get a call from a variety of people that so-and-so person is being appointed as independent director, and Bala, just please ensure that your team discuss this and ensure you vote in favor. If it is one person coming as a recommendation, of course you can vote in favor. If 3% being recommended for 3 different set of people with the high quality of high credentials who are actually recommending, at the same time 3 people are being recommended, then what call you take? That's the way we all used to abstain. So we moved away from abstaining to actually voting for and voting against. That's the trend that you have seen. So therefore, the industry, of course, is evolved. The earlier discussion, there was a discussion about, of course, I'm going to ask this question to both of you also. There was a discussion about ESG, and we also, there was a disconnect, right? I think in the sense, the companies which are doing exceedingly well on ESG norms till about 2019, pre-COVID, companies who used to follow the ESG norms were trading at an extreme amount of premium to the normal market. I think as the COVID broke out, and then as time progressed, as the energy shortage started coming in the global market, ESG was completely forgotten. The market started rewarding ESG companies, non-ESG companies, as a value companies, and they started also rewarding. So this is something, as a money manager, we go through the dilemma. The question is If you just stick to only one theme and one practices, if it creates the value, it's fine. If it doesn't create a value, then how do you actually change the course in terms of ensuring that you also participate, at the same time ensure the companies are also run properly. So with this, my opening remark, of course we have two of the stalwarts, one of the old industry players, both Mr. Rajiv Gupta, who runs the influencing role by of running the large PE firms, as well as the investment banking company has run. The same thing goes with Renuka, whom of course I've been knowing for the last 30 years. Again, I have played a very influential role in every respect in the capital market. So I would like to hear from both of you your opening remark. In general, we have seen cycles, we have seen how institutional investing pattern is evolving, and companies also, of course, are growing, new managements are coming. How important in terms of ensuring that governance, practices, policies, while of course building the initial stage of the companies, while evaluating companies as a private equity investors. Raj, you want to go first?
Yeah. Okay. Yeah. See, first of all, since we're talking of governance, I think it's important to give small and clear definition to what governance really means. And the way I see it, and I have seen it, is governance is nothing but board oversight that makes sure that companies will create value to their full potential. So really, create value to full potential is governance in a manner that the risk is at an acceptable level and in a manner which is fair to everybody. So really there are three parts to governance definition in my mind. Companies should create value to full potential through board oversight, risk should be within acceptable limits, and thirdly, the way the manner of achieving the objective should be fair to everybody, majority, minority, all shareholders. This is governance. Now, the end result of governance is what? The end result of governance is fair treatment to everybody and value creation with acceptable risk. If you look at the Indian environment, and I worked many years in a foreign private equity company, not as good as Renuka's, of course, but one thing we saw in that heady environment of the first decade of this millennium, going into the second decade, is this massive growth of China. And it was consistent, touching double figures many times. And one used to keep wondering where the capital is coming from and how that capital is taking that risk. But the growth was very real. Every indicator of that growth, and we all started with doubting that growth. Growth was undoubtedly, real and in place. Every indicator of that, whether it's consumption of steel, cars, electricity, railway wagon loading, port statistics, what have you, was showing that China is growing. So as China grew, and they grew to the second largest economy in the world, one thing they did not do, Bala, and you'll appreciate this, so will my friend Renuka, China did not create value. So that means there was a massive failure, and I'm being very, say in all humility, that there was a massive failure of governance somewhere in China, or that capital that China got did not care for governance. So it was a different type of maybe state sponsorship or what have you. And Indian capital, on the other hand, we grew at a smaller pace, capital was circumspect, it was private capital, but we created enormous value. I remember 2005, 6, I think index, I'm talking Bombay Stock Exchange index was about 5,000-6,000 Bala, if I'm not wrong, maybe 6,000.
Yeah.
Today it's 65,000, whatever, 66,000. So 11 times in about approximately 16 years. This is the extent of value creation. The same story, of course, we took 10 years, 12 years to readjust to the new environment that, economic environment that was created. So clearly, I think we are beneficiaries of governance. We have run the companies competently. We have generally been fair to, minorities, etc. And of course, institutions have helped. So I think we have good track record in governance. Second point I want to make, and before I hand over to Madam here, is that during this period, from 2007, Mr. Damodaran sir, you were chairman of SEBI also. I think one thing is maybe partly some 5% role played by Bombay also. We've had excellent and very capable leadership of SEBI. In this period, what has happened is tremendous power has been given to minority investors and to the independent directors. To the extent that if you look at the composition of nomination, remuneration committees, audit committees, the powers vested in them, they have to make a recommendation to the board, only the board can then decide. In some respects, board has been placed in the position of a shareholder. You can say yes or no to the recommendation of a norm committee. You can't originate yourself. That's the law as it stands. There's tremendous change that we have in India. And a lot of people come and tell us, you know, obviously we also bankers and we work with, apart from being private equity investors, we work with management. And a lot of time people come and tell us that, listen, this is really going overboard and you know, India has anti-promoter and capital has no respect. And we tell them that our perspective, while, you know, you're our clients, we love you and all that, our perspective is different. Every regulator is looking at China, every regulator is looking at what capital flows can do to an economy. And while, yes, we have the best ratio in the world, return on capital, price to earning ratio, price to book, you know, Bala, you know all that. Fact of the matter is that on an absolute scale, China has done so much better because they attracted so much capital. So the question for the regulator, sir, you will agree, Mr. Damodaran, question for the regulator was, what should India do to attract that capital? And therefore, a whole series of things that have been done by Indian regulators, particularly on the security side, is designed to attract capital, and I think we have succeeded. So this is the picture that I carry. Nobody is anti-promoter. The regulations, regulatory changes have brought in capital. They have helped us, and while we do all this, I think growth has kept up. Investments continue to happen. Companies are very well traded, very well managed. I think we are in a position today where, not to say that institutional investors have not contributed, they certainly have contributed, but the overall picture to my mind is very, very positive. And let me pause here. We play in this arena in private equity, and how we do things is that we, I would say, take guidance from the fact what has worked in India and do more of that. And we have seen 80s and 90s and all that. We know what doesn't work and we stay away. I think in summary that's what we've done. Yeah. Thank you.
Yeah, thanks, Raju.
Yeah, so good afternoon. Happy to be here. First, I would like to talk about what, you know, governance has meant to me practically. Given that much of corporate India was set up by so-called promoters, who pretty much held large majority stake in the company, if not all of it, there was no difference between the person and the company. The promoters thought that I and the company are the same, and since the company is mine or the majority of it is mine, I am in the best position to decide what is right from wrong. I alone will decide that. I think demystifying that company is different from you irrespective of your stake in the company was the starting point of talking about governance. That company is an independent entity. Shareholder is but one stakeholder in the company and not all the stakeholders in the company. And the company has an obligation towards all the stakeholders in the company. And therefore, what should be the governance which will satisfy the needs of all the stakeholders in the company was, I think, the first step in the ladder of governance. The second important point why governance is important is the sustainability. Even in the previous panel, they spoke about interlinkages. If we look at any company today, right? I mean, whether you're in manufacturing or you're in services or you're in deep tech or you're financial services, the interlinkages are so high that if you have to build a long-term sustainable company, someone who is looking at it in an impartial way, who has no direct interest in the company certifying that your practices, the numbers that you report, the way you conduct the affairs of the company are trustable, you are not assured of longevity of the company. If you are not assured of that sustainable longevity of the company, how can another party engage with you in any meaningful way? If you are not part of a powerful ecosystem, how can you anyway create long-term value? So this whole understanding that I am but one element in a chain of ecosystem players, and I need a third-party verification that I am a bankable company, I am a trustable company, whether as a supplier or as an employer or as a potential, a company which is seeking capital or a company that is seeking debt. Your limit for growth and your limit for sustainability is going to be really very, very short kind of runway. I think these are the two key reasons why governance becomes very, very important. It's not about, for me again, the third thing is, it's not about what SEBI is saying. It's not about what listing guidelines are saying. It's not about what company law expects you to do. It is about yourself. If you are a principal stakeholder in the company, you want to build the company for long-term sustainable value creation, what are the value system you stand up for? Do you think not reporting numbers transparently is a good way to grow the company? Do you think not having an independent oversight in your company through good board governance will help you really scale and be around 10 years down the line? Do you think not having good risk management within the company is going to be really useful for you? Right? So it's, for me, it has never been about what the regulator said or which box I need to check to tell my investors that I am compliant. Call it ESG, call it by any other name. It is about your own values, which is why in multiples, even in companies where we began with 90% or 100% shareholding, we had independent directors who will bring that fresh, unbiased pair of eyes into the affairs of the company and make sure that every action in the company is done keeping in mind the best interest of the company and not any one stakeholder. And as again speaking for just 10 seconds about multiples, I have my CFO here. I have a simple mandate to him, which is in none of our portfolio companies we will have a blowout. Do what it takes. So if you set that as your bar, then the way you go about carrying out your activity, right from the company you choose to invest, I think the first filtration has to be, who do you choose to give this precious capital? Whether it comes from domestic resources, international resources, institutional investors, individual investors, it really doesn't matter. Capital is very scarce. Capital is very, very scarce for Indian entrepreneurs, so it has to be channelized only to the deserving ones. So the first filter is, who do you admit? Then the next is, how do you navigate the journey? And the last is, how do you hand it over in a platform which assures you long-term sustainability and long-term good governance? So I think a lot is about what principles we take and less about who is regulating and what they really want.
Yeah, I think interesting, and Rajiv, I think you took the example of China. Definitely, I think their governance standards does reflect both in the economy as well as in the market. We are able to see that quite visibly. I think from India point of view, of course, we all as a money manager, I think you mentioned about ROE, price to book. I think as a listed, we only trade in listed companies. Of course, you derive value, both of you derive value in companies, bring it to a certain level, and then bring it to the listed space. That's where our entry comes in, which essentially means when we as institutional investors look at companies, when established, balance sheets are disclosed, know the processes, practices, the product sustainability, all this comes in the form of a disclosure. Therefore, we are able to assess it. Of course, we do pay attention to the financial ratios, which helps us take a good or informed decisions. Therefore, to large extent, our role comes in the form of just using some external agencies, just do some kind of checks, audit checks and channel checks and so on and so forth, and basis which you of course assess it. And management, the 70% ownership versus 20% ownership has got its own way of looking at both on the governance side as well as on the liquidity that is available in the market, basis which again one always applies a premium or discount in the valuations. See, for us relatively a little more easier, I would probably say. But when it comes to the question of your investing, the question of one, all the companies in which you make investment are either completely in the nascent stage, startup companies, going to become a leader in the futures for which you will have many unknowns, good profit versus bad profit, and there again it many times it comes as whether it comes from a good profit or bad profit. Again, ESG is something, somebody is non-ESG compliance, maybe we can call it a good profit is very good but not a good profit, and many such dilemmas will come. And when you see at various stages, because you are all entry level players and you bring in huge amount of capital, you bring in there, and a huge amount of capital you are putting and taking a bet on management. I think Renuka mentioned about the larger ownership, and when you start up company 100% owned by them and you become one of the shareholders. Any key insight that you can provide in terms of how these investments when you make, what are the factors influence your decision making, and yet ensuring that governance, other standards are being met?
We actually only do buyouts. So we take majority to start with, the mid-market buyouts. So I would say that we basically look at, in an engineering sense, we basically look at the incremental returns on our capital and on our presence. And I say that with all humility, because we operate in mid-market, we believe that our access to talent goes up with our presence. And so we try to assess that also, that okay, some capital will go in, some better management will go in, what can that company achieve? The fact of the matter is that generally the platform that you buy into is a proven business model, a proven ability to expand, but the quality of people is not the best. Risk-taking appetite is low. Typically, the promoter is in late 60s, so they want to, look for someone more energetic, some better capital, some better management. This is what we do. The fundamental analysis does not change, which is basically that is it a good industry? Does this company comparatively disadvantaged or not? And therefore, what can this company aspire to do? Our experience has been as follows. First of all, extent of financial fraud is low, it's not high. It does exist, undoubtedly. And if you want it, you will come across it without too much effort also. But it's not that everywhere you are up against financial fraud. Salesmanship, yes. Financial fraud, no. Secondly, our experience has been talking to promoters who build businesses. Typically, they have come from, many of them started early 90s when India liberalized and all that. They've now been 25, 30 years here. They came at like mid-30s, they are now late 60s and all trying to exit. Many of them came from US or wherever. So I think what they have built is reasonable businesses, did not have access to talent, limited capital, limited risk appetite, ran into some challenges, but built something that has proven itself in the market, many times regional, and they can be built. You superimpose on that talent and superimpose on that management. I think Renuka referred to independent directors and all that. They certainly help. Renuka, I'll just add one more point onto that. Our experience has been, with all due respect, that first of all, don't fill up the board with private equity nominees. It doesn't help. Yes, you want to have say in critical matters. So our typical structure is 2 nominees from our food, 1 CEO who's hired, and 3 independent. So it's always even number of directors we always aim for. So nobody has superiority. Second thing is, as I said earlier, governance is all about making sure a company operates value to full potential. If you don't keep briefing the independent directors and tell them about technological changes, regulatory changes, what the competition is doing, how competition is achieving what's happening in the rest of the world, what should we be thinking about. If you don't brief the independent directors, it is a very suboptimal way of working. You cannot, there's a lot of wisdom, and in this whole room I can see several people from whom I have learnt, and if I start naming them, 10 minutes will be gone, I assure you. But you have to keep them briefed because we are bringing them into an industry that they may not know. You bring them for their wisdom and experience, not for industry knowledge, is what we have seen. This latest issue of Fortune, I'm sure many of you would have read that. The company which has grown the fastest last 4 years, 19, 20, 21, 22, so pre-COVID into I'm talking calendar 22, is a company called Builders First Source. 55% CAGR, they are retailing construction materials, $20 billion revenue. Now this is America, mature economy, and 22 interest rates are going up, building construction trade. So if this company can grow 55%, it just tells you enough niches exist in this world. Look for a niche, get the right management in place, get the right governance in place, and give space to management. Learn how to respect talent, learn how to be out of the way. Their management, you are the board, there's nothing called owner. So I think she made the point, and I really thought that point was very good. There's a management, and there's a board, and there's no third party there. Board governs, management manages. Make sure the board is capable, make sure the management is good, and I think if you do this, things work out well. This is how we do things, and it has worked well for us.
Yeah.
Thanks, Rajiv. So, unlike Rajiv, who is predominantly or almost 100% doing control deals in mid-market companies, Multiples does predominantly minority deals with very strong, capable entrepreneurs who have excellent business going. Most of the companies that we invest in are already profitable. They are operating in a very interesting niche and have a potential to become very, very valuable. So our starting engagement with our companies is first very effectively communicating to them how to be fiduciarily responsible. Fiduciary responsibility comes to us as fund managers very naturally. There is nothing we own. We just are responsible. We are responsible to our investors who have put us in business. We are responsible to the companies to whom we have given money, and we are taking very significant stake. So my very dear friend and ex-colleague Suri in the audience will agree. There is a saying in Tamil called "Aindil valayadadu, aimbadil valayadu." What did not take shape or what did not happen at the age of 5 is not going to happen at the age of 50. Like how we raise our children with very, very strong family values, we raise our companies with very strong corporate values. We don't go with the assumption that we know more than them, or even worse, that they don't want to be a good governed company. Everybody wants to be a good governed company. In fact, many entrepreneurially run companies do not know what is good governance, why it is important, and how do I embrace it. So there is tremendous amount of effort we need to put in to engage with these companies and show them what is good governance, hold their hand, invest our time and energy. So there is a significant investment Multiples has done. I have another colleague here, my chief compliance officer. The consistent response she gets after we make an investment, there is a board meeting called of this board. She'll call up the company and say, what's the agenda? They'll say, what? What is agenda? And she will have to say, no, you've called a board meeting. Can you please send the agenda? And that is where the journey begins for my compliance team in terms of saying, if you're calling a board meeting, you need to have an agenda. You need to send this agenda in advance. You need to, as Rajiv very correctly pointed out, engage the directors. What's the composition of your board? How much are you really sharing with the board? How much is the board looking into the management beyond the promoter, beyond the CEO or the CFO? Is there depth of management in the company? And then I can go on and on in terms of your risk management practices, your IT security, you know, how safe is your company? What are your value system? How do you behave with your suppliers? How do you deal with your employees, right? Is there fairness in your business dealing? And then we can go to a higher level of sophistication on how much is the gender diversity in your company, right? What steps are you taking to make it safe and attractive for women to come and work in your company? So you keep elevating the game of governance with your portfolio companies. But to simply say that I have thrown a book at you and you follow this is not going to bring the results. It requires humongous investment of both human resources, which is cost to us, and effort on our part to really take these companies. And I will say that because we are very careful about who we back, we have had 100% success in terms of, putting very good governance practices in all our portfolio companies. And we look at, and I'm not saying this because I'm on a dais and I have to make, distinctive statements. We truly, truly believe that the best governance practices in our portfolio companies is a differentiator. It will get us better valuations as well when we go to exit these companies. And it is not a check in the box. And I'll also say one thing, it's a bit of an old story. So beyond my 23 years of experience in ICICI and all the great degrees I accumulated along the way, my best teaching or my best experience on governance came from a miserable failure that I had. I was sitting on this company called Subiksha, which was a blowout case. And it's a bit of the mercy of God and my parents and a miracle that I'm sitting here, because I could be in hell at this point of time. That taught me much more about governance than any speeches or courses that I could have attended. And what was the big mistake there? The big mistake there was the front end was just running in a trailblazing speed, commensurate with the aspirations of the entrepreneur, and the back end was left for another day to be built. And that day was never saw the light of the day, right? And along the way, we as directors and investors were sticking our neck out and saying that, hey, there is a great company being built. Here is an outstanding entrepreneur. Please understand his mission. He is able to give provisions and other daily use staples to Aam Aadmi at an affordable price. He has fantastic service model. And above all, let's be kind to him, because who is his competition? Ambanis are entering the business. There are really big players who are entering the business. How much can this one poor man do? Will he go and open shops so that others don't copy his model? Or will he go and build the back end? Right? And then you become so confused between being sympathetic, looking after your money, and don't want to be judgmental. You can't prove that something is going wrong. So the problem is that you only get a gut that something is wrong. And you cannot take action on a gut, because the repercussions on your capital, on the employees, on the entrepreneur, in the marketplace, the lenders, is humongous. And what if the gut turned out to be wrong? You can never be acquitted of that mistake. So the lesson that I learned there was that the back end has to be ahead of the front end. It's okay if you grow at a lower rate. It's okay if you don't grow at all, if you have not built your back end. The back end could be team, back end could be good processes, it could be good IT systems, it could be good risk management systems. And then you grow the front end, and no sympathy can be given Whether you are an entrepreneur with no big financial resources and big name or fighting against big competition, I don't want to know the truth because there is no scope for you to run the company on even slightly weak governance, let alone, poor governance. And that university, I call it the Subiksha University certificate that I survived through, which helped me found multiples on the foundation that multiples will never compromise on. Governance comes first before everything else.
In fact, I was about to ask you about that blowout versus failure.
Yeah.
I think you yourself mentioned about Subiksha as example, which is complete blowout. Clearly it comes out, again, management visionary, deep thinking, understands ground level realities, but whether those are sufficient actually to assess the company's basis you build the business, or you want to build the back end, strong back end, including supply chain management, inventory management, risk management process, etc. I think that's a very interesting point.
See, the other thing that I've seen about Indian entrepreneurs is that they truly believe that I am telling you, what more do you want? Even now I see very large companies, Damodaran sir, you'll be surprised, companies making PAT of more than 500 crores and all of that. When we say let's do a diligence, financial due diligence, they will say, why do you need it? I am telling you. Why is that not enough, right? So this whole fiduciary nature that you telling me is not good governance, I do believe you're running, but I need a third party who has the professional capability to endorse you as the one upholding good governance. Taking them on that journey is the most important one.
Raju, you had some points to make?
No.
Okay. I think you mentioned about two things. I think even as an industry players, we have seen few challenges very recently. I think there was a company is going for increase in the borrowing in the company. It's a debt-free company and doesn't need cash at all to build running the business. They have enough cash in the book, but still the company is going for rising debt. And despite the borrowing and passing a resolution for $1 billion borrowing, the debt equity doesn't change at all. The debt equity doesn't go alarming. There was a debate and discussions we all had, and the analyst was saying that we have to vote against this company because they are suddenly coming to the market, passing a resolution for borrowing debt. So he wants to borrow money and rather take enabling resolutions. Therefore, on the basis they can borrow. Then we debated, discussed, and finally we said the borrowing is meant for what? It's actually increasing the ROC of the company, ROE of the company for the future. That means he's making investment for the future. Therefore, in what capacity actually as an institutional investor, though we have the right to tell the company what they are doing is right or wrong, at the same time, the borrowing is being done actually for building the future sustainable. I think both of you spoke about. And of course, we reversed the decisions. We were supposed to vote against, then we said what we are voting is against that. And same way, we also seen companies, I think you mentioned about Subiksha, and we as a firm also went through way back in 2000. Of course, most of you will not even remember. There is an Y2K kind of solution. And none of us knew actually Y2K solution is a one-time solution on a particular day, night, that's it. Nothing beyond that. And all of us as industry players, we have exposures, and then went and told the management, you must do this, this way you have to communicate, this way you have to inform the analysts and so on and so forth. They probably they would have listened to what you said and what you guided them, but ultimately became utter failure. And then the company is not even in existence today. I think your experience, especially on these two things, capital allocation kind of thing, the independent director mentioned about, there are companies who are willing to bring independent directors completely from the outside the field, outside the domain knowledge. Is the domain knowledge of particular industry is important, or the outside domain knowledge being there, but they are capable enough to bring in some differences to the way the board will operate, the way the questions will be raised, and so on and so forth. And if you can just throw some light on that, it will also be useful to see how companies can be made different by having people with a completely different background.
So, if you see private equity in 2000s, 2010, those 10 years, and those 10 years matter because this was the year, this was a decade in which India began to grow, because if you see 2003 is the time when I think by and large adjustment had been completed from after the liberalized economic environment. And if you saw the financial ratios. I remember some of you who are interested, September 2003 quarter, if you see the results of that quarter and compare that with 1 year back, is sharp jump away and totally different performance. So I think from that 2003 to 2010 or thereabout, with of course GFC in the middle, one thing that was very clear was that both a lot of focus on India, China, and everybody felt that in these two countries we should go in there, invest, and there would be an opportunity to own businesses here. India had a long history of capitalism and all that. China was talking all the right things. And I remember private equity those days saying that operating partners, very, very important. For 7, 8, 9 years, operating partners, industry knowledge, to your question, hire somebody with financial institutions group, consumer, industrial, and those kind of 4, 5 different types of verticals. Have those people in the private equity business, and they will come and guide the companies. Utter failure. Utter failure. Because financial institutions, such a wide, industry. You could be insurance, lending, banking, you could be in mutual funds, private equity. There's a whole host of things that get categorized as financial institutions. And these guys would come from one background and try to lord over and try to teach people with regard to many businesses they had no familiarity with. By 2010, 11, 12, the thinking was very clear. Industry knowledge does not matter. Get wise business people who had experience and make sure that you brief them with regard to your industry as you understand it, fundamentals, changes, regulations, technology, who's growing, niches, etc., etc. Brief them and then leave it, with that briefing, leave it to their judgment to guide the companies. And that model from 2011-12 onwards has worked very well. Operating partners, the whole structure went away. The nomenclature may remain, people still, because I think invention of nomenclature has not happened, but those that, these operating partners that oversee the companies went away, and I think all of us started engaging people with basically senior management expertise and experience and briefing them, and they did a far better job. And by the way, they were also less offensive to management because they came with a certain humility. They didn't come in as experts for that particular industry, micromanaging it. They came with a business background to say, listen, directionally this is right, this is not right, etc. And Rajneesh is here, sir. A lot of people from State Bank of India brought a lot of capability and perspective to set the direction right. And our experience has been, in Bala, you can see this across the board. Private equity let go of these so-called industry experts. They just did not work. This is the reality.
Yeah. So while Rajiv gave the perspective on this operating partner and influence or interference in the investments, my experience has been that, especially in public companies, it's very important to have a board which brings diversified domain expertise. And again, just to share my own little experience in Tata Communications, when I joined the board, I know nothing about technology, I know nothing about telecom, and it's a company that has been built with so many acquisitions from around the world. And I got invited by Tata's, which was, of course, a great honor for me. So I accepted, and then I said, what am I going to do here except look like a fool? I really can't add any value here. And to my luck, in the very first board meeting that I attended, where my children would say it's very difficult to get their mother to shut up. So I coached myself and I said, I'm not going to reveal my ignorance. I'm not going to speak in this board meeting. I'm simply going to absorb. Kept reminding myself. And then what really happened was there were only 3 agendas in the board meeting, and all 3 were investment proposals. So one was investment in a fund, another was investment to buy a company, and so on. And here I am kicking myself because I really want to say a lot of things, because I come from the investment domain, but I have said to myself, I'm not going to open my mouth. So the meeting ended, they agreed to all the 3 investments, and then I told my chairman, I came with a determination and not open my mouth, but I disagree with all the decisions. He said, I would have taken huge umbrage if you had not spoken up, in this meeting. And then life moved on and they actually reversed the decisions. They went into depth about everything that I had to say about why you want to. At least in that board meeting, they didn't record that they are making those investments. And along the way, we benefited a lot by having someone who is only focused on technology, another person who has huge IT services background. The company is making a big transition from but just being a network provider to a solution provider. So we brought in board members who have run IT services companies, somebody with a HR background. I feel that diversity of experience at the board, where you are able to bring a holistic perspective of, is the business being kind of well-oiled on all domains, is very, very useful. But we should remember that finally it is being run by the management. I'm not for a moment a votary of backseat driving. I hate one cap fit all model. And what is even more dangerous is when board of directors or other influential people start to think about, will I do this way? It is not about whether you will do it this way. It is very important to recognize that somebody else is going to do it. And is he or she well equipped, well prepared, and well supported to do it that way? It is very important to bring that mindset rather than develop a view based on, if I were him, I would not do this and therefore I should not go with it. I think that would be my take on domain expertise and diversification of expertise on the board and how you engage in being useful to the management in taking the right decisions.
I think more than diversity, it's also equally important to have directors with a different, varied background. Ignorance sometimes is considered as a bliss. So that's a good point. Just one last point before I open up the floor for questions. New gen versus old gen. I think experience versus non-experience. I came across myself a company, again we had a debate. The father wants to bring the son into the business and is coming up for voting. The first reaction is, he's 22-year-old boy and why should we approve it? He doesn't have experience running the company and he's coming on the board. And I just remember Renuka mentioned a word, Aindil velayadu, Aimbidil velayadu, which essentially means that the seed that you put in at the age of 5, how it can grow and will continue to grow. If you don't put a seed, of course it will not grow. So I presume a 22-year-old boy working with my father continuously, seeing him actually running the business, doing the business, I would probably assume the guy would be more equipped than somebody who is coming from outside. So it is a new gen, absolutely no doubt, but he's going to be part of an established company. Probably he will become the future leader. So what's your sense of this kind of, one is diversity, what spoke about earlier, he spoke about ignorance. I just want to, because the youngsters are becoming a very powerful leader as we speak.
Look, our experience has been, these are the biggest points of discontinuity in a company, the generational change. And there's more than half probability it will not work out. And this is the point where there's the biggest source of rancor between the independents and the so-called directors representing promoters. There's the biggest source of dispute and all that. History is against sticking to the generational thing. And I think this is one reason why, first of all, there's deal flow for private equity, because generational change is a discontinuity that many times now the kids themselves say we don't want to do the business.
Yeah.
But experience tells us world over that this discontinuity does not works to the detriment of the enterprise. So we have, I mean, it's not my experience necessarily, because 20 years is not enough to prove it. But last 300 years history tells us this detrimental discontinuity that has to be guarded against. So I think one has to be very careful.
Okay.
Yeah. As institutional investors, you have to really apply your mind and think about safeguards and all that. It doesn't work.
Okay. Thanks, Rajiv. Before you wind up, any questions from the audience? Yeah.
One is, as institutional investors, what is the role of proxy advisors in influencing the voting decisions? And I find in some cases, the proxy advisors hold a very high kind of a role, and especially foreign institutional investors depend on their suggestions and not necessarily think independently in terms of what is the meaning of the resolution, what is the kind of a role, and what is your opinion? Second question is, in the case of a few companies, when they appoint the independent directors, there is a discriminated remuneration for the people who are from India and people who are appointed from abroad. Foreign people could be expats or could be even Indians employed abroad. Because they are from US or UK, they have a higher kind of expectation of remuneration. They negotiate or whatever happens. The resolutions very specifically say that the Indian director is this sitting fee, this is the commission, or whatever the percentage. But then the people who are coming from abroad have a higher remuneration, though it's within the statutory limits of 10% of the overall, all that is fine. That is ticking the box. But what is your opinion as institutional investors on voting on such resolutions? Thank you.
On the second part, anyone wants to answer? Or
Proxy advisor for you.
We don't do such things.
On the proxy advisors, definitely, of course, there are 3 proxy advisors. And one good thing on proxy advisor is they completely thread and analyze and give you pros and cons of every decision that's being proposed as the resolutions, whether it is appointment of independent directors and or with respect to the capital allocations or any other decision the company passes. They do, of course, their own analysis. And as the money managers, institutional investors, so because there are 3 opinions that has come, we pay attention. I mean, of course, we finally take a call what is the best interest of the shareholders and other stakeholders and how the decision that is being taken by the company is going to hold a future value. So ultimately, our decision has to be driven by that, not necessarily only by the proxy voting agencies, what they recommend. So not necessarily we ignore the recommendations, but definitely the analysis that is being provided independent of us with unbiased manner. Maybe some bias could also be there, we do not know, but that's something we pay attention. It definitely helps in bringing a right level of debate and discussions, and finally we take informed decisions. As far as the remuneration concern, I don't think it's as we talked about gender bias, diversity, etc. Definitely India as a country, the border restrictions completely is going away. I think it doesn't matter whether it is from India or from abroad. Naturally, of course, the parity value is definitely different when you recruit people from outside. I think the way we look at it is, as long as the appointment is going to add accretion to the value of the shareholders, then the decision has to be approved. And that's the way we take decisions, we assess it, we evaluate it only on the basis. For example, the Jaguar turnaround which Tata Motors have done. Definitely somebody who is sitting in India, whether he could have created value for the company, or somebody who actually is international experience, of country level experience, understanding various countries, products and consumer behavior and so on and so forth, has a wider experience, therefore he can add value. That's the kind of something we have to debate and discuss, and basically take a call. I don't think we should be able to, we can actually, on the basis of remuneration, we can knock off anything, as long as the person actually is this high level of confidence on us that is going to create a shareholder's value. Yeah.
Thanks for the comments, ma'am. Rajiv, very interesting. Rajiv, you made a very interesting comment about the China situation. And I work for a pharmaceutical company, and this is whole rhetoric about China +1 and moving a lot of manufacturing to Indian companies as well. So what you said is that the return per dollar or rupee of investment in India has been more than what China has generated. I think completely agree, but if you could spend a minute talking a little bit more about what's the governance like in China for Chinese companies, how are their boards, what are the repercussions of the return for Chinese companies being less than India, what's the long-term implications and something that Indian companies should be mindful of as the future develops? If you could comment on that, thanks.
See, China had a lot of state-sponsored capital, and there was a lot of national ambition that Chinese various governments brought to their regions and their industries. You know, many years back, if you look at 60s and 70s, it used to be said every country in the world wants to have one steel mill, one airline, one car company. And these three industries therefore became the worst industries to operate in over time, because airlines had some protections available with various complicated arrangements. Now, China has something very similar. The capital that Chinese brought, in most cases, was state-sponsored capital that really did not care much for return. So China got growth. They had massive investments. They created a lot of GDP. But the one set of stakeholders who did not really benefit from that was the provider of capital and the lenders, and therefore Chinese banks. Now that kind of a model was almost unthinkable for India, and therefore I think what we stuck to was a more conventional, Anglo-Saxon type of model. Stakeholders, forget stakeholders anyway, capital providers must get returns, all capital providers. That's the only sustainable model. That's what we have done. Now, this has worked well. It means that massive investment will not happen. Investment will be measured. There will be logical tests applied to people making investments. We've had the problem of thermal energy. You know what happened in India, the kind of overinvestment and the results of that. China is living with that, but the banks they know how to deal with these kind of bad loans. They have their own way of dealing with the things. You can see Chinese banking multiples, the picture is very clear. Now with regard to this China plus one, based on that, it's going to come to us. See, if you talk to any company in chemical space, auto parts, engineering, they are inundated with inquiries. But these inquiries are going to come at Chinese prices. Nobody is going to pay you a premium. The question for us is therefore as follows. Can we make a return on capital supplying at Chinese prices? The answer is it's doubtful. And therefore China plus one is not as big an opportunity for countries with responsible capital as it is for countries with socialistic pattern of capital. This is the reality. And you should talk to the chemical companies. They already kind of winding down. Bala would possibly agree. Yeah. You can talk to the auto parts companies. Supplying at Chinese prices, which are highly deflationary, is not easy for India. So that model will not translate over here, given our productivity levels and a whole host of other things. And cost of leverage. And yeah, all that. The cost of leverage, you see real cost. It's not going to work here. So don't get excited with this China plus one. By and large, of course, exceptions exist.
So what will be the implications, Rajiv? So what will happen to the Chinese economy since you have two stakeholders that are not happy with the returns that they're getting? What could be the long-term implications of that?
Is China a bit of conundrum, because if you say for a minute that Chinese capital has been state-sponsored, then China should be welcoming private capital. They have injured private capital a great deal. So I don't have the answer to that, but the contradiction is very apparent. It's very difficult to understand the Chinese conduct. But in the last 2 months, if you've been seeing the press, they're trying to again talk to international capital providers, strategic capital providers, and talk and welcome them and back and all that. Because if the state capital is going to be forever there, it's another story. If you want to bring private capital, then whatever they did the last 2-3 years is very hard to understand. So I don't know, but China will evolve, and China can live with a certain disaffection of people that we cannot live with. So I think there'll be very two different trajectories. To my mind, ours is more sustainable, but market decides on a daily basis. Bala decides. So
I think you used the word, very interestingly, you used one word actually, which I just carefully saw it. If the private capital is injured, then it will have its huge repercussions. So therefore, we also cannot afford to injure a capital provider, create an injury for a capital provider. Which I mentioned about China's private capital has been injured, so therefore they are suffering. So I think that's equally important in every country. And second is responsible investing. At the end of the day, it all sums up to the responsible investing, whichever way you call it. It all sums up to the responsible investing. And thank you, Renuka, and thank you, Rajiv. And thanks, Mr. Damodaran sir, for having...
Bala, I just quote Deng Xiaoping. He said, we can neither do without capital nor without capitalists. So, you know, what they're doing recently, capital is there or capital is not there, not going to work. Thank you.
Thank you. Thank you, sir.
Thank you so much. Continue to be with us on stage. I request Mr. Damodaran to kindly join us once again. Ladies and gentlemen, you're going to see the caricatures for each one of our panelists being brought up onto stage. And we request Mr. Damodaran to present it to each one of our panelists. This caricature has been made right here during this session, and each panelist receives the caricature along with a certificate for 10 trees to be planted in their name in the Sundarbans. Thank you so much. Ladies and gentlemen, put your hands together for our moderator, Mr. A. Balasubramanian, Ms. Renuka Ramnath, Mr. Rajiv Gupta. Thank you so much. Capturing this special moment with a photograph, it always makes for a wonderful memory. Thank you for these truly useful insights. Time well invested, I'm sure all of you agree. Thank you. Thank you very much. Appreciate your presence here with us on stage. Well, ladies and gentlemen, we're moving into our final session of the day right now, so we hope that you are ready. We've got the next session. This is our last session for day one, and it is Corporate Governance Premium, Fact or Fiction. So that's the session that's going to unfold right now. We're going to set the stage and play a video as we get ready to welcome our panelists. Well, it is day one, Gatekeepers of Governance, and this is our final session of the day, ladies and gentlemen. Thank you so much for your patience, but we're staying on time, and it is your presence here that's allowing us to do that. So our last session for day one is Corporate Governance Premium, Fact or Fiction. Ladies and gentlemen, even today, there are persons who believe that the structural arrangements for corporate governance constitute a cost and not an investment. Does corporate governance really add value, or is it only a feel-good factor? Do markets see additional value in companies perceived to be well-governed? Ladies and gentlemen, we look forward to welcoming our panelists onto stage. Our first panelist, Mr. Rajneesh Kumar. Ladies and gentlemen, join me in welcoming him onto stage, please. Mr. Rajneesh Kumar is former chairman of the State Bank of India, SBI. Starting as a probationary officer with the bank, he has held several important positions, including serving as the managing director of SBI's National Banking Group. He was also the chairman of many of SBI's subsidiaries, including SBI Life Insurance Company, SBI Capital Markets, and SBI Cards and Payments Services. He is presently an independent director on the boards of several large companies and is chairman of MasterCard India. He is also the chairman of Board of Governors of MDI Gurgaon. Ladies and gentlemen, Mr. Rajneesh Kumar. Welcome, sir. So, joining us on stage, our next panelist, we welcome Mr. Sundara Raman R., who is the Managing Director and CEO of Bombay Stock Exchange, BSE, India's oldest exchange. Prior thereto, he was the Managing Director and Chief Operating Officer in the Indian arm of Bank of America, where his responsibilities included global governance and control of the banking entity in India and the securities segment. Before moving to the Bank of America, he worked for over 20 years with the National Stock Exchange and was a senior member of the NSE team since its inception. He has also worked with leading public sector banks, State Bank of India, IDBI, and Indian Overseas Bank. Ladies and gentlemen, join me in welcoming our second panelist on stage, Mr. Sundara Raman R. And completing our panel, Dr. Umakant Varotil, please join me in welcoming him onto stage. Welcome, sir. Is an associate professor at the Faculty of Law, National University of Singapore. He specializes in corporate law and governance, merger and amalgamation, and cross-border investments. He has also taught on a visiting basis at law schools in Australia, India, Italy, New Zealand, and the US of A. He's an editor of Oxford Business Law blog, Indian Law Review, Asian Journal of Comparative Law, and the Singapore Journal of Legal Studies. He's also a research member of the European Corporate Governance Institute. Before moving to academia, he was a widely respected partner at the Amarchand and Mangala Das and Suresh A. Shroff and Company. He was also ranked as a leading corporate and mergers and acquisitions lawyer in India by the Chamber's Global Guide. Ladies and gentlemen, join me with a loud round of applause, Dr. Umakant Varotil. Well, now, ladies and gentlemen, we request our moderator, Mr. Sundara Raman, to take this session forward. Sir.
Good evening, everybody. Hope I am audible. I think you would have had a wonderful and fruitful and long day with a lot of sessions. And this is the last session, and I think we are only around 40 minutes or something late. So the advantage of being the last session is the number of participants will generally reduce, and therefore the possible number of questions, so the possible number of questions come down. So the life of the panelists becomes slightly easier. The disadvantage is many of the things which we thought we could talk would have already been talked.
Yeah, in the previous session.
So these are the advantages and disadvantages of being the last panel. Having said that, before I even get into the topic of today, what we are going to discuss, I'll just reference to a few points which I was hearing in the last session. A specific corporate entity and a specific country were mentioned, where references were drawn to say how lack of corporate governance has resulted in erosion of shareholders' value. And also a statement was made, a wonderful corporate governance also gives an impression and sort of satisfaction that probably the shareholders' valuation will be higher when they want to divest or whatever it is. This panel is just asking a question, is it true? It's very clear when there is no corporate governance, there is an erosion in value. That appears to be very clear. But is there a premium? Is the existence of a premium a fact or a fiction? This is the question that is being asked and that is going to be debated. The importance of corporate governance, the fiduciary responsibility, and distancing yourself from the company as a separate person and trying to have an independent view and therefore ensure ethics, all these have been well talked about. And there are lots of cases for us to showcase that if the corporate governance has been poor, there has been a failure, and therefore there has been an erosion in the value of shareholders. So these all become very clear and evident because there are multiple examples for this. But how do we also sort of empirically state that shareholders' valuation is at a premium when there is good corporate governance? On corporate governance, there has been a huge amount of emphasis. If I were to say in the recent times, starting with the Kumaramangalam Birla Committee, which brought in clearly this Clause 49's existence, and then there were various committees, Naresh Chandra Committee, Narayana Murthy Committee, J.J. Irani Committee, multiple of them. And then recently there was a Kotak Committee which brought into existence major changes in corporate governance, and many of them became, the recommendations became law. We also know about the ICDR and LCDR requirements that have come in place. LODR requirements that have come in place. A lot of stringency with regard to the way in which corporate governance comes into existence, and in respect of MIIs like us. MIIs means market infrastructure intermediaries. In fact, the corporate governance norms about our boards are even more stringent because we are dealing with a lot of public confidence as well. So all this is very clear and evident. There are a lot of studies as well which talks about how corporate governance brings in value. One of the data point which I recently saw was this: well-governed firms tend to outperform their peers. Is it true? It appears to be true from a 2023 report of S&P Dow Jones Indices which found that S&P 500 ESG index outperformed S&P 500 index by an average of 1.1% per year over past 5 years. It's a consistent performance. Somebody, when they were referring to ESG, they said good profit to profit that has come from good sources last session. So another 2022 study by University of Cambridge and University of Oxford found that firms with strong corporate governance practices outperform their peers by around 2.3% per year in terms of stock returns. This is another empirical study. It also showed that the outperformance is pronounced in periods of economic uncertainty. Another 2023 study by HBS found that high quality corporate governance structures were more likely to survive and thrive during COVID-19 pandemic, which showed the sustenance capability arising out of corporate governance. Another study of 2023 by World Bank found that countries with strong corporate governance, which was alluded to in the last session, had higher economic growth and lower levels of corruption. And there are so many empirical evidences. Actually, is there a need for a discussion? Could be a question, right? So, well, then let us see the other side of it. We have seen a lot of corporates on paper, in practice, in terms of profitability, listed, unlisted, whichever category they belong to, consistently performing, till one day, suddenly there is a whistleblower, and suddenly certain things happen, and from a top, it is rock bottom in terms of corporate governance. Is that a fiction? No. We have seen multiple such cases. It could be listed companies, it could be unlisted companies. So was there a corporate governance all along then? How come it was consistently giving performance and returns and was looking as blue-eyed in the face of many people, and suddenly one day how come it's at the rock bottom? This is one question which comes to our mind. Many startup firms who have very high valuations, valuations is equal to corporate governance if we equate that way, very high valuations, and suddenly one day we find a lot of issues cropping up from them. So where to place this theory? How to understand it? That's what the experts here are going to help all of us, including me, to unravel. To enable that process, I thought I will pose a few questions to one of them, and of course the other will jump in if he feels that he wants to also add something. And it could be an interesting discussion where we all can learn something. So with that as a sort of a background, I thought I'll pose my first question to Mr. Rajneesh Kumarji, who is a veteran in the Indian banking system, which was talked about. This question: I just want to know whether, in your opinion, the idea of corporate governance premium, is it a widely accepted fact in the business world, or it is still considered a contentious or debatable topic? Additionally, how do investors regard firms that exhibit robust corporate governance? Is there a strong correlation between corporate governance and elevated stock values? Does the corporate governance premium exhibit variation when considering different regions or different industries? Is the premium different for different countries, different regions, different industry?
So, one is, thank you for setting the background in a very elaborate manner. You have already posed certain questions, given certain answers also yourself, and in the previous session also, I was listening to Renuka and Rajiv, and many answers they gave from investors' perspective. So now when we are talking about corporate governance, so one thing is very certain, that you can build a beautiful building on a weak foundation, and sooner or later it will collapse. So when we talk about corporate governance or ESG, this is the foundation, and if it is strong, then the building will be strong. It may not look very beautiful from outside, not necessarily that it will be glamorous, but it will sustain if there are any adversities. So that is the analogy I draw. But when it comes to investing, so we are talking about two sets of corporates, one is private, another is public. And then there are different category of investors today. So there are speculators, they are technical, they are venture capital, there is a but the fundamentals, the people who are knowledgeable, institutional investors, when they do their research, and that's what we heard in the previous session, so definitely the first thing what they will look at, that who are the people behind this venture? If there is a board, who are the people sitting on the board? What is their background? What is their capability? What is their structure for corporate governance? So they do their research. But if we are talking about a stock market, then it is a very different game. And that's what we see. So if I am a day trader, it doesn't matter what you do, what is your governance. If I see the opportunity to make money or a quick money, I will make it in a day. So make money, lose money, it doesn't matter to me how the corporate is governed. That's a different class of investors, and same for hedge funds. They take bet on certain technicals. So what we are talking about, it will limit it to the people who do it knowledgeably, who are there for long term, with a horizon of 5 years, 3 years, 7 years. So definitely when they put their money, for them, apart from the industry outlook, how it is company's competitive position in the market, its earning potentials, its competitive advantage, there are so many factors which come into investing, whether it is equity or as a lender also if you are giving money. But the first question, the starting point, whether a lender or equity investor is, who are we giving money to? And what is the DNA of this organization? So the answer, there is no clear straight answer to this according to me, although you quoted certain statistics. In the public markets, according to me, even today, certain, say I'm talking about Indian experience only, that there are certain businesses, houses we are generally associated with, that their corporate governance will be good. It is assumed. And it's not that all their businesses succeed. There will be business failures. So when you're investing and investing with the intention to get a return on your investment, so even if there is a good, well-governed corporate, but it can fail. It's not that it is the recipe for success or higher earnings. And investing, we know it all also depends upon earnings and what multiple you give. So, but when we are comparing, say, in the same industry, same market, and so if there are 5 investment opportunities, then yes, you will have a look definitely that I will put my money on this company because I believe that they run their business honestly, and my money is safe. So there's some safety and then the return. But fundamentally, a corporation which survives for long, then it cannot survive on falsehood. So you were referring to that suddenly you find that, and there have been so many examples in US or elsewhere or India, that suddenly you find that the story was not good. It's just like that you have built a beautiful, you have put a facade, but the foundation was weak. But by the time the investors realize that the foundation was weak, the damage has been done.
Thank you, sir. Umakanji, you have some ideas on this question?
Thanks. So, Mr. Rajneesh Kumar has articulated the practical side of things because he's experienced in the industry. So, I will probably provide a slightly conceptual understanding of corporate governance premium. So, at the outset, I think our panel topic is corporate governance premium, myth or reality. And I think it's kind of a difficult question, and maybe as like anything else, probably the answer lies somewhere in between. So the first question is, what do we mean by premium? I think if premium is considered in terms of financial incentives, share price, I think that's a measurable aspect of it. And there I think the studies that you quoted and so on will become important. And there I would say it's a mixed bag, because there are studies which demonstrate the existence of the effect of corporate governance on share price or effect of corporate governance on financial performance, but there are also studies that show otherwise. That's not because of the lack of understanding of the concept, but because that is due to the differences in the metrics that people use to make these studies. So to me, I think that's one aspect of premium, but I think as an investor or as a corporate governance professional, we also might have to understand premium from a more intangible perspective. Because it's a gut feel, it's not just a monetary returns, but as we've discussed, will an investor invest in that company? Do they have the trust and confidence? So premium has that kind of element as well. Will a customer be willing to buy a product from a company which doesn't follow proper governance principles? So I think there's kind of a tangible and an intangible part. There's a lot of discussion and debates about the tangible part of it, the share price part of it, but I don't think there's a debate about the importance of the intangible. I don't think anybody can quarrel about the fact that the intangible element of corporate governance does have a certain amount of premium. So I think that's kind of something to keep in mind as we think about it. The second thing that we need to think about is what do we mean by premium? Is it premium at company level or premium at country level? To me, premium at company level is more difficult to fathom because each company has its own governance structure, each company has its own software, so to speak, from the governance perspective. But it's easier to understand premium from a country perspective. And here, I think there are studies in India as well which show that the better the corporate governance environment in a country, some of which is driven by regulation, the better the premium is likelihood of premium in the market. And here there are studies which even show that, you mentioned the Kumar Mangalam committee report, Birla committee report, which was in 1999 or so. There have been some studies which show that the moment there was an announcement of the Kumar Mangalam committee report recommendations affecting a certain type of companies, there was an increase, notable increase in the share price of those companies through an event study. So there you can establish that there's a correlation between what happened in terms of governance recommendations and actual returns to investors in terms of the market price. So I think the country level studies are somewhat easier. I'm not saying that that's beyond that is also beyond that has some controversy, but nevertheless country studies are somewhat easier to establish. And the reverse is also true, and I'll give you an example. I know we are talking about the upside and not the downside, but the converse of premium is also the discount. And here, one element which has been studied internationally, and this is well documented, is something known as the Korea discount. And the Korea discount is studied because the understanding is, even though South Korean companies perform very well, we know Samsung and others who are market leaders in products that they bring into the market, there is a sense that the governance is not all right because they have the chairballs, the group companies, and the transparency is lacking, the structures are very complicated. So there have been studies which show that Korean companies perform lesser in the market compared to their global peers from a stock market perspective. So there's a discount as well. So to me, it seems like, I think 2 points that I would like to add to the discussion. First is, I think there could be a lot of discussion about what do we mean by premium and discount. And secondly, how do we see premium and discount? Is it at company level, which in my opinion is more difficult to establish, whereas it's slightly more easier. I wouldn't say easier, but I think it's more direct in terms of country level analysis. And this, I think, goes to the discussion that in the previous panel as well about how the country's ecosystem can determine premium or discount as far as global investors are concerned.
Very interesting, the distinction in terms of different players and their goals, therefore, the importance of the basement being stronger and the connotation of premium being different, the tangible and intangible portion, the country level, corporate level. Wonderful. So one thing, one instrumentality in ensuring corporate governance has been the rules associated with listing, be it ICDR or LODR. That brings in some amount of regimen and a forced sort of understanding into the requirements and compliance. Then how do we ensure that in respect of startups and unlisted companies that there is a corporate governance, and how it therefore would help people who are planning to invest into it to achieve this? That is one question that comes in, because quite a few cases of unlisted firms having trouble or startups having trouble we have seen. What do you think are the challenges unlisted entities encounter in implementing corporate governance? So Umakant, if you could please start with this.
Thank you. I think that's a very important and sometimes underemphasized question, because as was discussed during the session on startups, corporate governance overly examines the importance of listed companies and governance on listed companies. So even if we look at what's happened in the last 20 years in India, apart from the Companies Act, which brought in reforms on corporate governance, otherwise it's SEBI which has been looking at focus on corporate governance and corporate governance reforms. But if we look at the corporate demographics in India, there are about 1.5 million companies, out of which I think Mr. Sundararaman will be the best person to answer this. My understanding is there are only about 6,000 or 7,000 listed companies in India. So the listed companies are only a minuscule proportion of the whole universe. So to that extent, we don't focus that much on unlisted company governance. But at the same time, unlisted companies have become very important, both in old age industries as well as the new age industry. So to take well-established industries, and this is an open, I'm not revealing anything that's unknown. It's a well-established case. If you look at the Tata dispute, and it went all the way up to the Supreme Court, it related to unlisted companies' governance issues because it related to Tata Sons, which is an unlisted company. So there, in my opinion, I think everything, as you said, relating to securities regulations don't apply. It is what I would call as contractual governance. So what have investors contracted? Do they have a shareholders agreement? Is there something in the articles of association of the company? That will determine how the governance takes place in those kind of companies, because ultimately it's left to a small body of investors. So there, I think premium has a different connotation because there's no market for the price of shares. Of course, you can do a valuation and determine whether there's a corporate governance premium or not, but premium has a slightly different connotation there. And for unlisted companies, the way I look at it, I think there are broadly two types of unlisted companies. One set of unlisted companies which are looking to list. So either they could be in the process of looking for an IPO at some point of time, including companies which have taken private equity or venture capital investments, and those investors are looking for an exit. So there is a prospect of looking to list the company. And there, I think those companies would do well to establish listed company type governances early on, rather than just to make that governance a topic come up just at the time of listing. So it should not be like you run the company without any governance norms. Suddenly, listing is looming large, and then you start putting together your the listed company sort of governance. I'm not suggesting that all companies are doing it, but I think it's a good way to put the listed company type governance sometime early on in the space, have some, lead up to that and then deal with, those type of situations. Or it can even be an M&A. You don't have to list, but if you want to sell the company, whoever is buying your company is going to do a due diligence, and governance issues are going to be one of the due diligence issues as well. And in due diligence, it's not so much about looking at the records, the financial statements of the company, it's about the look and feel of the company, the trust, who are you talking to? So when you're talking to a promoter who thinks about governance, I think the acquirer is probably going to easily understand and get the, the soft tones of whether it's a good, well-governed company or not. So in my opinion, whether you're going to sell the company, list the company, it's good to have significantly formal governance mechanisms put in place beforehand rather than to wait to list subsequently. And then of course you have companies which don't intend to list at all, like maybe it could be a family-owned enterprise, it could be a joint venture. There I think, I'm not suggesting that you don't need to have listed type governance, but I think you need to have something a little more formal than just running it pretty much informally. And just to kind of close on this topic, I think there are some developments in the Indian context which are both positive and to some extent might be challenging as well. I think the positive regulatory development in some sense is India is one of the, so if you look at the regulatory space on governance issues in other countries, there's a binary approach. If you're listed, there's a governance mechanism. If you're not listed, there's a different governance mechanism. But in India, Companies Act of 2013 has brought in something in between, which is if you're a large listed company, you may also have to follow some of the governance norms. Like some companies unlisted may have to have independent directors, you have to have an audit committee, material subsidiaries, those kind of things have to also be considered. So that, I think, is one way by which the government has already taken that into account in the 2013 Companies Act. But what I read in the newspapers now is because of everything that's going on in the unlisted space in India with startups and so on, the government is actually thinking of even including things like quarterly reporting to the Ministry of Corporate Affairs for large unlisted companies. Now, I don't know whether that is going to be an overkill or not, because that will create, in one way, it will increase transparency, but I think it will also increase the cost of doing business. So I think that's a space left to be seen. Where I think the government is conscious of what is happening in the unlisted company space, but you also don't want the needle to move completely to the other side, where there's too much cost in carrying out business if you're an unlisted company.
Mr. Rajneesh, your views?
Yeah, so very elaborate again, and we can expect very elaborate answer from him. But what we have to understand when we talk about the governance, that and specifically about the company, that it's a limited liability company. So when it comes to governance, the fundamental laws, which is the company law, so essentially it is the same, in spirit at least. The rigor or the requirements may be a bit different, but otherwise, the very nature of the very nature of the fact that a company is a limited liability company and there are outsiders dealing with it. So otherwise, why do we need a company law? Isn't it? If I am a proprietor of the business, I'm not governed by the company law. But if it is a company, then it is not a proprietorship. Even if there are 3 or 4 or 5 shareholders. So why the differentiation around the law for the listed entities arise? It is because the nature of the shareholders. The creditors or the other people who are dealing with the company, whether it is a private limited or public limited or a listed entity, they are same. But when it is a listed entity, then we are looking at a large minority shareholders. So whatever the law has evolved or whatever the mandate even for SEBI is, what they are looking at is that who will protect the interest of the minority shareholders. And that is the reason that why you need so many disclosure requirements, the requirement for independent directors. This is all arising from this fact that there is the number of people who are investing. That number is huge, and we need somebody who can speak on their behalf. So that is my understanding of what differentiates, but otherwise, in terms of expectation, company itself, because it is an independent person in that sense. So whoever is the promoter, he just becomes a trustee. Many times there has been a debate about that, why should banks insist on personal guarantee of the promoters when it is a limited liability companies? And my answer to that is, yes, we don't need personal guarantee, but provided then you act like a trustee. Then you distinguish yourself that I, being a promoter, and the company, both are distinct. Because you don't distinguish yourself, then I am in my rights to insist on your personal guarantee. That has been my answer.
Very interesting. One important point which all of us talk about and repeatedly say everywhere is the board governs and the management manages. And when we talk of board, the diversity of board, the stability brought in because of the diversity in the governance is repeatedly talked about in multiple forums. While diversity is a very bigger term, typically we associate it as women directors. One question in the last session that was asked to us, when there is diversity, there is some amount of discrimination in terms of the region from which the diversity comes. Leave that aside for a moment. It's clearly understood and established in multiple forums that the existence of women directors on board brings in greater stability. How do you think that this particular aspect of women directors improves the premium and improves the corporate governance standards? Any experiences that you have had which you would like to share? Mr. Rajnikant, starting with you.
For me or?
For you.
Oh, okay.
Both of you should answer this
No.
because we all have got diversified experience in this.
So my take is slightly different on this. So we cannot generalize, honestly. The need for gender diversity, it is being driven by the fact that this is a male-dominated society. And the fact that there is male chauvinism is also true. There should not be any hesitation in admitting that. So when there is such a situation, and if the society wants to be a developed society, then participation of women at all levels is needed. Now when it comes to like only by the fact that there is a women director that will improve the quality of the governance, I have my doubts there. So when you have a women director like any other director, what are the qualities? You can have intelligent women. Like intelligent men, you have dumb men, you have dumb women. So it will ultimately depend that who do you put on the board. But why do you need gender diversity? The reason is a bit different because, and I've seen it in the State Bank and now 33 to 35% is participation, but the onus of running the family, that largely is still on the. So if there is not a positive encouragement, then what happens that at some point of time, there is a time when they say, I want to quit, because it is extremely difficult to carry both the responsibility. And that is where this affirmative action, where there is like actively the organization takes care of its women workforce and also make it aspirational. Then there are chances that you retain them and you ensure their participation. So the insistence on gender diversity, I think, is, according to me, I may be wrong, is not about whether it improves the quality of governance. That would ultimately would depend whether male or female or whoever, what qualities they bring to the board.
Your views.
Thanks. I think my views and what I've seen in studies is kind of consistent with what Mr. Rajneesh Kumar mentioned, because I think the first question is who is the person, individual concerned. It could be a woman, it could be a minority from ethnic minority, so these are issues which are being considered in the US as well. But two points to make. Firstly, when we are thinking about a premium for diversity, interestingly, the studies are overwhelmingly positive for diversity premium as opposed to overall corporate governance premium. So a lot of times studies have established that having women directors, having ethnically minority directors are actually improving corporate governance. But those studies don't necessarily tell us why. Correlation is not equal to causation. But if you dig deeper, I think it resonates with what Mr. Kumar said, which is one study which I recently saw published this year in the Journal of Corporate Finance on the introduction of the one-woman director requirement in India under the Companies Act of 2013. 3 things came out in the study. First thing is the study showed that there was a positive effect on prices, there was a positive effect on premium. But the second is a very, very important condition, which is that premium is evident only if 2 other conditions are satisfied. One is that director is qualified. So is that person a capable director, woman director on the board or not? And qualification can be debatable. Is it qualification based on that industry experience? If you're a corporate lawyer, are you qualified? If you're an auditor, are you qualified? I think that's debatable, but you have to be qualified. And the second is the woman director has not to be affiliated with the promoter or the company management. So in other words, it should be an independent director, which is something again which the corporate governance norms based on Uday Kotak committee report have already implemented, saying that in large companies, the woman director also has to be independent and not just somebody part of the family and so on. So I think subject to these 2 important caveats, I think we do see some positive outcomes of the benefit of women directors. And the third thing which was interesting from the study has a broader societal impact, where this study also looked at which are the companies where the impact is higher. And they also found out that the impact is higher in companies which are incorporated in states where gender discrimination is higher. So if there's a woman director in a company in a state where gender discrimination is higher, the impact of having that woman on the board is much higher than in other places where gender parity is much more understood. So even that is very interesting. So having a woman director on the board need not necessarily help the company, but it can also help society. And one of the things that is also interesting, not just in India, but also elsewhere, is there's a lot of focus on diversity, on the gender diversity, but I think there are other elements of diversity as well, which takes us back to the ESG discussion we had. Can we lump all the elements of diversity together, or do we have to isolate them? I think that's something to consider as well.
Yeah, my experience is partly in line with what you're talking, and partly it has some specific nuance to it. Given the qualification or the minimum requirement and independence as granted between only male boards and a mixed board, I found the benefit in a specific way in respect of a mixed board. In the board, why do we have independent people? To have independent views. The moment you say independent views, that means people looking at the same problem given the same set of facts with a different outlook and in a different manner to probably come out with a different nuance. Gender brings naturally the type of a capability is one thing which I have seen. There are lots of studies in this area where factually looking at it, also putting heart with head, how much of heart, how much of head, all this comes in. So many times in respect of matters where this balance has to be between the heart and head has to be different, when you want a different view, having a diverse board helps a lot, and there are multiple such things which come across into the board on a regular basis, because it's all not about making money and business, it's a set of human beings which what you're handling in a corporate entity. So I found, my personal view is, given that the independence and the capabilities or minimum requirement for any board of director, I have found a diverse board helps a lot in not only for the management to manage, because it gives a lot of different perspectives, and also in the eyes of public that brings a balance. That's been my limited experience. This question is to Umakant to start with. In a dynamic landscape of corporate governance, it's of course dynamic, we are seeing that. We have witnessed a spectrum of outcomes, with some organization achieving notable success, while others have faced significant challenges. Can you please provide some insight with some examples, if you can, that showcases both the successes and challenges in the realm, not in share price performance, in the corporate governance area? And what do you think are the key lessons we should draw out of these successes and failures, so that it can be instances which can guide us for a better future?
Thank you. So thanks for that. First of all, I might start with an apology, because I'm a little hesitant, especially on the success side, to name examples for the same reason that you mentioned, because today's success might be, may not be remaining the same tomorrow, but having on a lighter vein that was, but there are definitely many successes, and I can see some of the successes mentioned on both sides here as well. So there are many success stories. But to me, and there are many failures as well. We've seen examples of that. I don't need to name, because there are high-profile failures, and some that we're seeing now, especially in the startup kind of sector, where there's a lot more activity happening on the failure side of things. So to me, I think the big issue is, how do we examine the successes and challenges? And this goes back to a large debate that we've been having throughout the day. And to me, I think one lesson that we can take is from a country which is not spoken about that much in corporate governance sphere, but I think there's a lot of development happening there, is South Africa. And South Africa has a very key person called Professor Mervyn King. And Mervyn King has issued a number of reports which have formed the basis of corporate governance in South Africa. And one of the reports of Mervyn King resonates very directly, because he says, when we are looking at successes and failures, we typically tend to look at the inputs into corporate governance, but we never examine the outcomes of corporate governance. So we are always considering, okay, do you have a board which looks like this? Do you have, a minority shareholder protection? So it's all law in books. So everything, you can window dress that very easily, because you can make everything look as it is, but where are the outcomes? So are the outcomes in terms of investor returns, in terms of protecting the stakeholders there, it's going to be very, very difficult to measure those outcomes. So maybe at some point of time when we look at the successes and challenges, I think if we put forward a outcomes-based approach, I think that will bring a lot of clarity to the understanding, and that's going to be difficult. And that can't come with regulation. It has to come inherently from companies. So I think a lot of it has been talked about, and Mervyn King talks about 4 things. One is ethical culture. It's already been spoken about a lot today. The second is about performance. And when we think about performance, it's about long-term value creation, which also came up today about short-term versus long-term. There was that discussion. So it's all about long-term value creation. And the third is about control. How do you control the company? The board has an oversight mechanism. So you can have the perfect board which does no oversight or very limited oversight. The outcomes are going to be not what you want. And there's a lot of jurisprudence developing in other parts of the world where there's a lot of oversight responsibility on boards, which hasn't hit the Indian shores yet, but who knows, it's going to come up at some point of time, where there needs to be proper compliance mechanisms, etc., and setting the tone at the top. And the last one, I think, is the most important one, which is legitimacy, where these governance mechanisms have to be bought not just by internal stakeholders, but by the external stakeholders, the consumers, the investors, the society as a whole. And I think that's going to be an area where we don't think about just the internal stakeholders in the company, but how we legitimize corporate governance in the broader society as well. So I think, to me, if we are able to map out any of these outcomes very clearly, I think we can then determine which are the successful companies and which are the companies which have failed. So I must apologize that I haven't given you specific examples as such, but I think if we place these metrics, it would be pretty much clear in terms of which are the good ones and which are the bad ones, and that can be subjective, and it's fine to be subjective. There's no problem with that.
So the key lesson what you're telling is, don't just concentrate on the inputs.
Yes.
They have a potential to get window dressed. look at the outputs, so that will help you to identify success factors. Yes. Great. Mr. Rajeshwar, your inputs on this question?
We know this world, and again, it has always been that the priorities on the success measure also keeps on shifting. So at one times it was like, I'm talking again in the corporate context, that it is the earnings which defines the success. There was a time that you just focused on earnings. And if your earnings are good, you are a successful corporate. But now the times have changed. So when we are talking now, it's not about earnings, we are talking about different stakeholders. And a corporate, now it is that it does not exist only for the shareholders or the shareholder value creation. A corporate today is expected to be accountable and responsible and create value for all its stakeholders. So that is where I think that differentiation is coming, and that is where ESG has become more relevant. Because when we talk about ESG, that is not taking care only of the shareholders of the company, but the very purpose is that a corporate creates value for all these stakeholders, including the society at large. When we bring in a factor like climate change or environment, which is today the hot topic and point of discussion at every forum, at every level of the government, whether it is the regulation which is evolving. So it has become this thing. So when you are defining success, going forward, how will you define success? If suppose a company, it is expected to invest heavily in protecting environment, it will have an impact on its earnings. So there is a contradiction. If you look at the shareholders' interest, they are concerned with the earnings. But if you look at all stakeholders, then that is where all this debate around that what is the economic cost or the social cost, not economic cost, what is the social cost of success? That is what is being taught. So I think today the success will have to be defined that a successful corporate in my view will be which takes care of all these stakeholders, and the stakeholders are many as well.
You talked about one inherent controversy with rather contradiction with regard to with the situations which we talked about the social cost versus, which is a very interesting point. Another contradiction that comes to my mind is about the startups. For some of the startups, it's day-to-day existence and getting money for running the company tomorrow. And some of them, it's running behind a valuation game, which becomes the importance. So clearly and naturally, therefore, there is every probability for them to lose sight of corporate governance. And then what do you think should be the measures taken to ensure that they don't lose sight of corporate governance and they maintain accountability, transparency, ethics, and whatnot in their day-to-day operations? You can have a quick reply on this so that we can devote some time for questions.
My reply to this is that whatever has happened to the startup world, investors have to take larger blame, the startup themselves have to take lesser blame. Rajiv, is that correct? So you are putting money on GMV. What is GMV? We did not hear 10 years ago. TPV, GMV, number of customers. So they were a different class of investors. And in many, when I was chairman SBI, so there was a company which was valued at 20 billion. Why it was valued at or 10 billion or this thing? State Bank was also valued similar. So I asked, so they have I'm talking about a housing loan company, you will understand also. At one point of time, their valuation and the State Bank's valuation was identical. So I asked, it's a slight digression, I will answer your startup question also. I said, why it is? In the first call with the analyst when I took over charge, why it is so? They have a portfolio of 1 lakh crore of housing loan. So I have my portfolio is 3 lakh crore housing loan. So at least give me valuation of 3 lakh crore. If you talk of customers, They have, sir, 10 million customers. I said, I have 40 million. But you don't give valuation to State Bank. You do. Okay. And in one of the, again, similar discussions, I said that if you can value, and I will name also, that if you can value Paytm at 20 billion, then YONO is 40 billion. Because I am making money. On YONO, they are losing money. So valuation, I think, and we have heard Rajiv, is a very different, but I think the valuation for a startup was driven by, when the investors were putting money, corporate governance was not on their agenda. Not at all. It was about the future potential. And the way they work, they also like, it's a blind bet sort of thing, let me put it this way. That you invest in 10 companies, one becomes successful and pays for the failure of 9 others. Is that theory correct? So the people who are investing in, that's a different class of investors, and they have a very short term horizon. They have to exit in 5-6 years. They are not there for long term. What we are talking about, value investing. So it was a different class of companies, different type of capital, and by those people who had no understanding of corporate governance. I am telling it here in the open forum. Who are their nominees? They have never worked in any corporate. So what experience they have of the corporate governance? And everything in a startup had happened right under their nose. Who are the nominees of all these investors? So just to blame these startups for that, they are young people. They are creative. We cannot doubt about that. They came with a lot of dreams, energy, positive energy, because I have seen both sides of the world. I have been in a corporate like SBI, and now I am actively involved with the startups. So when they were putting their money, investors, I am telling you what should they have done. Rather than putting young boys from their investment team on the board, they could have reached out people like who have no hair, gray hair, to watch for their interest, which they did not do. So neither their nominees nor the people who built these companies, they had any idea about what the corporate governance is. And that's the whole problem, and sooner or later it was to happen, and it happened. So now that some sense or some good sense is prevailing, and the success for any startup would be that there are 1 or 2 people at least, not many. Because if you have too many, again, gray-haired people, they may become an obstacle. So we don't need that, but 1 or 2 people to watch, guide, and tell what's right, what's not. And the people, they have that attitude of encouraging innovation. Don't put obstacles in that creativity. Then it can work, and it will work. I am very confident about it. And everybody learns from mistakes, but when we talk about a startup valuation, it's entirely a different ball game than what we see for the other companies. And there have been many, now you take example of Amazon, you take example of Tesla. So if Amazon started in 97, 98 with this type of capital, and today where they are. So what these investors are looking that out of so many, one Amazon and their money is recovered. So that investing philosophy is very different, governance philosophy is different. The parameters on which the valuations are done being very different. So everything is material but earnings. So profitability was not thought of. Rather, to my surprise, the more loss you make, you are more valuable. So that is the answer to the question.
Thank you very much. Thank you very much to the panelists. Keeping time in mind, this being the last session, we have 8 minutes to go. If there are any questions.
Hello. My name is Debashish Mohanty, and my question is to Dr. Umakant. Sir, it's established or settled, accepted that governance has premium. My question is about other two, E and S. Is there any empirical study that between E and S, you may treat them standing alone, which has got a more causal connection with long-term sustainable performance, financial performance between E and S, if there is any empirical study.
Thanks. So, to be honest, I'm not aware of any specific empirical study, but I would hazard a statement that I think there's a lot more traction on the E element because the environmental issue is an existential crisis. So climate is an important issue, and we heard it in the ESG discussion. So I think companies which are not taking the environmental issue or climate consideration into account are going to be in trouble in the long term because of regulation, because of phasing out fossil fuel and so on. So companies which are particularly vulnerable to that, and we heard about the oil companies, right? So oil companies which are have to also come up with alternative plans. Otherwise, they will be suffering from a risk. So here the E element is not just about doing good to society, because if you don't take the E risk into account, if you don't take climate risk into account, it's going to affect the long-term profitability of the company, and investors are going to take a direct hit. So it's not just about doing good, it's actually about addressing a long-term risk for the investors. And I think I would say in your question, E is more important because the S part of it is a little more hazy at the moment because there's no direct implication. It's a good thing to have, and there's some studies which indicate that, but I think the correlation is not as strong as it is for the environmental and climate issues, which are an existential risk currently.
Any other question? Yes, sir.
So, Rajneeshji, sir, this governance is imposed by shareholders, they appoint directors, they provide the mechanism, framework, and therefore there is a tendency in private sector to start categorizing. This is a good group, well governed, not so well governed, like that. But when it comes to the government of India as owner of businesses, the classification breaks down. So if you see State Bank of India, you are in possibly best bank in the country, the whole host of other banks owned by the same promoter. That means apart from governance, culture also matters, institutional culture and processes. Well, how do you think, where does that play a role and what do managements do? Because in governance we talk a lot about the shareholder and what he imposes, but there's something getting pushed from the bottom up, as an example of State Bank. Somewhere I think that has been less talked about, but your comments, because you've had full innings at State Bank, will be helpful.
Yeah. So one is that when government is the shareholder and they are the majority shareholder. So in case of government, unlike other corporation, the will of the majority shareholder reigns supreme. What happens to the minor shareholder? You may have SEBI, you may have company law, but whatever it is, but it is the majority shareholders who will drive the. But within that also, the performance can be different. So government owns more shares in other banks than the State Bank of India. But still, people say, I am not saying it, but the SBI has generally considered to be well-governed bank as compared to many other public sector banks. So owner is the same, right? So over a period of time, what I feel that there is a certain ethics and DNA which develops in an organization for whatever reason. It's very difficult to pinpoint that reason that why SBI is different than other banks which are owned by the government. And same is the case with many other public sector undertakings. And in the banking sector and the other public sector, like OMCs, so they have been almost in monopolistic situation. But for banks, there has always been some competition in some form. And then the best thing to happen to the banking industry was 91 reforms which brought in private sector banks. So two things happened. One was the listing of the banks that helped despite government being the owner. And second was the entry of the private sector banks. And in a competitive environment, I would still give credit to the public sector banks that despite the issues around, because say if it is a board, so we know that the will of the representative of the majority shareholder will. There is nothing like independent board in a public sector organization. That is a myth, according to me. So, so that's it. So it's all depends upon still. And one reason, it may not be, people may debate it, but one reason which I believe that in SBI has been that for most of the time the chairman has been from inside the bank. It may be a good thing, it may be a bad thing, because the counter argument would be that because you always had chairman from inside, so you're not getting the fresh. But the musical chair game which happens in the other public sector bank, the GM to ED, ED to this thing. So to understand the organization, to feel loyalty, to be part of that organization, that is missing. So that could be one plausible reason that why SBI is different than other public sector banks.
I think we have reached the end of the session. Sir, yes, sir.
Two or three comments and one question, very brief comments. One on what Rajiv said about public sector. It's a fact that the government as majority shareholder of public sector undertakings, including banks, neither understands corporate governance nor cares for corporate governance. I think to expect that the government understands this, they don't understand the difference between ownership and management. And if you don't understand that, corporate governance doesn't get started. That's my brief comment on what Rajiv said. On Debashish's question, I have a slightly different take. E and S are subsets of G. If a company has good environmental practices and good social practices, it adds to the governance. I look at E and S as a subset of G. And now my one comment and one question, which is, you mentioned it's a hypothesis really, there's no evidence at all. Nevertheless, I am, shall say, tempted by Dr. Umakant's presence here with his understanding of corporate governance on a global scale. If there is a woman on the bank board, or on any board, sorry, she might not contribute much as a director. If you had a man in her place, he would have done as much. What it does is that all the other guys on the board, they focus on the discussions, so there are no old war stories told, no locker room conversation. You get more focus, and that is what she brings to the board. Even if she doesn't contribute, it's an untested hypothesis, but based on observation. If you notice, men in a board where there is no woman tend to slouch in the chairs. When there is a woman on the board, say, sit straight and ask the right questions. And this is based entirely on observation. My question to you, this is not a light-hearted observation, serious observation, but my question to you is a corporate governance premium or a corporate governance discount based more on perception management than on reality? We know a lot of companies that manage perception very well and persuade the rest of us that they're very well governed. The reality might be something else. And there are companies that don't invest in perception management, and therefore every minor problem tends to get blown up. I don't know whether that's something that you share.
Thank you, Mr. Damodaran. I think it seems to me that currently a lot of the premium discount discussion is based on perception. But to me, the premium or discount discussion is also dependent upon market efficiency. So the more the information regarding a company is out there, and this is not just the perception but the reality within the company, the more likely it is that the premium or discount will track the reality. And I think SEBI has done a lot of things in the last 20 years. Mr. Sundar Raman mentioned like LODR regulations. So I think there's a lot more that's coming out in the open. Maybe some argument can be made that it's an overkill. But I think it's moving from perception to reality, but I still don't think we'll get there. A lot of it will still be based on perception.
Thank you so much, sir. Maybe probably this is the last question because I'm getting a flash, the time is up.
Can I have a last question?
Yes, sir.
Yeah.
So this question is for you, Sundar. Earlier on you said that a market infra entity like BSE deals with public trust, public confidence, so corporate governance is more stringent. Can you elaborate on that? And also in the case of your exchange itself, which is also listed, so it's an exchange which is a listed company also. So does that also add to the complexity? Just can you elaborate on that?
I will not say it's complex, it's different, and anything different need not be necessarily should be taken as complex. I find it is a welcome thing and it is an important thing. Let me say some areas which are different. In the case of a market infrastructure intermediary, so before that, when we talk of governance, we say the bedrock of governance is the quality of directors who come in place. In fact, one of the mention that was made was, you don't blame the startups, it is the people who are sitting in as investors and directors whom to be blamed. So the quality of directors will decide how the corporate governance works in any entity, which is not different for MIIs. So since it is public confidence, public money and everything involved there, the regulators have been rightly so very worried about what is the type of the directors who will be there. What we call as public interest directors will be there in the boards of these intermediaries. So in respect of a normal corporate entity, the process followed for appointment of a director is very different from that in the case of an MII. Today you do a background check and you suggest 2 names to the regulators, giving them the leeway to see which one is suitable in their ideas because they have more access to information. That helps in ensuring good quality and independent directors, which was mentioned, come into the board. That goes not only with regard to the normal directors, it also with regard to the managing director of the entity. Not only that, you cannot have more than 2 terms. After that, there should be a cooling period. You cannot go into the any other firm immediately or come back again. So these type of normally what you would like as good corporate governance requirement have been put in place to distinguish them and rather put them in a different class compared to a normal listed entity. There are requirements which, in my opinion, if you have a governance board, some people may think as a hindrance that everything you have to go to them. But look at it this way. You are also an employee as a managing director of MII. You do not know every time whether you are taking right decisions. If you are able to have the collective benefit of thought process of multiple specialists in their own field with wide experience, some of them with no hair and some of them with gray hair, some of them with black hair, it becomes very helpful. Then you are also confident that you are not doing anything wrong. So I think it provides lot of security, lot of safety, lot of comfort and confidence to be in the board of an MII compared to any other board where you may take some decision which can go wrong. Here there are a lot of checks and balances to at least help you that it does not go wrong. Things can still go wrong, at least there is some backstop. Okay. Thank you so much for your patient listening, and thank you panelists, and thank you all for this opportunity, and have a very good evening, and thank you.
We request Mr. Damodaran to kindly join us on stage. We'd like to thank our panelists, ladies and gentlemen, Mr. Rajneesh Kumar, Mr. Sundara Raman, our moderator, and Dr. Umakant Varotil. Thank you so much for sharing your perspectives with us on this really important topic, corporate governance premium, fact or fiction. What an amazing day it's been. It's been truly productive, ladies and gentlemen. And with that, we've come to the end of our 6th session of the day. We'd like to thank our panelists. Each one receives their own caricature. A round of applause, please. And a certificate for 10 trees planted in the Sundarbans in their name. So, ladies and gentlemen, 6 sessions, 18 speakers, over 180 trees that are going to be planted in the Sundarbans. We come to the end of day 1 of Gatekeepers of Governance. We're going to see you tomorrow at 9:40 because it's going to be an amazing session, starting out with conversation with the one and only Mr. A.M. Nayak. 9:40 tomorrow, ladies and gentlemen. My name is Keisha Lobo, and I'm going to see you day 2, Gatekeepers of Governance. Thank you so much for your patient hearing and being a part of this evening. Thank you.
don't fail to be here tomorrow morning. We have the one and only A.M. Naik, and you will get some very interesting insights from someone whose corporate journey is a little short of 60 years, 60.
So ladies and gentlemen, 9:40 tomorrow morning, we're going to see you here and looking forward to you being a part of day 2, Gatekeepers of Governance.